Before we start this video, do like and subscribe to our channel and not miss on any updates.
Okay, now let us come to the third one. Third one is what? Third case study is from May 22 question paper. It is of BMY. Okay, BMY. In this also, I think there was an issue. Let me see. In this also, there's an issue. There's also, I actually felt very bad when they asked this question. Okay, let me come down to the questions. Directly questions, okay, not the case. The exchange ratio acceptable to pool will be what? Exchange ratio is, you have to check this with M&A. M&A chapter, business valuation and M&A, that is the chapter, okay. Will Miss Devina required to take registration GST? Not our question, okay. Lease liability, FR. Dilemma being faced by a partner being case, acknowledgement of communication, retiring auditor, auditing. Portfolio beta, this is AF, okay. Then explain professional misconduct, not about us. Lease, FR. Supplier is required to seek, which is GST. Okay, none of these are relevant to us. Only 3.5 and 3.1 are relevant. 3.1, let us see what is 3.1. What is the exchange ratio acceptable to Messrs. Pool Limited? Now let us come back and see. What is Pool Limited? This is case scenario 1. Okay, they have given case scenario 1. Now let us see what is case scenario 1. TAM Limited is a company engaged in telecom. Presently, it is major presence North India. Very irrelevant all stuff. Company wants to expand in South. Okay, great. Company has got two options. One is to expand by opening own network, which will take time and efforts, and results will not be fast. Other hand, company may target to acquire an existing telecom company having sufficient base in South and to integrate the North India operation with the acquired company. It will yield quick results. Okay, so company is willing to appoint the firm to identify and take process of acquisition forward. After the study, M&A vertical of the firm has identified Mrs. Pool Limited. So TAM Limited wants to acquire Pool Limited in South. Okay, but it is not doing well. The information of both the companies is given below. The total earnings, number of shares, price PE ratio, combined PE ratio is given. When this kind of questions come, the way to solve it is first to input the data. Please input the data before you make anything else. Total earnings, which is PAT in lakhs. How much is it? TAM acquirer. TAM acquirer. Pool target. Okay. PAT is 1200 and 400. PAT in rupees lakhs. Okay. Then outstanding shares. Shares in lakhs. How much is it? 400 and 200. What is the first number that should come to you in your mind when you see both these numbers? EPS in rupees. How much is EPS in rupees? Both are lakhs. So 1200 by 400, which is 3. 400 by 200 is 2. Next question. PE ratio. PE ratio is what? 8 and 7. So PE ratio is 8. Here it is 7. What is the next number that should come to your mind when PE ratio is given? Correct. Market price. What is market price per share? 8 into 3 and 7 into 2. Okay. Market price in rupees. Please write in rupees everywhere. It will be useful for you, useful for evaluator also. Okay. Now, what are they saying? PE ratio of the combined entity is expected to be 10. Combined. Okay. What is combined PAT? Combined PAT is 1200 plus 400. Okay. Then I will also do something called market cap. Market cap in rupees lakhs. Okay. What is market cap? Anyone? Market price into MPS into share count or PAT into PAT into your PE ratio. So here market price into share count. This is market cap of A. This is market cap of B. So combined market, and then they're saying PE ratio will now change to 10. PE ratio, they have said no. PE ratio of the combined entity is expected to be 10. So even though their combined market cap is 9,600 plus 2,800, ideally PE ratio is changing, because of which their combined market cap now post-merger is 16,000. So there is an increase in the value of the firm. Now, this is a poorly drafted question. Why is it a poorly drafted question? We have entered all the details. The exchange ratio acceptable to Pool Limited. MS Pool Limited, which is the target, exchange ratio, what is acceptable to them? How will you decide acceptability of an exchange ratio? Is it based on my EPS will not go down or my overall share in the company will not go down? You have to clarify. In all the questions, if you look at what we have solved in the class, or is it based on steady material, past exam, everywhere, they have very clearly specified that there is no loss on EPS. There is no loss on market share or the share of the market capitalization. They specify. Is it based on price or is it based on EPS? Here they have not made a mention. How are you going to solve? Okay, let us see. That is one mistake, one goof up. In the real world, it is always market price. It is not EPS. EPS, nobody cares. Market price is what people care. In our ICA syllabus, they have said either EPS or market price. In this question, they have not said anything. That is the unfortunate reality. Okay, let us see. 14 by 24, you're right. So, if it is on basis of market price, the ratio is 24 is to. So, if it is on base of market price, the exchange ratio will be, if market price is 24 is to 14, the shares that will be allotted will be ulta. That is, for every one share of pool, you will get 14 is to 24. That is 14 by 24. What is 14 by 24? 0.58. If it is in the EPS ratio, if it is in the EPS ratio, the ratio will be not 3 is to 2, but 2 is to 3. It is ulta. So, whenever you see acquirer and target side by side, and what is the shares that one share of target will get for one share of target, how many shares of acquirer you will get? The ratio is not 3 is to 2, it is 2 by 3. The ratio is not 24 is to 14, it is 14 by 24. This is the logic. So, here it will be 2 by 3. What is 2 by 3? Is 0.667. Now, let us come back and look what is the answer that they have given. 0.42, 0.50, 0.35, 0.65. None of them are matching. 0.65 probably is close to our 0.66. But it is not 0.66. You'll be surprised to see the answer. I was actually surprised. Where did they come? Where did they get this? They gave answer as A. 3.18. A is what? 0.42. How will they get 0.42? From where did they get 0.42? I have no clue. So, this is also an incorrect answer in my opinion. If any of you have figured out how that 0.42 has come, please let me know. But I have not been, I've discussed with Suraj also, we have discussed with a bunch of people, the answer is wrong. So, in this case also, please mark an answer, you will get marks. If the institute has given a wrong answer, suggest an answer, they may have given a wrong answer. But how will you do randomly 1 minus 0.58 here? I also know that 1 minus 0.58 is 0.42. But you cannot do like that randomly. It has to follow a logic. Please elaborate why is it 1 minus 0.58. My share is worth 14. Your share is worth 24. For each share of mine, how many shares will you give? It will be 14 by 24, which is 0.58. That is exactly the question. How would it suddenly become 1 minus 0.58? You got 1 minus 0.58 after I showed you the answer. Did you get it before I showed you the answer? No. So, this question is also incorrect. Okay. So, if at all such kind of incorrect options are given, you please see here. I think in one of the earlier ones, they mentioned no option is correct. I think it is in the previous case study. They mentioned actually, no option is correct, they themselves mentioned. So, if no option is correct, you have to mark some answer, they will give you a mark. I don't know why it is I left. I think I closed that particular question. But in those questions, they mentioned very clearly no answer is given. Okay. So, you check the other case study. We taught 3 case studies, right? Grofine, SAC, and BMY. Please go and check one of these case studies. It is actually there in that. Let me try and open it. Okay, we'll first finish the question and then come back. Why waste time on this? Now, next question. What would be the profit of portfolio beta in case 5? What is case 5? Case scenario 5. Investor has got investment in 3 stocks and is willing to know the beta of his portfolio. The following information in respect of the 3 stocks is given below. Number of shares, market price, and beta. What is the portfolio beta? It is simply the weighted average. How do you compute weighted average? Let us see. SVL, SCL, MLS. Number of shares is 15,000. 8,000, 7,500. Then market price in rupees 60, 35, and 30. So friends, don't get confused. Portfolio weighted average is always based on the value of the portfolio. So you have to necessarily compute the value of the portfolio first. So value of portfolio in rupees, which is 15,000 into 60 is 9 lakhs. 35 into 8,000 is 2.8 lakhs, and 7,500 into 30 is 2.25 lakhs. So the value of the portfolio is 14 lakh 5,000. Okay, value of the portfolio. Then beta. What is beta? 0.9, 1, 1.5. So how do you compute weighted average beta? You simply multiply 9.8 into 9. Correct. Weight into this. So 8, 9. You can compute weights also, or you can do directly like this also. 9 lakh into 0.9, 2.8 lakhs into 1, and 2.25 lakhs into 1.5. So you'll get a total of 14 lakh 27,500. So weighted average beta is equal to sum is equal to 14 lakh 27,500 divided by 14.5 lakhs. So 14.05 lakhs, 1.016. So weighted average beta is 1.016. This is a super simple question. What is the answer here? It is there, 1.016. Yes, answer 1.016. 3.5, the answer is 1.016. Very, very simple. Let us check if it is correct. Yes, thankfully, mercifully, with God's grace, they have given the correct answer. Okay, now I will show you the other question where I was telling grow fine, was it? Somewhere they, no, not grow fine, it was the other one. Grow fine, and November 23. This was the one in which SIMCO, right? SIMCO. See the solutions. One of the solutions, no correct option. This is their institute suggestion answer. Okay. So it will most, this is November 23. And they have given incorrect answer to something else also. Okay. So all this will happen. Don't lose. The first one, that 4.1, I said 4.1 or what was that? 4. This 4.5. 4.5, they gave answer as A. Right. All these kind of things will happen. So don't worry about all of this. Whatever answer you get, even if you think that the answers are incorrect, mark something and come out with it. Okay. So this is what we have discussed today in 3 case studies. But this again will be uploaded on Monday or Tuesday because weekend my team may not be able to upload. They'll be uploaded by Monday or Tuesday. Please wait. I'll upload this Excel sheet, of course. I will definitely upload this Excel sheet. So this ends the session for today. Any of you have any queries, please let me know. I'm here to answer. Okay. Okay, Mohit Bashin. Thank you. Thanks a lot. Okay. I take it that nobody has any other questions. The AFM, if you look at it, very few questions are being asked, at least so far. The questions are also simple. The formula sheet is sufficient. I don't think you need to carry something beyond the formula sheet there to the exam hall. This is my understanding. However, I will give you some, there is this book I have, right? This T380 compiler. If you want to carry this, this is soft copy is available on our website. Please take a print. But it is how many pages is it? It is 259 pages. I don't know whether you want to print a 259 page thing because this contains everything of all the chapters. Now, I cannot summarize it in 100 or 150 pages. It is not possible because I'm actually explaining everything. So this is basic theory, right? Probably you may be able to delete 1 page, 2 page, or probably even 50 pages. But then 250 and 200, not much difference. So if at all you want to carry, my suggestion is carry this book and carry the formula sheet. Okay. Okay. So this is what it is. Let's wind up today's session. Thanks a lot for being attentive participants and asking questions and answering, my queries, answering my questions. So all the very best. Study well, and we'll catch up again later. Ciao. See you guys. Bye.
Now the third one. Which is case study number 3 of your 22 examination. Number 22 examination, case study number 3. Now here again we'll come back. By which date JKL should have recommended the dividend as per listing obligations and disclosure requirements? FEMA question. Do you think Tulip should accept the offer of Mr. Joseph and route the transaction through bank accounts of the company? So that is, we'll have to see what happens. If you look at the option, it talks about money laundering. Then, considering the balance sheet of JK Limited, what is the maximum amount that the management can further borrow as per the provisions of Companies Act? This is related to the borrowings of the company. Which approach can be used by JK Limited to value the division ARP Limited, considering the fact that the segment-wise valuation of ARP will lead to overall higher valuation of the company? This is your AFM related part. And as a tax auditor, which of the cash payments of JK Limited in case study 3 above will be reported by tax auditor in form 3CA, 3CD? That is what we have to discuss. So basically, disclosure happens in 3CD. 3CA is just a certificate. I don't know why do they say disclosure in 3CA. Then you are required to guide Mr. CA Ms. Shweta how she should approach in case of JKL. I will share the case studies in the group. So today, after the class is done, these 4 case studies what we have solved, I will share it in the group. You are required to guide Mr. CA Mrs. Shweta how she should approach in case of JKL when the management has neither provided the investigation report nor any representation in respect of fraud. This is related to fraud. The moment you see fraud, in previous classes we have discussed, one is your 240. You just remember 420, 240. Okay. Then you have to look at reporting to the government, CARE requirement. So those things will be considered. Calculate the enterprise value using entity value as based on the relative valuation method. This is AFM. Explain the concept of reverse merger and advise the management of JKL Limited the benefits, if any, in case of merger of JKL with Machine Industries Limited is done following the suggestion of financial consultants. So, in the light of limited time, in this session, we'll just discuss this concept of reverse merger. Next time when I take up the case study, I'll be covering the balance aspects. Okay. Now, when it comes to reverse merger, what is reverse merger? Normally what happens is, let us say we have A Limited, we have B Limited. A Limited, let us say, is owned by Mr. A has 80% stake of A Limited. Okay. And here, Mr. B has, let us say, 80% stake of B Limited. A Limited acquires B Limited. A Limited acquires B Limited. Who is acquiring? A Limited acquires. A Limited has 10,000 shares. B Limited has 2 lakh shares. A Limited has 10,000 shares. B Limited has 2 lakh shares. As per the terms of arrangement or agreement, what A Limited does is, A Limited will issue, please listen to this carefully. A Limited will issue to Mr. B 2 lakh shares. A Limited will issue 2 lakh shares to B Limited or to Mr. B and other shareholders. So Mr. B will get 1,60,000 shares. Now, actually, who has acquired? A has acquired. Actually, A Limited has acquired. But what has happened is, A Limited originally had 10,000 shares, plus they issued 2 lakh shares. So the total shares is now 2,10,000. B is alone holding 1,60,000 shares. So can I say B is now controlling the combined entity of A and B? So let us say B Limited comes into A Limited. Now B owns 1,60,000 shares. And because B owns 1,60,000 shares, B controls A Limited. Can I say this? Or is there any confusion in this example? Can I say that B controls A Limited after the merger? Yes or no? Can B control A? So I'm repeating the example once again. A Limited has 10,000 shares. It is the smaller company. B Limited has 2 lakh shares, out of which 1,60,000 is owned by Mr. B. So what A Limited does? A Limited says, I will acquire B and I will issue 1,60,000, 2 lakh shares, out of which 1,60,000 is given to B. Now, ultimately, in the combined entity, B has control over 1,60,000 shares and B now controls A Limited. When B controls A Limited, here we say it is a reverse merger. Actually, A should be controlling B. But after the merger, the scenario such happened that B will now control A. B will now control A. And this is called a situation of reverse merger. Now, whenever we have a reverse merger, let me just explain to you the concept. A reverse acquisition occurs when the entity that issues the securities is identified as the acquiree for accounting purpose. So what are we saying? B Limited or Mr. B is the accounting acquirer and A is the accounting acquiree. Legally, A Limited is acquiring, but for the purpose of accounting, who is acquiring? For the purpose of accounting, the acquiree becomes the acquirer. Acquiree becomes the acquirer. Now, why do we do these kind of transactions? See, these kind of transactions are done for some kind of synergic benefit, or if you want to acquire a company which does not have business. Okay, so there will be multiple reasons where such kind of transactions are put into place. So in the next class, we'll discuss. No, it is not about control. So think of it. This is the smaller entity. This is the smaller entity for compliance purpose. For compliance purpose, or if you want to, for example, think of this. A Limited is listed. B Limited is unlisted. B Limited is unlisted. Now, B is a bigger company. B wants to list itself. If B wants to list itself, it is a long process. If B acquires A, then A has to be delisted. So what they say? They will say A will acquire B. A will acquire B. But for the control purpose, B will be controlling. So you get a chance to list in the, in that way. So that is where, reverse acquisition are helpful. Okay. More like a structured transaction. So think of it, a very small company and a very large company. Now, the large company wants to retain the control, but the small company, they want to keep the small company in existence. They want to use the name of the small company, the listing, or sometimes what happens is this small company may be in a foreign country. Now, you cannot go and start a business in the foreign country. So you can enter into this reverse acquisition kind of a transaction where such kind of, structuring is possible. Okay. So that is the concept of, reverse merger. Now, in this particular case, what we were discussing just now, reverse merger, I have explained the, case to you about that in the subsequent class, in the next class when I take it up. And then fraud related aspects also we'll discuss in that class. Tomorrow, you will have taxation aspects of these 3 or 4 case studies that we have. I am sharing the case studies in the group right away so that you can refer to them subsequently. Okay. So we'll conclude it here. And tomorrow, Shiv Teja will be taking taxation related aspects. Okay. Thank you and have a nice day or have a nice evening. Good night, actually. Thank you.
Good evening, students. Should we wait for a minute more for people to join? Good evening. Okay, guys. So we will start off. We should not waste time of people who have joined on time. That is the first principle of punctuality. Just because somebody else has joined late, we should not waste your time. We should treat you with respect. So that is the first thing. So let us start off. I'll just give you a brief on what we're going to do. So I guess last time when Suraj took the class, I think it was day before yesterday, there were 3 or 4 case studies that we did together. The 3 or 4 case studies, what were done was, I think, one was HK & Co, then one was FIL, and the third one was some reverse brain drain or something like that. So we're going to start off on those particular case studies only. And in these case studies, like we did the previous time, what we will do is we will do them from a subject-wise perspective rather than doing the entire case study one shot, wherein 5 faculty are there, 1 person is speaking, 4 people are idle. We would rather look at it more from a subject perspective, which is why today myself, Aslesha and Yogita are here. We are going to cover respective aspects of AFM, corporate law, and economic laws. We're going to cover the same 3 case studies, what we discussed in the previous session with Suraj. And tomorrow you're going to have a session by Shivteja where he'll be discussing about the DT and IDT aspects. So let us start off without further delay. And I'm going to share my screen. Give me a sec. And the first case study that I'm going to discuss, we're going to start off with this HK & Co, which is November 22 question paper. This particular case study is case study number 3 in November 22 paper. This was already disclosed to you, informed to you when Suraj took the previous session on Monday. We are continuing the same case study, but we're going to cover different set of aspects in this particular case study today. Okay, just one second, I'm sharing my screen. Students, and any of you know, at any point of time you have doubts, feel free to ping in, feel free to ask questions and all, because you will not get always a chance to ask questions and probably everywhere else, because most of our classes are online classes, so you may not always get the chance. This is one chance that you should definitely take best use of. And you should not lose out or miss out on asking us any questions, especially with respect to the case and is with respect to the topic that is being discussed, rather than tangential questions. I hope you know what are tangential questions, something that is slightly touching the topic but completely divergent, moving away. So don't ask tangential questions, ask directly related to the subject and the case study at hand. Okay, so I hope my screen is visible. Yeah, so this is the case study of HK & Co, a CA firm. The firm has 20 partners. Just hold on, I'll annotate also. Yeah, so their firm has 20 partners and professional experience. During the month of 22, different engagement teams handed out various assignments, so on and so forth. One of the assignments is yeah. So JK Limited is interested in acquiring a running enterprise, which is one of their clients, and they started a new project. The company has interest in one of the divisions of ARP, which is a listed entity. So please note, ARP is a listed entity. It's a very important point. And ARP is a multidisciplinary company having presence from auto components to textile and so on and so forth. All these businesses are under the same roof. All these businesses are under the same roof, and ARP Limited, the shares of ARP are actively traded. Current market price is 15 rupees per share. This is a very important point. It's a listed company. Market price is 15 per share. Summarized balance sheet is given below. Non-current assets, current assets, trade receivable, cash and cash equivalents, shareholders funds, long-term debt, and current liabilities. Now, I'm not going into the rest of the case. I'm just read the first line. Voice is breaking, is it? Aslesha and Yogita, do you see my voice breaking? Because one of the students, Ramurthy, said that my voice is breaking.
It's fine.
It's fine, right? So there's no issue. So Ramurthy, I guess there is some issue at your end. Please have a look at it. So I'm not going to get into the entire case study. We told you the previous, in almost all our sessions, we've been telling you, just have a look at the case study, directly come to questions. And don't read the questions in depth, just see what topics are they getting covered. So here, first one is listing obligation and disclosure requirements, LODR. So this is economic law and corporate law. Then accept the offer of jury, route the transaction through bank accounts of the company. No transaction will be covered under Office of Money Laundering. So money laundering, again, this is also economic law. Considering the balance sheet, what is the maximum management can borrow? This is Companies Act. Which approach can be used to value division given that segment-wise value will lead to higher valuation of the company? This looks like something like AFM. Then as tax auditor, which of the cash payments made by JKL above? So this is tax. You're required to guide Shweta how she should approach in case when the management is neither provide investigation report nor representation. This is audit. Calculate the EV of ARP using entity value as the base under relative valuation method AFM. Explain the concept of reverse merger and advise the management of the benefits in case of JK Limited. It was done the following. Suggestion of financial consultant is given in the case study. Now, this is probably a mix of AFM and probably even in SM also probably would have discussed this. But anyway, keeping those aside, I am here to discuss about the 3 questions that are relevant from AFM perspective, and then I'll hand over the baton to Yogita and Aslisha. So there are 3 questions on AFM, broadly AFM. One of them is not probably 100% reverse merger is probably not 100% AFM, but I will anyway cover that aspect. So now let us look at the first question. What they said, the first question that they've asked is, what is the first question that they've asked? Yeah, which approach can be used to value division of ARP? So it is valuing of one division. They're not valuing everything, they're valuing one division, considering the fact that segment-wide valuation will lead to overall higher valuation of ARP. So now come back and let us have a look at the case. Now we can actually have a look at the case, which is more relevant. Now we know the context, right? So we've been given the balance sheet. The balance sheet of ARP and JK Limited are given. ARP, these are consolidated numbers. Even though there are segments, only the full number is given for the entire company. So segment-wise information is not available, but they're asking us to find out how will you value the segments. Okay. So the company has interest in one of the divisions. It's a multidisciplinary, auto components, textile, food. So there are 3 divisions at least that they have clarified, but we don't know how to value those 3. We will come to it. Shareholder funds represent 70,000 shares of 10 rupees each. Oh, so here their shareholder funds is 800. 800 amount is in rupees 1,000. 800,000, that is 8 lakhs. Whereas here they are saying it is 70,000 into 10, which is 7 lakhs. So 1 lakh is reserves and 7 lakhs is share capital. Please note this. This is an important one. Rest is, yeah, they themselves have said rest is in retained earnings. Data pertains to entire company, not of a division. Segment-wise valuation will lead to higher valuation of the company. Hardware division will be bought for 60 crores for this acquisition. Funds will be borrowed. Okay. So one division is being purchased for 60 crores. One of the verticals of JKL Limited. Now this is moved from ARP to JKL, right? Is in gold jewelry and ornaments. It has paid up capital of so-and-so. It has indicated 15% growth. Order book is strong. None of this relates to ARP. Because why am I specifying it so much? Repeating it multiple times? Because this particular question, what we've been asked here pertains to ARP and not JK. Okay. The question is, which approach can be used by JK to value division of ARP considering segment-wise valuation will lead to overall higher valuation of the company. Okay, so we are bothered about ARP's valuation, not about JK's valuation. So we can come back to JK related issues, but first we have to answer this. So students, I know some of you may already have access to the suggested answers, but ignoring what is there in the suggested answer or without looking into what is there in the suggested answer, what do you think is the response to this? How do you value companies? What are the kinds of valuations that you do? Anyone, please feel free to type. What are the various types of valuation? You have a cash flow based, relative based, relative valuation. So what are the various kinds and which one do you think is more appropriate here? A one-line answer is sufficient. Anyone? Don't look into the suggested answer. Suggested answer is independent. Because they can come up with a variety of questions. Fair value, okay. Anybody else? Only fair value. No other method. Discounted cash flow. Then okay, fair enough. I'll move forward. So see, there are varieties of valuation. We have net asset value, which is basically very close to book value. Then you have your discounted cash flows. Then you have relative valuation. Right. Now, in this case, we have been given very little data. The data with respect to ARP is very minimal. Only the consolidated data is given. Individual segment-wise value is not given. However, if they take individual segment-wise, they have made a statement here. Please see. Data potential and not of a particular segment-wise valuation will lead to higher valuation of the company. So there is a belief that if you do segment-wise segment-wise value and do a sum of the parts or a chop shop method or anything like that, it will give you a higher value. But is discounted cash flow available? It is. You don't have enough data for that. Then, so what do you do? Right? What is it? What is the specific question? Which approach can be used? Which will, given that segment wise, will lead to overall higher valuation. So one of the answers that is good answer. I'm not going into the suggested answer, but I'm just telling you good answer. One is obviously a net asset value. Second is, you can do a segment-wise value, but you apply a conglomerate discount, because when you have multiple businesses in the same, multiple verticals in the same company, you probably can have a conglomerate discount also. Or you do a valuation, which is, a book value and what I said, the book value or net asset value and cash flow if cash flow details are given. So let us see what is it that they have said. They have said, where is this? Here they've given what are the values? Values in net book value, values in multiples, using chop short, using balance sheet approach. So if you use multiples, very clear that each individual chop shop or multiples, both of them will give you a higher number. Whereas if you look at a net book value, you'll probably arrive at a lower value, but then this may be lower than the true worth of the business. Same way with balance sheet approach also, if you go through, I don't know what they mean by balance sheet approach, but it is basically very similar to the net book value. So the answer that they've given, this question is what? 3.4. 3.4, the answer they've given is C. C is what? Using chop shop method. So they themselves have said that if you value segments using different segment, you may get a higher value method. But then they again are saying that you use a chop shop method. So I'm not 100% in agreement with this, because you should say chop shop method after applying a conglomerate discount. That is a right kind of a answer for this particular question. But net book value and balance sheet, why they are wrong? Because you will be giving a very, very sharp discount, because the book values do not reflect the market values, which is why they both don't work. And multiples cannot be applied because it is a conglomerate. So chop shop can be applied, but only with a conglomerate discount or with a multiple business holding company discount. So I unfortunate that they've asked a question like this, but that is the right answer according to me. Then next question is, we are required to guide how when management is neither. So this is not AFM question. 3.7 is the AFM question. Calculate the enterprise value. So guys, what is enterprise value formula? Any of you can share what is the formula? Anybody feel free to type. So there are no wrong answers. No, this is not an exam. So even if you make a mistake, no problem. Okay, no problem. So I'll tell you what is enterprise value. Enterprise value is what you can see on the screen. Market cap plus debt minus cash and non-core investments. You do these three things, you will get enterprise value. I hope it is visible what I'm sharing on screen. Market cap is basically equity value. The value of the equity shares. Value of the equity share consists of the value that is attributable purely to the equity shareholders. Right? Enterprise means the value that is attributable to the entire business. Okay. Business may have equity and debt. Right? For a moment, assume there is no debt. Then the equity value ideally will actually be equal to your enterprise. Ideally, because there are certain conditions in it, will be equivalent to your enterprise value. But equity plus debt minus, you also have to do cash and non-core investments. Why do you have to do this? Because cash and non-core investments do not are not for operating purposes. When we talk about enterprise value, we are referring to the value of the entire business as a whole from its operating activities. What are non-core investments? Investments in mutual funds, investment in a listed security of some other unrelated business. Okay, surplus cash, last 3 years profit lying as cash. All these money is either in cash or non-core investment. So enterprise value is market cap plus debt minus non-core investments. So coming back, what is enterprise value here? Very, very simple. Enterprise value is market cap. What is market cap? I told you guys to see current market price per share is 15. So you compute 15 rupees into how many shares? Into 70,000. Is there no other way to compute market cap? There are ways to, you can probably do a DCF and all, but is information given? No information is given. So 70,000 into your 15 rupees per share. 70,000 shares into 15 rupees per share. That gives you your market cap. You add the value of debt, which is 200,000, which is 2 lakhs, You subtract the value of cash, which is 500,000. So the working will be 70,000 into 15, which is 10,50,000. Add your long-term debt, which is 2 lakhs, minus cash and cash equivalents, which is 5 lakhs. So 7,50,000. This is the value, right? So this is how you arrive at it. That is the function. That is what I was showing you. EV is 7,50,000. Absolutely right, Deepika. That is what it is. Right. Now, next question, last question on AFM in this particular set of questions is 3.8. Explain the concept of reverse merger and advise the management of JKL the benefits, if any, in case merger of JKL with Machine Industries Limited is done following the suggestion of financial consultants in the case study. Now, this has got nothing to do with ARP. This has got something to do with another company called Machine Industries Limited. So we have to go back and let us check what is it that they're talking about. Okay. Further, management of JKL has decided to buy a sick company called Machine Industries having negative net worth. Please note, very, very important. Financial consultants were hired to give their opinion on the decision, and all of them have recommended JKL to merge itself with Machine Industries rather than merge MIL into JKL. So instead of, if you look at two things, if the big company is JKL, small company is MIL. So instead of small company going into big company, bring the big company into the small company. This is called reverse merger. However, management is not inclined to take this decision and is still undecided on the method of merger. So this is exactly what the question is pertaining to. What is the question pertaining to? Yeah, conglomerate. Somebody was asking conglomerate discount. This is something that I explained in my classes of AFM. When you have multiple businesses in a single company, the company will not. So this is a question asked by Ramamurthy Kalia. I'm sorry, I'm unable to pronounce your name because full surname is not visible. I'll call you Ramamurthy only. So what has happened? He's asking what is conglomerate discount. Conglomerate discount is a discount that is given to a business when given to a share when too many businesses are in the same company, because it does not reflect the value of any one business. So there is a conglomerate discount that is applied. You use a chop shop method, but you again add a discount on a holding company discount or a holding business discount. That is what it is. We've discussed this in the class, in AFM classes. Okay, let me come back to this question on reverse merger. Why do they do reverse merger, guys? Now that they've very, very clearly mentioned the sick company and negative net worth. Anyone, can you please respond? Why do they do reverse merger? Feel free to type something, no? Just one line. Nobody? Reverse merger, backdoor listing, very good. To have accounting acquirer benefits, good. To avoid legal way. What is this legal way? There is nothing called legal way. Everything that we are doing in all our case studies, all of them we have to follow the law. Okay, so backdoor listing is one very good reason. But I think JK is also listed, right? Or JK is not listed. I didn't check that part. JK is, I know ARP is listed. JK Limited is hardware, ARP, after management. Yeah, it is, I don't know. It is not clear. It is not clear. So what happens is, if MIL is a listed entity, then you can actually go and get listed by becoming a part of MIL. Second thing is, if it has negative net worth, you have accumulated losses that can be set off against your profits, right? So a lot of people do reverse merger for that reason only. So let us look at what the answer they've given. I'm pretty sure that is what they will cover. In ordinary case, company takeover, the company taken over, that is the target is a smaller company. In a reverse merger, a smaller company gains control of a larger one. The concept of takeover by reverse bid or a reverse merger is not unusual case of, not the usual case of amalgamation of a sick unit, which is non-viable with a healthy or prosperous case, but it is a case where the entire undertaking of the healthy and prosperous companies to be merged and invested in the sick company, which is non-viable. The company becomes a sick company when there is erosion in net worth. The alternative is known as takeover by reverse bid. Reverse bid leads to following benefits: easy access to capital market. Brilliant. Somebody highlighted listing, increased visibility of company in corporate world. I am not 100% agreeing with that, but that is what the institute answer is. Tax benefits of carry forward losses to the public company. Absolutely right. Cheaper and easier route to become a public company. So you need not go through all all the listing formality, go appoint a banker, merchant banker, if it's applied to SEBI, get listing requirements, all that need not be done. Directly, you can merge yourself with a listed company, and then you can actually be get yourself listed. So these are the three questions that I had. Anyone has any doubts, please let me know before I pass on the baton to Yogita. No, okay. So I am, Yogita, I think over to you. I have handed over the session to you. You and Aslesha, are now all the questions with respect to economic and corporate laws. I think you guys can take it forward.
Okay.
And I'm sorry if I've taken too much time. My bad.
Okay.
You're not
Good evening,
audible. You got to be louder slightly.
Hello. Am I audible?
Yeah.
Okay. Good evening, students. So now we'll be taking up the same case study, but we'll be taking up the questions relating to economic law and company law. So I'll be taking up the company law questions, and Ashlesha ma'am is going to be taking up the economic law questions. All right. So let me just share the screen again. Okay. Is the screen visible? Yes.
Yes, it is visible.
Okay, great. Okay, so we are taking up the same case study, HK and Company. And we have a question from company law here. So we are going to first read up the question. And based on the question, we are going to check the facts from the case study, and accordingly, we are going to solve. So it's 3.3. Considering the balance sheet of JK Limited, what is the maximum amount that the management can further borrow as per the provisions of the Companies Act? Now we have been given 4 options. So see, this question is simply asking what is the maximum amount the management can borrow. So that means we are talking about the power of the board of directors to borrow funds. Okay, so now if you know the Companies Act, this is simply covered in our section number 180. So if you know the facts of section, if you know the provisions of section number 180, this will be very easy to solve. So first, let's try to understand the provision. Then we are going to go into the question. The case study, we'll see the facts, and then we are going to check the options, which one is more appropriate. Okay, so now can you see the Word document in front of you? Is this visible?
Yes, it is.
Okay, awesome. Okay, so we are going to read. See, section number 180 has got simply the powers of the board of directors. It has got a list of powers. We are simply going to refer to one point which says that if the company, the board of directors want to borrow money, then they can borrow the money. But if that amount is more than the total of paid up share capital, free reserves, and security premium, then special resolution is required to be taken in the general meeting. However, if this amount is less than or up to the paid up share capital, free reserves, and security premium, then simply the board of directors, they do have the power. They can simply borrow this much amount. All right, they don't have to take the special resolution. Right, so that is the provision. So basically, to solve this question, we need to see the paid up share capital, free reserves, and security premium. So we'll go into the question. Let's see the facts. See, in the question, here we are talking about JK Limited. Now here what is given is shareholders fund is given, which is 500,000 rupees. So that means 5 lakh. Okay. Then we have got loan which is given, which is 50. Then current liabilities and provision is given 200. All right. So basically, when we say paid up share capital, free reserves, and security premium, that's shareholders fund. So our relevant figure here is 500. All right. Now, when we talk about section 180's provision, this limit of paid up share capital, free reserves, and security premium, this is the total amount of loan, including any existing loans. So here we do have existing loan also. Existing loan is 50. So that means additionally, how much amount can be borrowed by the board of directors? It is 450,000. All right. So accordingly, we'll have to select the answer. I hope this is understandable. So let's see the different options that we have. Considering the balance sheet, what is the maximum amount the management can further borrow? That means other than the amount of loan that it already has. So what are the options? A says 550,000 being consolidated amount of capital invested in the form of shareholders fund and long-term debt. This is wrong. Then we have 1,500,000 being 3 times the shareholders fund. Again, this is wrong. The third option is correct, which is 450,000 being shareholders fund as reduced by the existing debt, as we discussed. Last option is wrong, 250,000 being the shareholders fund as reduced by the total existing debt and current liabilities. So I hope this question is clear and I hope you understand the provision. So now I'm going to hand over this question to Ashlesha ma'am. She's going to take up the other questions relating to economic law. All right.
Thank you, Yogita.
Yeah.
So let's see the same case study and we will look at the questions related to economic laws now. Is my screen visible?
Yes.
Yeah. So the first question which we are going to do here is based on listing obligation and disclosure requirements. So this is a SEBI regulation question. Let's first read the question and then we'll go to the case study and see which para of the case study is relevant for answering this question. So the question is, by which date JKL should have recommended the dividend as per listing obligations and disclosure requirements. So here the question is that by which date should this company JKL have recommended the dividend? So it means that there's some declaration of dividend. Let's go to the question. Let's read the relevant part of the case study and then decide the date. Here. So the relevant part of the case study is this, where it talks about the payment of dividend. So let's read it. One of the verticals of JKL is engaged in export of gold, jewelry and ornaments. JKL has paid up equity share capital of 4 lakh divided into 40,000 equity shares of rupees 10 each. Results for half year ended 30th September 22 has indicated 15% growth in revenue and 20% in profit for the half year ended as compared to the last year. Order book of the company is strong enough to maintain growth for the next 5 years. So they see a growth possibility for the next 5 years. And after looking at the financial result for the half year ended on 30th September 22, the management has decided to recommend interim dividend of rupees 2 per equity share. So here the management has decided that they would recommend a interim dividend of rupees 2 per equity share. And here they have set a record date and the record date is 23rd of October 2022. Now, let's first look at the relevant provision, relevant regulation, and then answer the question. So the relevant regulation here is Regulation 42, listing LODR Regulation 42, which says for payment of interim dividend, the board of director needs to shall recommend or declare all dividend or cash bonuses at least 5 working days before the record date. So here, the important part here is that the dividend has to be recommended at least 5 working days prior to the record date. Now, what is the record date fixed here in the question which we saw? What is the record date which has been fixed? 23rd of October. And the regulation says that the recommendation has to happen at least 5 working days before the record date which has been fixed. And when we count these 5 days, we are going to exclude the date of intimation and the record date. That is, we are not going to include 23rd of October when we are calculating the 5 working days. So according to you, what should be the date by which the recommendation has to be given? Which date? Should it be 5 days prior to 23rd of October and not counting 23rd of October in it? What should be the date? 5 days prior, not after. The record date is 23rd of October. So if you say 18th, you are including the date of intimation as well. And here the provision says that we should not include the date of intimation and the record date. So not including the date of intimation and the record date, the answer comes to 17th of October 22. So the answer here to this particular MCQ is option B, 17th of October 2022. Now here, if you look at the suggested answers say that the correct answer has not been given in the options. The reason for it could probably be, number one, that earlier there was some 30 days requirement. So they are using the 30-day requirement to answer this question. Or number two is they could be counting 18th of October as the date. So here the answer should be 17th of October 2022. Is this clear to everyone? Have you all understood this particular MCQ? If yes, let's move on to the next one. Let's see the next MCQ. Now this MCQ is based on Prevention of Money Laundering Act. So let's see. The question says, do you think Mr. Tulip should accept the offer of Mr. Joseph and route the transaction through bank accounts of the company? Now, what is the offer? In order to know what the offer is, let's first look at the question. Let's go to the relevant part of the question again. So now whenever you have case studies like this to solve, as we've always suggested, and we have been suggesting that first go through the question so that you know which topic is being covered, and on the basis of that learn how to extract the important part of the case study which is relevant for your topic. So to answer the previous MCQ, we just saw the dividend part, and now to answer this particular MCQ which is based on money laundering, we'll take care of this part. We'll have a look at this one. It says, one of the executive directors of the company, Mr. Tulip, is very well connected with persons having political interests and connections. Mr. Joseph from South Africa contacted Mr. Tulip and offered him to engage JKL in one transaction in which company can earn handsome amount in one go. So basically, there's some person, Mr. Joseph from South Africa, who has contacted this person Tulip, and he's saying that we can enter into some transaction and you can earn a very good amount just in one go if you enter into that transaction. The details of the transaction are that the company of Mr. Joseph will transfer rupees 5 crore in the bank of JKL, and JKL will transfer 3.5 crores into small amounts in different accounts to be specified by Mr. Joseph. So what is happening here? There's some amount which is being transferred in the bank account of JKL, and then JKL is going to transfer this 3.5 crore in small amounts and into different accounts which will be specified by Mr. Joseph. Since bank account of JKL is generally receiving foreign payment, no one will doubt this transaction. And then the company will earn 1.5 crore simply by using its bank account. So the total amount which is being received is 5 crore, and out of which 3.5 is being transferred to different accounts in small amount. Now, if you remember or if you have read the Prevention of Money Laundering Act, there are 3 stages of money laundering. First one is placement. Placement is basically the initial stage wherein the laundered money or the illegally obtained funds, they are introduced in the financial system, they are put into the financial system. The second step is layering. Now what happens is layering is there are several small transactions taking place. There are several multiple transfers which are done in order to hide what is the origin of fund. There are several transactions, a chain of transactions is created so that the original source of transaction, original source of money is not known. And the final stage is integration. So integration is wherein the laundered money is brought back into the economy, is brought back into the financial system as untainted one, claiming it to be a legitimate one. So in this particular situation, they are asking us whether Mr. Tulip should accept Mr. Joseph's offer. Now, what do you think? Should Mr. Tulip accept the offer which has been given by Mr. Joseph? What is your opinion on this? What do you think should be done? No. So, Mr. Tulip should not accept the offer because this is a case of money laundering. So, here, let's see the options. So, option A says yes. So, this option is completely ruled out. Moving on to option B. Option B says no, as the transaction will be covered under offense of money laundering, and the leg of transaction amounting to 5 crores will be classified as layering. So here they've asked us that whether the transaction will be layering, placement, or integration. Now here what is happening is an amount is being transferred into the bank account and then further transactions are taking place. So this is the second stage of money laundering, which is called as layering. So the correct answer here is option B, that the transaction is covered under money laundering. So Mr. Tulip should not accept the offer and it will be classified as the layering stage of money laundering. So these were the two questions related to economic laws in this particular case study.
Let me discuss one more short, interesting case study, which the law part and other areas we have discussed. But let me talk about the tax-related content in that particular case study, my dear friends. And this is also one new case study from the multidisciplinary case studies. Clear? Can you see that? Yes. Students are ready. Are you totally ready? Please reply. Come on. Yeah? Good. Now see. Yes, I love the participation, man. This is so amazing. Your participation gives an energy, boss. Yeah, let me start. HK & Co, based in Delhi, is a leading firm of chartered accountants. See, the moment in the question they talk about chartered accountants, you have to realize that they're talking about a CA firm. So they'll definitely talk something related to auditing, something related to professional ethics. That's for sure. Having clients from all verticals of business and service industry. Firm has 20 partners, having professional experience of more than 3 decades. During July 22, different engagement teams handled different assignments. And H. Kumar has been asked to review and guide the engagement teams in the following assignment. First one, assignment with JK Limited. JK Limited is interested in acquiring running enterprise rather than starting a new project. They have interest in one of the divisions of ARP Limited, which is a multi-industry company. All the business are under same roof. Market price is given, current asset, shareholder fund, trade fund. Okay, man. Shareholder fund represents 70,000 shares. This is all related to your financial reporting. One of the verticals is engaged in export of gold jewelry and ornaments. And JKL has paid up capture of so-and-so, growth is so-and-so, order book is strong enough to maintain the growth for next 5 years. After looking at the financial results, management decided to give interim dividend. Okay, very good. Next. One of the executive directors of the company, Tulip, is a very well connected with persons having political interest. Wow. And connections. Joseph from South Africa contacted Tulip and offered him to engage JKL in one transaction in which company can earn some handsome amount at one go. These things will squeeze. The details of transactions are that company of Mr. Joseph will transfer 5 crores in bank account of JKL and JKL will transfer 3.5 crores in small amounts to different accounts specified by Joseph. Money laundering, PMLA. Since bank account of JKL generally receive foreign payment, nobody will doubt the transaction. Like that, people will think. Thus, company will earn 1.5 crores simply using bank account. Not related to tax. Next. Another vertical is engaged in manufacturing and exports of drilling machinery. The company has made following cash payments. Now comes the real story. The moment they say cash payment, your brain should strike the point called section 40 capital A3. To single person, single day. If you are paying more than 10,000 by other than account pay check or account pay draft or online transfer, then such expenditure will be disallowed as per section 40 capital A3. Come on. Cash payment during audit period 21-22 to local transporter for carrying goods. Wow. The moment you read that line, your brain should start thinking one more point. That is, if payment is made to a single person single day exceeding 10,000 by other than account pay check, account pay draft or online transfer, that expenditure will be disallowed. But when payment is made to transporter, the limit is not 10,000, the limit is 35,000. Excellent. Lot of students have replied in the chat box. Very good. That's so awesome. Good. Payment of 6 units of 4,000 each made in cash. 6 into 4, 24,000. Not relevant for us. 2 invoices of 21,000 each made in cash to Mr. Y on 5th July 21 and 6th July 21. Both are 2 different dates. What is relevant is only single person, single day. So that is also not a problem. 40,000 made in cash to Z on 7 July 21 against invoice for expense booked in 2021. Already invoice is booked as expense, but now payment is made in cash. Here there is a problem. Section 48(3)(a), which says already when expense is claimed on accrual and now you are making the payment in cash, it will be disallowed. And it is more than 35,000, single person, single day. Next. Further, management of JKL has decided to buy a SIC company, MIL, having negative net worth. Reverse. Financial consultants were hired to give opinion on decision, and all of them recommended JKL to merge itself with MIL. That's called reverse merger. However, management is not inclined to take this step. That's all merger story. Another vertical is engaged in agriculture operation. Your audit manager is doing a statutory audit. She overheard that there is some mishappening in the company. Audit. There is suspicion of some fraud. She has requested management to provide details of investigation, but the response has been evasive. She requested the management to provide representation of management in respect of fraud. That's all related to auditing. First point, LODR, that's your listing obligation and disclosure requirement, not related to tax. Second point is your money laundering, that I will not talk. The third point, Companies Act, that also I will not discuss. Which approach can be used by JK to value, that is your valuation, that also I will not discuss. As a tax auditor, I will talk. Tax guy will talk. Which of the cash payments made by JKL in case study 3 above will be reported by the tax auditor in form 3CA and 3CD? Tax audit report. We discussed that first payment there is no problem. Second payment there is no problem because both are 2 different dates. The whole problem is with the third payment only because payment of 40,000 amount is directly made in cash to a single person single day. So what is to be reported in tax audit is only the third point. 1, 2, 3, 1 and 3, 2 and 3. Answer is option D, my dear friends. Only the third point. Because there only is the problem. The other cases, there is no problem at all. Next. Descriptive, you are required to guide CA Sweta. How should she approach? Where represents suspected fraud, that is related to fraud case. Calculate enterprise value, financial reporting. Explain the concept of reverse merger. What is that word? Reverse merger. And advise the management of JKL in case of reverse merger. They'll get the benefit of that losses and all those things. This is also not related to your tax. So if you observe carefully, first question, first bit, second bit, third bit, all the 3 bits of descriptive question is nowhere related to the tax. See, sometimes it does so happen like this where in some case studies where only few questions may come in from tax. And I've also seen some case studies which I'll talk with you very soon where there will be huge questions on tax. That is also possible. And I've seen one case study where the direct tax was questioned, indirect tax was questioned. 60 to 70% part of the case study was related to direct tax and indirect tax only. No doubt about it. So you cannot gauge telling that this much only will come from tax. Anything is possible. Good. Student is asking, I have one doubt. Yes, my dear friend, please type your doubt. I'll be more than happy to reply to your query. Yeah, student is asking, so can you explain why second one is not disallowed? Okay, I'll share the screen once again. My dear friend, if you see carefully, we are talking about payment to transporter. If it is other than transporter, the limit is 10,000. But transporter, what is the limit? 35,000, correct? And payment of 2 invoices of 21,000 each. 2 invoices of 21,000 each. It is made on 5th July, one payment is made. 6th July, one payment is made. It is not on same day. If it is same day 42,000, then there is a problem, right? If it is on different dates, why there is a problem? Because 40 capital A3 talks about single person, single day. I'm sure you understood that point now. Wonderful. Thank you so very much. So friends, that is the story of this interesting case studies. And the last case study, what we just discussed, did not have much points on taxation. That's the reason why the time was not much involved in the last case study. But let me tell you, there are a lot of case studies which are going to talk where there is huge content of tax also, my dear friends. No doubt about it. Clear? So if student has got any more further query, you can feel free to ask. I'll be more than happy to reply to your query. And if there is no other query, no other question, we can conclude session here, and I'll see you very soon with lot more interesting case studies very soon, my dear friends. Clear, sir? Please reply. Everybody is clear. Good. Student is asking, sir, please share Excel. I'll share the Excel. I'll share in the same group what we have been discussing. Don't worry. Okay? Done. I'll sign off for the day then. Thank you so much, guys. Take care. We'll sign off. Student is asking when we'll share all the PDF sets. You are talking about the case study PDF, or you're talking about the answer PDFs combined and shared? That you're talking about, my dear friend. Are you talking about the answers or the questions? Question case study. Okay, don't worry. That they'll share. That I think already they shared in the group, right? Just check once. That should have been in the group. Yeah, if not shared, they'll send it across. Don't worry. Done, my dear friends. Thank you so much. Signing off, Shivateja. Thank you. See you all very soon with more interesting case study, my dear students. Take care. All the best. Bye-bye. Hello, my dear friends. Very good evening. I believe that I'm visible and audible to all of you. Please confirm. Hello. Yes, perfect. Thank you very much. Come on. So friends, now, today, we are going to discuss 3-4 interesting case studies where we are going to talk about some very, very important point related to direct tax and indirect taxes. So without any delay, let me start some interesting case study, my dear friends. We are going to talk about case study number 11 first. Is the screen visible, my dear friends? Yes, thank you very much. Come on, friends, please see that. Apara and Sampad had completed their articleship training from a reputed CA firm in Chennai. Both were good in studies, and after qualifying, they decided to become partners in profession and partners in life. Wow, wonderful. So they completed training from a reputed firm in Chennai, and they were good in studies, and after qualifying, they decided to become partners in profession and partners in life. And Sampad was proficient in interpretation of laws and direct taxes, while Apara was good in indirect taxes, auditing, and chartered accountants. They started their firm at Kochi in the name of Apara, Sampad and Co. Chartered Accountants. Then, what is that they have done, my dear friends? Currently, they have a well-established practice spread across various spheres, including FEMA, corporate law, international taxation, valuation, etc. Apara and Sampad had in the past done few engagements for Greenlee Limited. And Ramnik, the Vice President Finance of Greenlee Limited, invited Apara and Sampad for a meeting along with the finance team, internal auditors, and tax consultants of the company. As Greenlee Limited was a coveted client of the firm, Apara and Sampad both have attended the meeting. Very good. And during the meeting, they discussed the following points. Greenlee is one of the leading laundry in Delhi. And for cleaning the suits, they charge so and so amount. They charge overheads, variable overheads, fixed overheads. So that's all related to your costing related element, not related to a taxation as such. Let me proceed further, not to waste time. Yeah. Second bit. Greenlee is having 3 years average profit of 10 crores. And during the financial 23-24, it is required to spend on account of corporate social responsibility. That's again related to your law, my dear friends. So let me look at the third point here. Company purchased a land in the city outskirts on 1st August 2018 for a consideration of 1.2 crores to construct a factory, for which the stamp duty valuation on that date was 1.75 crore. When the stamp valuation is 1.75 crore and he purchased for 1.25 crores, definitely the point is very clear. For the difference, 50 lakhs, he would have paid tax when he has purchased the property, my dear friends. He would have paid tax when he would have purchased the property, because that will be taxable under income tax law under the taxability of gift, my dear friends. 56-10. Next. Later, management decided to sell that land to fund the business diversification objective. And on 1st August 2023, the land on city outskirts was sold for 5 crores. Very good. It is sold for a value of 5 crores. And the stamp duty valuation was 5.40 crores. Now, let me make you recall, my dear friends, as per provisions of section 50C, which talks about stamp duty value in case of land and building. 50C clearly says if selling price is less than, I repeat once again, if selling price is less than stamp duty value, then stamp duty value is deemed to be consideration, provided the difference is more than 10%. But if you observe carefully, very clearly here, the actual consideration is 5 crore and the stamp duty value is 5.4 crores. The difference is 40 lakh. So the difference is not more than 10%. When difference is not more than 10%, sale consideration what we'll take is 5 crores only, but we are not going to take 5.4 crores. Next, they have given cost inflation index, that is CIA number, for 18-19 and 23-24 is 280 and 348 respectively. Very good. So basically, this data is relevant for the purpose of computation of capital gains. If they ask, we'll see. Next. ABC Limited resigned due to personal reason. So related to auditing. After the meeting was completed, Ramnik met Sampad and had a casual discussion with him. He told that his daughter Sweetie was pursuing post-graduation from Stanford University, USA, for which he had remitted $50,000, which is nothing but 40 lakhs for her maintenance abroad under liberalized remittance scheme. I hope you guys know very clearly that under liberalized remittance scheme, we can send up to $250,000 outside India without any approval. You would have learned that in the concept of FEMA, my dear friends. Now see. Thankfully, he did not do any other remittance during the year. Nice. While Sampath was busy in a discussion with Ramnik, CA Money, internal writer of Greenlee, and a close friend approached for a quick chat. Money informed Apara that practice was going good and he was appointed as title writer. Later, he has been busy finalizing the audit letter communicating related to auditing. More of points related to auditing and law. Next. Come on, guys. Let's look at the multiple choice questions. For the remittance of 40 lakhs by Ramnik, authorized dealer is what? Very, very interesting question, my dear friends. So let me tell you very clearly here. That is, there is one section called 206C 1G. TCS will apply in case of foreign remittances. TCS will apply in case of what, my dear friends? Foreign remittances. And moreover, my dear friends, in case of remittance outside India for the purpose of education or medical treatment, there is no TCS. There is no TCS if the amount is up to 7 lakhs. And next point, my dear friends, if the amount exceeds 7 lakhs, the amount exceeds what, my dear friends? 7 lakhs. Then the rate of TCS is 5% on the amount exceeding 7 lakhs, my dear friends. That's a very, very interesting point. What you should make note of, my dear friends. Got the point, everybody? Come on. What is the first option? Not required to make any TCS. Second, required to make TCS of 1.65. Third, TCS of 2 lakhs. Fourth, TCS of 0.165 lakh. Come on, tell me, my dear friends. What will be the answer? Come on, friends, what will be the answer? I already told you the working that on amount exceeding 7 lakh rupees, we'll charge TCS at the rate of 5%. So TCS at the rate of 5% will be 40 lakh minus 7 lakh into 5%, which comes to 1,65,000, my dear friends. So when it is 1,65,000, the answer will be, my dear friends, option. What was that option? Let me open that screen. The answer will be option B, my dear friends. Required to make collection of tax at source at 1.65 lakh. Student might get one doubt. Sir, I heard that it is not 5%, it is 0.5%. Let me tell you, if the remittance is for the purpose of education and that remittance is out of loan taken, then the rate of TCS will be 0.5% on the amount exceeding 7 lakhs, my dear friends. But in this case, remittance is not out of education loan. When it is not out of education loan, my dear friends, it is not 0.5%. It will straight away be 5%. Very, very interesting point. Are we clear, my dear friends? Can I proceed happily? Please reply. Student is telling loan is from financial institution only. Yes. Educational loan and then remitted outside India, it is 0.5%. Good. Financial institution basically means whatever is covered in section 80E, my dear friends. 80E talks about deduction for interest on loan taken for the purpose of higher education. That is covered there. Good. Are we clear, my dear friends? Can we proceed? Please reply. I'm waiting for a reply. Good. Thank you very much. Second question. Capital gain on arising on sale of land at city outskirts by the company will be how much? Let's calculate it. Come on, friends. The property is sold on which date? Come on, friends. Property is sold on which date? Property is sold on 1st August 2023. Property is sold on 1st August 2023. And it is purchased on 1st August 2018. And obviously it is long term, correct, my dear friends? And what is the actual purchase cost, my dear friends? The actual purchase cost is 1.25 crores. But the SDV on the date of purchase is very clearly 1.75 crores. Then what will happen is the difference of 50 lakhs would have been taxable. At the time of purchase as per section 56(2)(10). Because logic is very simple, my dear friends. As per section 56(2)(10), which talks about taxability of gifts, which says that immovable property received without adequate consideration is taxable if difference is more than 50,000 and difference is more than 10% of consideration. And in this case, that will definitely be taxable. Now, very interesting point is that on subsequent sale of such land, cost of acquisition would be 1.75 crores. On subsequent sale of the land, what will be the cost of acquisition, my dear friends? Cost of acquisition will be 1.75 crores. Did you get? How did we understand? How did we get that 1.75 crores, my dear friends? Everyone? Good. So what will be the full value of consideration, my dear friends? What is the sale price actually? What is the sale price, my dear friends? We sold it for 5 crores. Stamp Valuation Authority fixed at 5.4 crores. Sold for 5 crores. But STV is 5.4 crores. Then, my dear friends, as per section 50C, 5 crore is considered since difference is not more than 10%. Since difference is what, my dear friends? Not more than 10% of consideration. Since difference is not more than what, my dear friends? 10% of consideration. Friends, getting clarity, everybody? Speak out. Student is asking overwriting. What is overwriting, my dear friend? I didn't get your point. Yeah. So full value of consideration will be, my dear friends, 5 crore or 5 crore 40 lakhs. What will be the figure, my dear friends? The figure what I'll take is definitely 5 crores. less indexed cost of acquisition. So without me making write all these points, how will you understand, my dear friends? That's why I'm writing all these points. Index cost of acquisition will be 1,75 lakhs into 348. 1,75 lakhs into what, my dear friends? 348 divided by, what is the index cost of acquisition? 280. Divided by 280. Then the long-term capital gain will be 2,82,50,000. 2,82,50,000. That becomes my long-term capital gains. So my answer will be option B, my dear friends. 2,82,50,000. That becomes my long-term capital gain. Some student is telling 1.35. What is that 1.35, my dear friends? I don't know from where you got 1.35, sir. That's it. That's the story of this second interesting point, my dear friend. Third point, drafting audit letter committee. That's related to auditing. Fourth question, which of the statement is correct regarding compliance to be made by Greenly Limited? That is related to your law. Fifth one, during conclusion of auditing, again related to audit. Descriptive question. Number one, Apara wants to draw the attention of the readers. Emphasis of matter. That's related to auditing. Sampad discussed with Apara and thought it would be handy and easy to explain the clients the details of LRS if they have standard document. Draft a note on various aspects of LRS. So if that is the case, you should talk about FEMA. You should talk only about FEMA. That's not related to taxation as such. Somebody is telling Institute updated the case law. Previously it was 1.35. I don't know why 1.35 was there. That is not correct. Whatever working I have done now, that is the correct answer. Yeah. Done. Maybe there was a clerical mistake in the institute material. Not sure why there was a mistake. Yeah. One. Eighth question. Ramnik request to compute incremental cost, which will be taken as a base. Indicate the aspects to be considered for making the lowest to quote. So that is related, not related to your taxation. It's related to your, what you call pricing strategies and other things. That's it. That's all, my dear friends. That's the end of story of this very, very interesting case study, my dear friends. Case study number 11. I'm sure we got good clarity on these points, everyone. A very short and sweet case study, actually. Good.
Hello, everyone. How are you all? How is your preparation going? Scared about IBS? Okay. See, IBS is all about practice. As much as you practice, no, whenever you get free time, just sit with some cases and just do them yourself. Because provisions, any which ways you have studied, provisions are all covered in first group and second group. Okay, so one person is saying that they have read first, like group 1, 2 years back. See, you'll have to revise. Although I know there's no time to revise, you can probably refer some really crisp notes, or you can like refer to some marathon lecture. But revision, so you have to do. You can't just directly go in the exam with the book and expect that you will be able to locate the answers, and you have to at least once go through the whole material so that you know which provisions are there. Doing questions alone is enough. See, questions is practice. That will help you to speed up your reading process and your shortlisting process, like how you shortlist the answers, right? So that is just practice. But based on what are you practicing? So you need to have at least some conceptual clarity. If you have conceptual clarity, then practicing questions is more than enough. If let's say you don't have conceptual clarity for the subject at all, then there's a problem. Okay, so that you need to fix. How? Just go through some short material. Okay. Otherwise, one simple tip is that, uh, study some subjects nicely. See, if you analyze IBS, all the cases that we are studying, whatever we have analyzed, we understand that, GST and direct tax is covering good 30 to 40% portion. Then company law and economic law is covering another 18 to 20%. Okay. So that means if you do just these subjects also, 60% will be covered. So then, what you can do is prioritize these topics. And also the case studies that we are solving, cover them at least. Because again, there are many questions today that we will be solving. You will notice that they are repetitive. We have already solved these questions. For example, like women director, it's again and again being asked. Okay. So another short hack is, if you don't have time to study the full subjects and all, just look at the past exam questions. Just look at important topics. Because mostly those important topics are only being asked again. Okay. Okay, so now let's start with the session for today. So today we are doing company law, and we'll be taking up mostly MCQs today. So it's going to be a fun session. I'll be explaining you the provision, and it will be your job to give me the answer. Okay. And yeah, so we'll try to cover, I think, 7 to 8 cases today. Okay. So we'll be taking 5 cases from the study material. We have already covered for company law. Study material, case study 1 to 10 we have covered. So today we'll be taking case study 11 to 15. And additionally, we will be taking the case study digest for November 23. And we'll be covering some questions from there. All right. So let's start off. Okay. Are you ready? Tell me. Chat there. Yes or no? Are you ready? Let's start. Yes or no? Yes or no? Till then, I'm going to set up my screen. Okay. So is my screen visible? Is my screen visible? Yes, thank you. Okay. So we'll start. So first we are going to be taking up, one second now. So first we are going to be taking up the case study number 11. We are taking study material case study first. Okay. So in this case study, we have got only one MCQ, which is relating to your corporate and other laws. No, only corporate law. Okay, so let's read this case study and let's see if we can figure it out. We are going to first be reading the question. And based on the question, if we need the facts, we are going to go into the case study. Otherwise, we are directly going to be solving the question based on our general knowledge. Because most of the questions, you can just solve by looking at the question, I have noticed. Okay. Okay, so which of the following statement is likely to be correct regarding compliances to be made by Greenlee Limited? Okay, we don't know. So see here, the options are covering some CSR forms. So this question is asking us, which of the following compliances are required? Now, we don't know what is CSR related details of this question of Greenlee Limited. So we are going to go into the question and just look at the CSR provisions. Okay, so this is a small case study. In the last paragraph, we have some details relating to CSR. What is CSR? What is the full form of CSR? What is the full form of CSR? Corporate Social Responsibility. Okay, so Greenlee Limited having 3 years average profits of 10 crores. During the financial year 23-24, it is required to spend on account of corporate social responsibility. It has incurred this expenditure through the NGO named Green Foundation. Now, see this, even though it's simple, it's just 3 simple lines given, but we have to read it carefully. Okay, so see, this company has average net profit of 10 crores. Okay. Now here, it is required to spend on account of CSR. That means this company already knows that it is required to spend the amount as per CSR. We don't have to do the calculation whether this company has to spend or not. Next thing is, the company has already incurred the expenditure through an NGO. Okay, so the company has already incurred the expenditure. That means this company has already probably registered itself under CSR also. Okay, so these are the facts which are given. Now, based on that, what is the required compliance now? Okay. The question asks, what are the basic compliances required? Now, in the notes that we will be providing, we will be also having the forms given to you. The list of the forms will be given to you. So here, as you can read the options have got either CSR 1 form or CSR 2 form in all the options. So you can simply go and check what is CSR 1 for and what is CSR 2 for. All right. So now, relating to these options, let's look at the provision first. Okay. So see, as per the company's accounts rules, CSR 1 form is required if the company wants to register for CSR activities. That means it's the first time that they are doing CSR activities and they want to register themselves for these activities. Okay, this is registration form. Second form is the annual reporting form, CSR 2. In this, every year with AOC 4 form, the company is going to list out the details of the CSR which the company has done. Right. Now, please note that CSR 2 form is to be attached with form AOC 4. All right. Now, please tell me, in this given case, which form is going to be applicable, CSR 1 or CSR 2? I want you all to answer. Is the company going to register the CSR or is the company going to report the CSR? Okay. Sikandar is saying 2. Anybody else? CSR 1 is required or CSR 2 is required? Report. Correct. CSR 2 is required. CSR 2 is the report. Okay, so you're right. Now, CSR 2 also, so there are two options relating to CSR 2. Option B says it is required to file CSR 2 independent form with at the MCA portal. And option D is CSR 2 as an addendum to AOC 4 at the MCA portal. Now, in your this material, the answer is given as B. But B is not correct. The CSR 2 has to be filed with AOC 4 form. All right, so your correct option here is D. Right? Okay. So that is your first MCQ. I hope you have understood this.
Good evening, everyone. So today we'll have the session on economic laws and we'll cover up case studies 11 to 15 from your study material and also few case studies from the case study digest. So let's start with the case study 11 of your study material. Okay, so let's start. So there's one question on in case study 11 and this question is for FEMA. So as the usual practice, we'll first have a look at the question and then we'll go to the case study, read the relevant part and come back and answer the question. Yeah. So the question based on FEMA here is question number 7, which says that Sampad discussed with Apara and thought that it would be handy and easy to explain clients the details of liberalized remittance scheme if they have standard document. Draft a note covering various aspects of liberalized remittance scheme. Now here, if we look at the question, this is a very straightforward question, though it is based on the case study, but this question is a straight question wherein they are asking you to draft a note which covers all the aspects related to a liberalized remittance scheme. So they want to keep a document handy for all of their clients wherein they have a standard document and they can explain their clients with the help of a document that, okay, fine, these are the points which are covered under the liberalized remittance scheme. So can someone tell me what are a few points which would be covered under this standard document which would be made for the clients, wherein you have to explain them what liberalized remittance scheme is? So what points would you add into a document like this? Anyone? No? So the relevant part here is only this much, wherein they say after the meeting was completed, Ramnik met Sampad and had a casual discussion with him. He told that his daughter Sweetie was pursuing post-graduation from Stanford University, USA, for which he is remitted USD 50,000, that is 40 lakh, for her maintenance abroad under the liberalized remittance scheme. Thankfully, he did not have to do any other remittance during the year. So basically, the question which have been asked to you is a direct question wherein they are asking you only to draft a note for covering different aspects of liberalized remittance scheme. However, they could have also asked another question stating that is this type of remittance allowed, and what is the limit to the remittance which has been made by Mr. Ramanik? What is the maximum amount of remittance which can be made by Mr. Ramanik during the financial year? So based on the same topic, there could be multiple questions which can be asked. So let's first have a look at the answer. Let's first see how would you answer this particular question. So since they've asked us what are the various aspects of liberalized remittance scheme, so it is a part of PEMA, which lays down guidelines for the outward remittances which are made from India. So what are the things we'll include under the aspects to be covered? First of all, it is a scheme which is applicable to all the resident individuals, and it is also applicable to minors. Then we'll also have to cover about the maximum limit. So the free limit is up to USD 250,000 per financial year. So the remittance which can be made in the financial year is up to 250,000. Now, in the case study, we've seen that the amount which has already been remitted is USD 50,000. Now, you tell me how much amount can be freely remitted further under the liberalized remittance scheme. 50,000 is already remitted. What is the remaining amount which can be freely remitted by this person under the liberalized remittance scheme? How is that? 2 lakh dollar, 2 lakh USD, because 50,000 has been remitted by him. So under liberalized remittance scheme, 2 lakh USD still pending. But yes, if there are another points in the case study wherein there are another remittances which have been made by him, we'll have to consider those also when you are answering it. Okay. And in this case study, there's no other remittance. So here the amount which can be freely remitted by him furthermore is 2 lakh dollars. Okay. So a question can be asked based on this as well. The next point which can be which you'll write here is it can be for both permissible current or capital account transaction, or a combination of a current account and a capital account transaction. And in case a remitter is a minor, then this declaration has to be signed by the minor's guardian as well. And this scheme, that is the LRS, is not available to corporates, partnership firms, HUFs, or trust. It is only available to whom? It is available to resident individuals. And also remittance can be consolidated in respect of family members, subject to individual family members complying with the terms and conditions. So this question which was asked here, question number 7, it was a direct question. Even if you did not even if we did not go through the case study, this was a question which could have been directly answered by you. Is this clear? Have you understood this? Please answer whenever a question is being asked. Yes?
Now, moving on to the next case. Case study number 14. Now, BASP and Company Chartered Accountants are a firm of chartered accountant having offices on major towns of South India. They provide consultancy and all of that. Okay. Following points have been explained. First, company is expanding its business and establishing a new unit with a budget of 250 lakhs. This budget has been given. There is something related to CGST, GST, then they have given advance and all of that. This most likely relates to your GST component. During the financial year 23-24, in one of the board meetings, management sought an approval from the board for investing in equity shares of other companies as per the Companies Act. So there is one more aspect. Okay. Then, in addition to manufacture and supply of ACs, the company also does installation for the same. and they have received advance and so on. The company charged GST at 18%. So this is related to GST part, your composite supply and related aspect. Company entered into agreement with Humlog Enterprises, not registered as GST. That is also again for GST. Company's operations were going on smoothly and they were on a growth trajectory. The company has turnover of 100 crores and loan outstanding 75 crores deposit. So something to do with law. Audit discussions. Jay asked Tan and Kan if they could help his friend Merun, partner Mahim and Company, chartered accountants. Jay and Merun were close friends and they often used to have professional and academic discussion. So they are, there's something with their discussion. So we will see what is to be done there. So by this time you have scanned through the case, and this practice you have to build as you solve case studies. Scan through them, then come to the question. Is ABC Private Limited required to appoint an internal auditor as per the Companies Act? So provisions related to internal audit. That company will treat on the loss on sale of shares as, how will they treat it? Loss so much and 10,000 will be claimed as loss. Gain of so much, company cannot claim the loss. So this is more to do with your, I think, income tax provisions. In background of the facts given above, input tax credit, how much will be there? Correct position of law in the given case study with respect to payments. As regard to discussion of Tan and Kan, Merun arranged by J, which of the following is most appropriate description of engagement quality control reviewer in accordance with the professional standards? So this is to do with quality control related aspects. We will discuss that. Coming to descriptive questions, GST law, Foreign Contribution Regulations Act. Can the financial statements and audit reports signed by Merun be reviewed by some other chartered accountant for quality control? Which issues should be addressed by Merun for appointment of such concern? This is to do with review. And what should be the likely control of quality control review policy and procedures if Merun firm is required to establish such policy, right? So how should the quality control be done? So basically question number 5 and question number 8, if you see, that has to do with audit. Now tell me one thing, which standards or which pronouncements deal with quality control related aspects? When we talk about quality control, what comes to your mind? Which standard comes to your mind? SQC 1 comes to your mind, right? So let me just share that with you, SQC 1. Now, SQC 1, just give me a moment. SQC 1 and which standard? Yes, SA 220. Both of them you have to read in conjunction. Okay, one is SQC 1, standard on quality control. You refer to SQC 1 and other standards also. And then you have SA 220 that deals with your quality and quality control when you're carrying out the audit. Okay. Now, when it comes to SQC 1, let me just share the thing. I don't know if the computer is troubling a lot. Just a moment, guys. So I'm not able to move it to my iPad, so I'm directly sharing on the screen itself. Okay. Then once we discuss it, again, we'll go back. So now, the standard on quality control, as I told you, we have two standards. One is SA 220 and the other one is SQC 1 that deals with quality control for firms that perform audit and review of historical financial information and other assurance and related service engagements. So as far as SQC 1 is concerned, it is not only applicable for normal audits. Whenever we are carrying out other services, if for example, wherever SRS is applicable, or you have other related service engagement, you do some compilation services, whatever you do, you will follow SQC 1, right? Now, SQC 1 is generally, when we look at it, it talks about what should the firm do to ensure that there is a quality control, or there are policies in the firm where we ensure that the audits are carried out with the quality. And how do we decide the quality, what are the aspects to be taken care, what kind of staff should we hire, how should we review the the assignments that has been completed, how do we accept clients, right? So all of that we consider. So this includes leadership responsibilities. What should the partner or the head of the firm, what should they do to ensure that there is quality control in the firm? Then ethical requirements. How do we comply with ethical requirements? Where we have this code of ethics which talks about integrity, objectivity, professional competence, confidentiality, and professional behavior. How is this complied with? Then how do we accept and continue? So this is very important, where whether the firm should continue the quality engagement with a particular client. If there are risks associated, then they may consider withdrawing from the engagement as well. Correct? Then integrity of the client. If for example, there is a problem with the client, there is a fraud related to the client, the management is not cooperative. So that part we'll consider. Then how do we ensure that we have proper human resource, right? How do we hire? How do we recruit? How do we train? How do we evaluate their performance? How do we take care of the articles and all of those things? That part is considered. Then when we talk about specific aspects related to performance of engagement, engagement means each audit assignment. So how is each audit assignment carried out with respect to how does the team carry out the work? How do we ensure that the standards are complied with? Then how do we review the performance of the work? So all of those related aspects. Then consultation. Whenever there is difficulty, so we should take consultation either within the firm or outside the firm. For example, if I have some issue as a practicing chartered accountant, then how should I handle that issue? If, for example, I got a doubt, can I go and ask someone in my firm? Yes, I can ask. Can I go and ask someone outside the firm? Definitely, I can ask. So that also we can do. Okay, so we need to do consultation and related aspects. Now, coming back to the question is asking us, as regards discussion of Tan and Kan with Merun arranged by J. So now what has happened? Let us go back to the case. Jay asked Tan and Kan if they could help his friend Merun. So Jay is asking Tan and Kan if they could help his friend Merun, partner management company CA. Jay and Merun were close friends and they often used to have professional and academic discussion. So Jay and Merun, they are friends. Tan and Kan gladly agreed to provide clarification to Merun if they had any technical query. Jay set up a Zoom call between Merun and them. During the call, Merun said he would be more comfortable and confident if some other chartered accountant reviews the financial statements and audit report he is signing for the purpose of quality control. Now, first is they are taking consultation. Second, what they're saying is Merun will be more comfortable if some other chartered accountant reviews the financial statements and audit reports he is signing for the purpose of quality control. So there are two aspects. Now, what is the first question asking us? As regards to discussion of Tan and Kan with Merun arranged by J, which of the following is most appropriate description of engagement quality control reviewer? So this is specific to an engagement. It is not about consultation. It is about engagement quality control review. Now, what is the meaning of engagement quality control review? Whenever we are carrying out a particular engagement, whenever certain judgments are being made, it should be reviewed by engagement quality control reviewer for taking an objective view before the report is issued. So you need to have someone who is reviewing the engagement part, right? So there has to be someone who is the engagement quality control reviewer. Now tell me one thing, can this engagement quality control reviewer be an outsider or he has to compulsorily, this engagement quality control reviewer, should he be outsider or he can be an insider as well? Do you think we can have an external party? And second question is, if I am taking the help of so basically what will this engagement quality control reviewer do? The engagement quality control reviewer, what he will do is, he will review the financial statements, he will review the work, and he will give his, if there are some corrections to be made, if there are some suggestions to be made, all of that will be done. Now, first question is, can he be an outsider, he or she? Second question is, if the engagement quality control reviewer says that everything is fine, go ahead and issue the report. Can the signing partner say that because the engagement quality control reviewer said certain things, that is why I have signed the report and hence I am not responsible? So first question, all of you answer. Can this be an outsider or can this be an insider as well? Or can it be an outsider or it mandatorily has to be an insider? Yes? Or not yet gone through SQC 1? Can he be an outsider or he can be an insider as well? The engagement quality. So basically, someone who is reviewing the engagement being carried out, can he be a outsider or he can be an insider as well? Can he be an outsider or he has to mandatorily be an insider? Both, right? So it is not necessary that it has to be an insider. Whoever is doing this engagement quality control review part, he can be an outsider and he can be an insider as well. Now, when we look at outsider, he has to be someone who can be a partner, who can be an engagement partner. Accordingly, we have to decide. So now here, first, what is the most appropriate description of engagement quality control reviewer? First one, he can be a partner or other person in the firm, but he has to be a member of ICI, or partner or employee of another firm, member of ICI with appropriate experience. So as we said, he can be both. The one who reviews the engagement can be both. So the first option looks appropriate in this particular scenario. Second, he can be a partner of the firm, partner of another firm with appropriate experience. Yes, but he can be another chartered accountant also. Okay. So it is not necessary that he has to be a partner only. Third. So this is not wrong. So in examination, you have to be careful while choosing, because here we are saying he can be a partner or other person. Here that other person is missing. So this is not right. He can be a partner or employee of another firm with appropriate experience. He can be. This is right. But A is more wholesome. That is why we are choosing A. So this is a thing where you have to look at. All four are appropriate, but most appropriate is option number A. Okay. Then coming to question number 8, part 1. Can the financial statements and an audit report signed by Mehroon be reviewed by some other chartered accountant for quality control? Which issue should be addressed by Mehroon for appropriate appointment of such person? So now here again the question is, can it be reviewed? Can this person, whatever is the discussion going on, can the financial statement be reviewed by other? Yes. Financial statements or the audit report, whatever we are looking at this, as per SQC 1, you can get it reviewed by another person, another chartered accountant with an appropriate experience that is there. Okay. Now, what are the things to be kept in mind, or what are the issues to be kept in mind whenever we look at, review by an external person, or whenever you are engaging an external reviewer? Now here, you have to look at the qualifications. Of course, he has to be a chartered accountant, and the experience. So you have to look at qualification plus appropriate experience. That is the first thing. Okay. Then you should also look at objectivity. How much can you depend on that? Otherwise, what will happen is, if you're too dependent on the engagement quality control reviewer, if that compromises the objectivity of the review itself, or if it is a close party, if it is a person who is a very close friend and objectivity is damaged, in that case, we should not be doing it. So these are the two things you have to keep in mind, right? This is a pure theory question. Then what should be the content of quality control review policy and procedures if Mehroon firm is required to apply such policy? So this, you can directly look at the theory. So I think some of this has been missed in this notes. So we'll look at the suggested solution, and then in the notes also I'll incorporate that subsequently. Okay. the policies and procedures. So firms should establish policies and procedures requiring for appropriate engagements an engagement quality control review that provides an objective evaluation of the significant judgments made by the engagement team and the conclusions reached in formulating the report. So basically, the objective of an engagement quality control review is that if, for example, I am a partner, and if I am a partner and I have carried out a particular audit, there is a possibility that I might have missed out some points. Okay. So independently, another partner with appropriate experience, he will review the audit and see if some points are missed out. Okay. Now there have been, I've come across a lot of cases during quality control review. In one of the cases, what happened was the client had a subsidiary. Okay. The client had a subsidiary, but they forgot to consolidate the subsidiary for 2 years. And in the 3rd year, when another partner was reviewing, that is the point of time when they realized that, array, we have not consolidated the subsidiary. That is where engagement quality control review becomes important. Okay. Now, policies and procedures should include requiring an engagement quality control review for all audit of financial statement of listed entities. This is mandatory. If you have listed entities, the policies, the engagement quality control review policy should ensure that all audits of financial statement of listed entities are reviewed by an engagement quality control reviewer. Then it should have criteria against which all other audits and reviews of historical financial information, other assurance and related services and engagement should be evaluated to determine whether an engagement quality control review should be performed. So what should be the criteria which we should use to review audit and review of other historical financial information? Something like, let us say there is a limited review, quarterly limited review. How should this be reviewed? Then require an engagement quality control review for all engagements meeting the criteria established in compliance with the above paragraph. So basically, what is the criteria? And second thing is, have an engagement quality control review for all engagements that meet the specified criteria. So here, what is the criteria? And if something meets this criteria, how do we do that? Okay. So that is with respect to engagement quality control review. And then the firm's policies and procedures should require the completion of the engagement quality control review before the report is issued. This is very important. It is not that after you have issued the report, you will do the engagement quality control reviewer part. It has to be done before the report is reviewed. And you should have policies and procedures setting out nature, timing, and extent of quality control review, criteria for eligibility of engagement of quality control reviewers, and documentation requirements for an engagement quality control review. So the policy should say what is the nature, timing, and extent of QC. First, what is the criteria for the eligibility of EQC reviewers? So here we are talking about who can be. Can anyone be a reviewer? Can an article assistant be a reviewer? No. Who can be a reviewer? And documentation requirements for an engagement quality control review. So what is the documentation requirement? This also should be set out. So this had more for your audit related aspect. Now coming back to this case specifically, I have a couple of points to highlight here, given the case scenario that has been presented in this, right? Yeah. So here, this can be linked to India 16 also. What is the amount to be capitalized? Okay. What is the amount to be capitalized, or what is the contract work in progress? Something like that can be included here. Then, if there is a bonus share, what is the impact on EPS? That can be a question. Can someone tell me what is the impact on EPS as per India 33? When bonus shares are issued, what do we do? What is the impact of issuing the bonus shares on EPS? Anyone? Okay. So whenever there is a bonus issue, you will retrospectively or from the beginning of the period, you will adjust the number of shares. So that will be the impact on EPS. So that could be one more aspect as far as this particular case is concerned.
Now, case study number 14. You might get one out, sir, why not case study number 13? Case study number 13 is already being discussed about something called reverse trumps. Reverse terms, remember, people were coming into developing country for better scope in India. Exactly. Student is still having some doubt. Sir, why did you choose option B as 32 crore? Sir, option B in that is 32 crores and 2 crores. 32 crores is the actual interest what is paid. 2 crore is what is disallowed. So both are reported in tax audit reports. Got it, my dear friend? Or you are still got stuck there only? Perfect, sir. Thanks for your time. Thank you so much. Done. Proceed. Case study number 14. BASP and Co. Chartered Accountants are a firm of chartered accountants having offices across major towns of South India. Very good. They provide consultancy in the field of GST, income tax, and corporate law. ABC Private Limited is one of the major clients of the firm, having a dynamic and professional finance team. Tan and Can, the partners of BASP and Co., had regular meetings with Jay, Director of Finance of ABC Private Limited, and his team. During one of the meetings, Jay seemed to have quite some points for a discussion with Tan and Can. Having seen new members in the audit team, Jay gave a quick overview about the company and its operations for their understanding. He explained that company manufactures and supplies ACs, refrigerator, and other products. He went on to explain the following points. Company is expanding its business and establishing new units with a budget of 250 lakhs. Very good. The budget is, breakup is 120 lakhs for civil construction excluding GST, 130 lakhs for plant and machinery excluding GST. Very good. Next. Civil construction cost includes construction of foundation for installation of plant and machinery. And the cost of construction of foundation is 20 lakhs. CGST, SGST for both civil construction and plant and machinery is 9% each. The details of expenditure are 1st April, advance given plant and machinery, advance given to contractor. 15th April, construction has begun. 30th April, civil construction work expenses. 31st July, again expenses. 1st October, payment made to suppliers of plant and machinery and delivery received. 31st December, construction work expenses. 31st March, final payment made, including outstanding GST. That is how they incur the expenditure. We will see. What is that they are going to ask us? Let's wait and watch. During 23-24, in one of the direct board meetings, management sought approval from board for investing in shares of other company as per Companies Act. Related to law. No, wait. Some interesting thing. The board approved management's proposal after deliberation and discussion. Company purchased 10,000 shares of Milan Limited on 1st of January at a price of 20 per share. And Milan Limited declared bonus of 1 share for every 2 shares held. That was 1:2 bonus shares were given. And they held on 31st March as a record date for issue of bonus shares. And the company sold 10,000 shares purchased on 1st Jan on 31st August. Sir, this concept is technically called bonus stripping. Bonus stripping. There is one brilliant section called section 94.8, which talks about bonus stripping, which says that if the shares are purchased within 3 months prior to record date, record date means the date when we got bonus shares, and within 9 months after record date, the original shares are sold. In that case, my dear friends, whatever loss comes, that loss will be ignored, and that loss will be regarded as cost of bonus shares. Very, very important point is there. Next. In addition to manufacture and supply of AC, company also does installation for the same. It received advance of 5 lakh for supply of 5 ACs for installation of 15th February. Company supplied AC on 28th February and issued invoice on 28th February. Supply was chargeable at 18%, but it was reduced to 12% from 25th of February. Invoice is raised when, my dear friends? Amount payment is received Payment is received before change in rate. Invoice is after change in rate. Supply also is after change in rate. Company charged GST at 18%, while buyer Bhavana Limited contended that GST should have been charged at 12%, as the supply was made after change in rate. Can somebody tell me what will be the answer, my dear friends? Will you take after change in rate or will you take before change in rate? Got section 14. Very good, my dear friends. Obviously, what will come is section 14 will come into picture, my dear friends. And section 14 clearly says if payment is before change in rate, supply is after change in rate, invoice also after change in rate. Then we'll see what, my dear friends, after change in rate. Next. Company has entered into agreement with Humlog Enterprises, proprietorship concern, not registered under GST, for providing transport services by road for carriage of AC to various parts of country. The said concern has a fleet of 50 vehicles, and company made payment of around 50 lakhs on account of said services availed. Getting my point, everybody? And when payment is made to them, obviously they are supposed to do something called TDS, my dear friends. No doubt about it. Friends, next line. Jay was happy to inform that company's operations were going on smoothly and they were on a growth trajectory. Very good. During 22-23, company had turnover of 100 crores and the loan outstanding from the bank was 75 crore and deposit of 30 crores. Next point. After audit discussions were over, Jay and Ken had a general discussion. During the conversation, he mentions that Sashi, a shareholder and non-executive director, has become the present member of parliament. His son is studying abroad in US. As the present term is coming to an end next year, his term also will come to an end. And Shahi is willing to contest next election as independent candidate. He has many friends and relatives in US and asked his son to contact them to collect fund for his election. Oh my God. Jay also told Ranga that Shahi's friend, who is a contractor working for Ministry of Transport, also accompanied Shahi on the US trip as a part of government delegation. Next. Jay asked Stan and Ken if they could help his friend Merun, partner Mahim and Co Chartered Accountants. Jay and Merun were close friends and they often used to have professional and academic discussion. Stan and Ken gradually agreed to provide clarifications to Merun if they had technical query. Jay has set up a Zoom call between Merun and them. During the call, he said that he will be more comfortable and confident if some other chartered accountant reviews the financial system and audit report is signing for the purpose of quality control. That is using the work of another auditor. Come on, friends. First question. What is that about? Is ABC Limited required to appoint internal auditor? That related to your Companies Act. Next. Company will treat loss on shares as what, my dear friends? Very, very important point, my dear friends. Let me tell the answer to you. Which goes like this. MCQ number 2. That is, as per section 94(8), bonus stripping concept will apply if, what is that line, sir? Bonus stripping concept will apply if shares are purchased within 3 months prior to record date. Record date is basically the date fixed for announcing the bonus shares, my dear friends. So getting clarity, my dear friends. And such shares are sold within 9 months from record date. Within 9 months of the record date, my dear friends, such shares are sold. Such shares are sold. Then what will happen, my dear friends? Loss on sale of such shares will be ignored. And such loss shall be considered as cost of acquisition for the bonus shares. So the loss will be ignored and the loss will be considered as what, my dear friends? Cost of acquisition for bonus shares. Because in this question, the original shares are sold within 9 months, my dear friends. So are we getting clarity? So the loss is ignored and that loss will become cost of bonus shares. So what is the correct option, my dear friends? Company cannot claim loss of 50,000. However, this loss will become cost of acquisition of remaining 5,000 shares which are received as bonus shares. Answer is option C, my dear friends. D is not correct. Somebody is telling D. D is not correct because D option is telling cost of bonus shares will be nil. So D is not the correct answer. C is the correct answer, my dear friends. Which one? Third question. In the background of the facts given above, what is the amount ABC Private Limited is entitled to take as input tax credit? So let me tell you this answer very, very clearly, sir. The point is very clear, my dear friends. ITC related to construction of immovable property cannot be claimed as per section 17.5 because of block credit. However, ITC related to plant and machinery can be claimed. Moreover, ITC related to foundation. ITC related to what, my dear friends? Foundation. ITC related to what, my dear friends? Foundation work. It is related to foundation work related to plant and machinery can also be claimed. Come on, let's see the answer, my dear friends. Come on. Come on, come on, come on, come on, my dear friends. What are the options we have got? Get back. Let's see the question. Let me get back to the question. What is that they had, my dear friends? Come on, come on. 120 lakhs is for construction of foundation. Total. Out of that, cost of construction of foundation is 20 lakh. So on this 20 lakh, you can take credit. And 130 lakhs also you can take credit. So you can take credit on 130 lakhs also. You can take credit on 20 lakhs also. Totally, you can take credit on 150 lakhs, my dear friends. So GST on 150 lakhs can be claimed as input tax credit. And how did I get 150 will be 130 lakhs plus 20 lakh is that foundation work. So which will be 150 lakhs into 18%, which comes to how much, my dear friends? 27 lakhs. So that can be claimed as input tax credit. Yeah. So what is the option, my dear friends? 27 lakhs we can take as credit. So answer is option B, my dear friends. Because that is what is a credit which we can claim. What a brilliant question, my dear friends. Next, question number 4. Advice ABC Private, what is the correct position of law in the facts of the given case? Tell me, guys, you tell the answer. We are talking about something called section 14. We discussed already. Payment is before change in rate. Payment is before change in rate, and supply and the invoice both are after change in rate. Then obviously what rate of tax will apply is, we'll apply new rate of tax. Already I discussed this point with you, my dear friends. So the answer will be option B, my dear friends. Because of very clear-cut answer, section 14. Section 14 of CGST Act, which talks about time of supply in case of change in rate of tax. Are we clear with this question, my dear friends? Very, very interesting point. Good. Next. As regards discussion of TAN and CAN, quality control, that's related to your auditing. Descriptive question. First bit. Discuss implication, if any, in the hands of payment made by ABC Private Limited to Humlog Enterprises. That means payment is made to a transport operator. Clear-cut answer, my dear friends. In case of payment to transporter, my dear friends, TDS under section 194C will apply. And in fact, moreover, I remember in this question, they clearly told that he is an individual. When he is individual, my dear friends, we'll do TDS at the rate of 1%. When he is individual, we'll do TDS at the rate of 1%. Friends, getting my point, everybody? When he is individual, obviously, my dear friends, without any second thought, I'm going to do TDS at the rate of 1%. And the question they told, they have made a payment of 50 lakh rupees, my dear friends. So TDS will apply on 50 lakhs. And of course, my dear friends, if he does not own more than 10 vehicles at any time during previous year, then TDS will not apply. But in this question, they never told he does not own more than 10 vehicles. In the question, they told he has got 50 vehicles. Got the point, everybody? And moreover, TDS is to be done at the time of payment or credit, whichever is earlier. TDS is supposed to be done at the time of payment or credit, whichever is what, my dear friends, earlier. And one more interesting point, under GST law, my dear friends, in case of payment to GTA, it is given that GTA is unregistered. Then in such case, my dear friends, recipient is liable to pay tax under RCM at the rate of 5%. In fact, my dear friends, if GTA would have been registered, GTA has got an option whether to go for 12% or to go for 5%. 12% with credit, 5% without credit. But since in this question, if you observe, my dear friends, GTA is an unregistered person. Since GTA is unregistered person, my dear friends, our client is supposed to pay tax under reverse charge mechanism. And I can also add one line here. Such tax paid under RCM can be claimed as input tax credit. So whatever tax we are going to pay under RCM, my dear friends, that tax again, we can claim it as input tax credit. There is no doubt about it, my dear friends. Are we getting clarity, everybody, my dear friends? All of us, come on, please reply. Interesting point, but makes a lot of meaningful sense. Next point, get back. So descriptive question, first bit is done. Second, J feels it is not appropriate for Shai to seek funds for election with reference to Foreign Contribution Regulation Act, FCRA, that is related to law. And in the background of Meru's discussion with Tan and Can, answer the following. Can financial statement be reviewed by other chartered accountant related to auditing? That's it. And quality control review. This is also related to your auditing. Nothing is related to taxation there. Friends, got the point, everybody? I'm sure we got that very good clarity on this interesting case study, my dear friends. Case study number 14.
Okay. So we will be moving on to the next case study, which is case study number 14. Case study 14. Now, case study 14, again, we have got one MCQ which is relevant for us. Okay. So MCQ number 1. Let's read this. We are on case study number 14 of your study material. Okay. Now, is ABC Private Limited required to appoint an internal auditor during the financial year 23-24 for complying the provisions of the Companies Act? Okay. So here we are talking about internal auditor. Is internal auditor's appointment compulsory? And this is a private company. Okay, so here we are talking about chapter 9 of the Companies Act, accounts of the company. And here the relevant section is section number 138. Okay, simply in section number 138, we have been given certain prescribed limits, turnover limits, paid up share capital limits. If those limits are satisfied, then such a company will compulsorily have to appoint an internal auditor and they have to get internal audit done. Otherwise, it's not required. Okay, so we'll directly have to refer to this section and the limits. That's it. So for that, we need some facts from the case also. We need to see what this case says, like what is the turnover of this company, what is the outstanding loans and everything. Okay, so let's read into the case. Okay, so point number E talks about certain limits of the company. So J was happy to inform that the company's operations were going on smoothly and they were on the growth trajectory. During the financial year 22-23, the company had a turnover of 100 crores, remember that, and loan outstanding from the bank of 75 crores and deposits of 30 crores. So these are the three figures that we have. Turnover 100 crores, outstanding loan from the bank 75 crores, and deposit is 30 crores. Okay, so we'll have to now refer to section 138 to see if this private company needs to do internal audit or not. Okay. Okay, so now section number 138 covers our internal audit. Okay, it says that certain prescribed companies will compulsorily have to have internal auditor and they will have to conduct internal audit. Now, what are these prescribed companies? It is given in rule number 13 of the company's accounts rules. Okay, now this rule number 13 says that every listed company, no matter what is the turnover, no matter what are other limits, every listed company compulsorily have to have an internal auditor and get the internal audit done. Okay, every unlisted public company having paid up share capital more than equal to 50 crores or turnover more than equal to 200 crores or outstanding loans and borrowings from the bank and public financial institutions exceeding 100 crores or more at any point, or outstanding deposits 25 crores or more at any point. So this is for every unlisted public company. What is our case? Our case is a private company. So turnover of 200 crores or more, outstanding loans or borrowings from the banks or public financial institutions exceeding 100 crores or more at any point. And there is no point given for deposits. So deposits are irrelevant for us. Okay. So in the question, see, turnover should be 200 crores or more, outstanding loans at any point during the preceding financial year, at any point, irrespective of repayment, the highest loans and borrowings at any point during the financial year should be 100 crores or more. One of these should be satisfied. Okay, so deposits are irrelevant here. So deposits we are not going to see, irrelevant. Turnover is 100 crores. It does not satisfy our criteria. And outstanding loan is 75 crores. Here we need 100 crores of outstanding loan. Again, that is also not satisfied. So none of these criteria are satisfied by this private company. Is this required to have an internal auditor? Yes or no? Is this required to have an internal auditor? Is this required to have an internal auditor? No, no, correct. Okay, so we'll select the option accordingly, right? So the company is required to appoint an internal auditor as one of the limits is satisfied. This is wrong. The company is being a private company is not required to appoint, again, this is wrong. The company is not required to appoint the internal auditor as the appointment of internal auditor is a matter of board resolution. See, the reasoning is incorrect here. These two reasonings are incorrect. The company is not required to appoint internal auditor because the threshold prescribed under the acts have not been met. This is the correct reason why we don't need an internal auditor. I hope we are clear on this. Okay. Can we move on? Can we move on to the next? Yes. I want to know if I'm very fast. Am I very fast? Or is this speed okay for you? Speed is okay? Okay, good.
So let's move on to the next one. Now, moving on to case study 14. Case study 14 has a question based on FCRA, that is Foreign Contribution Regulation Act. Let's see what the question is. Question 7 says, Jay feels it is not appropriate for Shahi to seek funds for election in such a manner. So there's some person who's contesting for elections, and there's a person, Mr. Jay, who feels that funding election in such a manner is not appropriate. Now, with reference to FCRA, explain who are prohibited from taking any contribution from a foreign source. So now you are required to explain that who are the people who are prohibited from taking any contribution for foreign source. And for this, we are going to use section 3 of FCRA. However, we'll first have a look at the case study and see what the scenario is. Okay, so the relevant point here is here. After the audit discussions were over, Jay and Ken had a general discussion. During the conversation, he mentioned that Shahi, a shareholder and non-executive director of the company, has become the present member of parliament. His son Abir is studying abroad in US. As the present term of parliament is coming to an end next year, his term will also come to an end. So there is a person, Mr. Shahi, who is a member of parliament, and his son is studying in the US. And this person, Mr. Shahi's term is also going to come to an end next year. His term is going to come to an end as the MP. So Shahi is willing to contest next election as an independent candidate. So for the next election, Shahi wants to stand as an independent candidate. He has many friends and relatives in the US, and he has asked his son to contact them to collect fund for his election. So he has friends and relatives in the US, and he's asking his son to contact those friends and relatives and get funds for his election. Jay told Ranga that Shahi's friend, who is a contractor working for Ministry of Transport, Shipping and National Highways, also accompanied Shahi on a US trip as a part of government delegation. So they were just discussing, chit-chatting, and meanwhile Jay was told about Shahi, who is going to contest for the next election, and he's seeking collection of funds by his son from his friends and family who stay there in the US. Now, you tell me, do you think this is allowed in general? Do you think he can do this? No. So here, the question is asking you to answer it with reference to Foreign Contribution Regulation Act. So Section 3 of the Foreign Contribution Regulation Act talks about some prohibited things, some situations wherein there are prohibitions from seeking foreign contribution or funds from outside. So let's have a look at those. What are the situations wherein funds cannot be obtained from outside sources? Or who are the people who cannot obtain funds from outside? Yes, you're correct. Candidates for elections cannot do that. So Section 3 of Foreign Contribution Regulation Act, there are certain prohibitions on acceptance of foreign contribution. So there are a few categories of persons on whom directly or indirectly there are prohibitions imposed. So who cannot obtain it? It cannot be obtained by a candidate for election. So from the first point itself, we can understand that Mr. Shahi, he cannot obtain funds from outside because he is contesting for elections. So Mr. Shahi cannot do so. Then who else cannot obtain foreign contribution? Correspondent, columnist, cartoonist, editor, owner, printer of a registered newspaper, a public servant, judge, government servant or employee, or any other corporation which is owned or controlled by the government, any member of legislature, that is MLA, any political party or office bearer of any political party, organization of any political nature, or an association or company which is engaged in production or broadcast of audio news or audiovisual news or current affairs programs through any mode of mass communications, or any correspondent, columnist, cartoonist, editor, owner of association of company which is related to audio broadcast of audio news, audiovisual news, or current affairs program. Now, how are you going to write answer to this particular question? This is the direct question. So first, you will first have to explain section 3, that is this. You will have to write who are the people who are prohibited from, who are not allowed to accept foreign contribution. And then, yes, we'll give our conclusion that in the given case, Mr. Shahi is seeking funds from the US for election. He is a candidate who is contesting for election. So it is not appropriate on Mr. Shahi's part. Mr. Shahi is not allowed to do so. He cannot do it. So that is how you're going to answer this particular question. Is this clear? Have you understood this? You will soon get notes for economic laws. We have prepared notes in FEMA and they'll be shared with you soon. And for the other acts also, we are compiling all the important points and you will get that. I think we've already shared the notes. I'll just check and get back to you. You'll get the notes soon. Okay, is this clear?
Hello everyone. How are you all doing? You all are doing well? Good. So let's start. Have to get 15 EBS. IBS. Okay. Let's hope so. Okay, so let's start. So today we are going to aim to finish at least like 2 case studies. Why 2 only? Because they are big case studies. Okay. So with that, we'll be finishing the November 23 case study digest. Okay. So let's start. Okay, so case study 1 is what we have to do. And this has got 5 questions. So this case study is majorly a company law case study only. Okay. So let's start off. Okay, so first we are reading the first MCQ. All right. So with reference to the information which is given in para 2, whether there are any statutory requirements for VPL to appoint a whole-time company secretary and whether Mr. Divakar is eligible to be appointed as a whole-time secretary. So this question simply talks about whether this particular company, is it compulsory for VPL? We'll see what is VPL. Whether it is compulsory for this company to appoint a whole-time director. Yes. So 203 is the relevant section. Whole-time director, whole-time company secretary is a KMP. And we have certain companies which are prescribed that they have to compulsory have key managerial person. It is given in our section 203. Okay, so we have to check that section and accordingly we'll have to see. Second part of the question says whether Mr. Divakar is eligible or not. Okay, so we'll have to see what para 2 says. Let's look at the question, then we are going to read the section and we'll decide. Okay, thereafter VPL appointed we are reading para 2. Thereafter, VPL appointed Mr. Divakar as a whole-time company secretary and Mr. Devraj as the managing director, respectively, which are also serving on the same position in its holding company. So far what we understand is that this VPL company, they have appointed Mr. Divakar as the whole-time company secretary and Mr. Devraj as the managing director. And both of these people, Mr. Divakar and Mr. Devraj, they are having the same position in the holding company, Amisyam. So what we understand, there are 2 companies here. There is this Amisyam, which is the holding company. And then under this, we have got VPL, which is the subsidiary company. Now, VPL appoints these two people, and they're also holding the post of company secretary in the holding company. Okay. Okay, let's read further details to understand more about VPL. Okay. Now, after being appointed as a managing director in VPL, Mr. Devraj acquired 1,000 shares at the face value of 100. Issue price is this. This is not relevant for us. Why? Because Mr. Devraj right now is not relevant for us. On 25th August, VPL sold its two machineries to Mr. Devraj. Again, this is also not relevant for us. We want to know whether it is compulsory for VPL. What we want to know, whether it is compulsory for VPL to appoint a company secretary or not. For that, we need the details of VPL. So VPL details are given up in the above paragraph. So let's read this above paragraph. Visam P Limited. Okay, Visam Private Limited is another company engaged in manufacturing and selling of only one chemical product, COH, and 55% of equity shares of this company are acquired by Amisyam Limited, due to which the paid up share capital of VPL has increased from 8 crores to 10 crores. Okay, so this is the relevant information for us. So this VPL has got a paid up share capital of 12 crore. Based on this, we have to check whether they need to compulsory have a company secretary or not. Okay. Is my screen visible? Is the Word document visible? Yes or no? Is the Word document visible? Just please tell me, is the Word document visible? Yes, thank you. Okay. So now let's look at what section 203 says. So section 203 talks about appointment of key managerial person. It says the following companies shall compulsorily have a whole-time KMP. Okay. Now what is that? Even the listed company, every listed company needs to have a KMP, and every public company having paid up share capital of more than equal to 10 crore should have a KMP. Okay, so when we say whole time KMP, it means a company secretary, it means a CFO, and it means an MD, manager, CEO, etc. in the absence of a whole-time director, right? Other than that, it's written that every private company having paid up share capital of 10 crores or more should have a whole-time secretary. They need not have a CFO, they need not have an MD, whole-time director, etc. But they should have a whole-time company secretary. So in the given case, I hope you understand. In the given case, we are talking about VPL. Now, VPL is a private company or is it a public company? It is a private company. It is a private company, PE Limited. So now this is a private company. So that means the full provision is not applicable here. We don't need to see the above part of the provision. What is applicable is this part, which says that every private company having paid up share capital of 10 crore rupees or more should compulsorily have a whole-time company secretary. All right. Now, this whole-time KMP shall not hold office in more than one company at the same time, except if it's a subsidiary company. So it's possible for the KMP to hold an office in the subsidiary company additionally. Okay. So now in this case, based on the provision that we have discussed, please tell me if VPL should have a company secretary. Yes or no? Okay. Yes or no? See, you guys will have to be active on the chat. I will wait for your answer. I want you to listen to the case, listen to the provision, and then reply. Okay? Yes, yes, correct, correct. Okay, so VPL should have a company secretary. Now, Mr. Devraj, is he capable of being the company secretary? Is he qualified? See here, with respect to, Mr. Devakar, with respect to Mr. Devakar, we have got one information, which is that he holds the same position in its holding company. So see, is it possible to hold the position of company secretary in holding company as well as subsidiary company? So section 203 says it's okay, no problem. The whole-time KMP shall not hold office in more than one company at the same time, except if it's the subsidiary company. So if a KMP is a KMP in subsidiary and holding, that is allowed as per 203. Got it? So accordingly, we'll have to select the correct option? Let's quickly look at the options. Yes, as its paid up share capital exceeded. Okay, 1 second. So these are the 4 options. Let's look at the options. There is no requirement to appoint the whole-time company secretary in a private limited company. Now, this is not the correct option for us because it says there's no requirement. Second option, yes, as the paid up share capital exceeded the prescribed limit, and also Mr. Divakar is eligible to be appointed as whole-time CS, as it is the subsidiary company of Amisyam. So this B is the correct option. It covers both our points. Let's read the C option. Yes, as the paid up share capital had exceeded the prescribed limit. However, Mr. Devakar is not eligible to be appointed as a whole-time secretary. So this second part is incorrect. No, as a paid up share capital did not exceed. This is incorrect. Okay, so B is the correct option. Okay. Right. Let's move on to next question. So next question we have is a descriptive question. Let's read question number 6, question 7 and question 8. First part is relevant for us. We're going to read first question number 6, first part. With reference to the information given in para 2, explain the manner in which VPL would have appointed Mr. Divakar and Mr. Devraj. So what do we have to explain here? See, Mr. Divakar was the company secretary. Mr. Devraj was one of the KMP. We'll read. Now you have to explain the manner in which they are appointed. Okay, so basically section 203 again, but you just have to explain the manner of appointment. So you have to explain the provisions of section 203. Just for reference, let's look at para 2. Mr. Divakar is a whole-time company secretary and Mr. Devraj is the managing director. So we have to see how the company secretary is appointed and how the managing director is appointed. Okay, so what does section 203 say? This is a descriptive answer. I'm simply going to explain the provision to you, the relevant provision. See, again, here we have to explain the manner of appointment. So you don't have to quote the entire provision. You have to quote the part of the provision that relates to the manner of appointment. What are the steps or the steps that have to be taken by the company for completing the appointment? Okay, so section 203, it says that if a whole-time KMP has to be appointed, then board of directors, they have to take a resolution. That is the first step, board of directors resolution. In the board of directors resolution, they will also have to explain the terms and conditions at which this person will be appointed. Like that means for what duration he will be appointed, what will be the remuneration, what will be the roles and responsibilities, etc. All that. The whole-time key managerial person shall not hold office in more than one companies at the same time, except if it's a subsidiary company. Okay, so this we have already discussed, that whole-time director can be appointed in only one company. More than one company is allowed if it's a holding or subsidiary company. Now, if the person is an MD or a manager, which is in our case, the other person, not Divakar, the other person is an MD, right? So if a person is an MD or manager in one other company, it is permissible for the company to appoint him as an MD if following conditions are satisfied. Okay, so see, we know Mr. Divakar and the other one, Mr. Devraj. Mr. Devraj and Divakar both are also working in the holding company. So this provision says that only with respect to MD or manager, even if it's a holding company or subsidiary company, if that MD or manager is working in two companies, then we have to follow these steps. Even if it's a holding company or a subsidiary company, these steps have to be followed by the board of directors. What are these additional steps? Okay. First step is that we have to ensure that this person is acting in only one additional company. Okay. So at the most, this MD and manager can be an MD and manager in only one more company, not more than that. Next, the board resolution should have the consent of all the directors present. So all the directors that are present in the meeting, they should agree, then only such an MD will be appointed in another company. So here see, Mr. Devraj is already an MD in the holding company we had discussed, right? So now he's being appointed in the subsidiary company. So there, the board of directors will have to sit and all the board of directors, they will have to give the consent. Then only Mr. Devraj will be appointed in the subsidiary company as the MD. This condition is not applicable for company secretary. This is only applicable for MD or manager. Okay. Then specific notice of such meeting and the resolution has to be given to all the directors in India. So this is simple. The notice has to be given to every single director containing the agenda that we are appointing an MD or manager who's already an MD and manager in another company. Okay. So this is the provision. Based on this provision, what do we understand? We understand that, see, Mr. Devakar, who is a whole-time company secretary, for his appointment, simply board resolution is enough. Okay. For Mr. Devraj, who is a managing director in Amisyam Limited, which is the holding company, for his appointment in subsidiary company, we need board resolution with the consent of all the directors present. And also a special notice has to be given to all the directors in India. Got it? Okay. So we're going to move on to the next question now. Are you satisfied with this? Can we move on? Yes or no? Yes or no? Okay, let's move on. So we'll read the next descriptive question from this particular case study. I'm reading the 6th question, second part. With reference to the information given in para 3, explain what statutory requirements Mr. Praveen would have explained to Mr. Devraj that would have made him change his contention. Oh my God, what a complicated question. Let me read again. So para 3 we have to read. It says, what statutory requirement Mr. Praveen would have explained to Mr. Devraj that made him change his contention. So there is definitely some Mr. Praveen. Mr. Praveen has said something to Devraj. Who's Devraj? Devraj is the MD, no? We just discussed. Devakar is the CS. Devraj is the MD. So Mr. Praveen has said something to Mr. Devraj, who's the MD. And then Devraj has changed his mind about something. Okay, so we have to see what they are discussing. What is it they're talking about? So let's look at para 3. Para 3. Okay. So the CFO of Amisyam Limited, Mr. Digpal, told Mr. Devraj that from financial year 22-23 onwards, the financial statement of Amisyam would be required to be prepared on consolidation basis. However, Mr. Devraj told him that he is of the view that there would be no requirement to do so, as Amisyam Limited is an unlisted company. Okay, so see what is happening here. They are talking. The discussion that they are talking about is whether they should prepare a consolidated financial statement. See, we have so far discussed that there is a company which is Amisyam, which is the holding company, and it has just now acquired another company, VPL, and VPL is the subsidiary company. So now there is holding and subsidiary. Okay, so now we have got section 129 which talks about financial statement. Section 129 says that if the company has a holding or subsidiary, then consolidated financial statement should be prepared. And even consolidated financial statement should be approved in the general meeting by passing ordinary resolution. This is what section 129 says. So accordingly, here the CFO of Amisyam Limited, which is the holding company, this person tells Mr. Devraj that the financial statement of Amisyam would be required to be prepared on consolidation basis as the company has acquired the subsidiary VPL Limited. However, Mr. Devraj told him that he does not think that there is need to prepare consolidated financial statement because Amisyam is an unlisted company and all the members of the company would be intimated in writing. Just give me 1 second. Would be intimated in writing for the financial year, the company will not be preparing consolidated financial statements and will only issue stand-alone financial statement. So here, what is Mr. Devakar saying? Sorry, Mr. Devraj saying. Mr. Devraj is saying that, listen, we don't have to prepare a consolidated financial statements. Why? Because of 2 reasons. One reason is that this company is an unlisted company. They're saying that the holding company is an unlisted company. Amisyam is an unlisted company. And second, they're saying that they have sent a written notice to all the shareholders stating that we will only be preparing a standalone financial statement. We will not be preparing a consolidated financial statement. With these two conditions, do you think is it okay for this company to not make a consolidated financial statement? That is the main question. I hope you have understood the question at least. Okay. So now here we'll have to check what section 129 says. Let's look at section 129. See, section 129 talks about consolidated financial statement or generally financial statement. Yes, Zoom user, you are right. Section 129 says, see, you will have to answer this question. So I am just giving you the provision. Please listen to the provision carefully. Then let me know what you think. Okay. So section 129 financial statements, it says that where a company has one or more subsidiaries, then the company has to prepare consolidated financial statements of the company and all of its subsidiaries. And then such consolidated financial statement also has to be laid in the annual general meeting. This is the general rule. This is a general provision. But there is an exception. Rule number 6 of company's accounts rules talks about the manner of consolidation. It says consolidated financial statements have to be prepared as per Schedule 3. Okay. And the applicable accounting standards. Okay. But there is an exception. Nothing contained in this rule shall apply if the company meets all of the following conditions. If all of these following conditions are met, then there is no need to make a consolidated financial statement. What are these conditions? First condition is this company is wholly or partially owned subsidiary of another company. So here we are talking that there is a subsidiary company which is wholly or partially owned. All of its members, including those not otherwise entitled to vote, have been intimated in writing and they don't object to the company not presenting a CFS, which means that this company that does not want to prepare a CFS, they have sent a written notice to everybody, all the members, saying that they don't want to prepare a consolidated financial statement and they will only be preparing a standalone statement. And all of these people, they have agreed, they don't have any objection. So this condition is satisfied by Amisyam, right? Amisyam has done this. Amisyam has sent a written notice to every single shareholder saying that they will not make a consolidated financial statement. So this first condition the company has satisfied. Here we are talking about Amisyam. That means the holding company we are talking about. Holding company has sent a notice to all of its members saying that we will not prepare a CFS. Okay, this first condition is satisfied. Second condition says securities are not listed or not in the process of being listed. The second condition is also satisfied. Amisyam is an unlisted company. In fact, that was one of the contentions of the managing director. He was saying that this company is unlisted and we have sent a notice to all the shareholders. So the second condition is also satisfied. Third condition says the ultimate holding company of that company, ultimate holding company or immediate holding company has filed a CFS with the registrar of companies. That means that particular company has one more holding company or any further highest holding company. And that holding company has prepared a CFS. In that case, this company will be exempt. What am I saying? I'm saying that so far we had discussed that Amisyam is the holding company and VPL is a subsidiary company. Amisyam does not want to make CFS. Okay, so if Amisyam has one more holding company, let's say X has acquired more than 50% shares of Amisyam. X is the holding company of Amisyam. And X is making a consolidated financial statement. Then that third condition will be satisfied. So those three conditions are applicable on a company which is coming in between. That means it has some subsidiaries, but it is also the subsidiary of some holding company. Okay, so this is a little complicated provision, but it is what it says. So Amisyam will be exempt from having CFS, making CFS if three conditions are satisfied. One, Amisyam has given the notice to all its shareholders that it is not making CFS. Two, Amisyam is an unlisted company. Three, its immediate holding or its even X can have another holding company. Okay, so its holding company has prepared CFS. Okay, if all of these three conditions are satisfied, then Amisyam need not make a consolidated financial statement. Got it? But in this given case, Amisyam is following only two conditions. One, it is unlisted. Second, it has given written notice to everybody. It does not have any immediate holding company. And because it does not have any immediate holding company, obviously, the holding company is not making any CFS. So third condition is not satisfied. Now, please tell me, is it okay for Amisyam to not make a CFS? Should Amisyam make CFS or not? Should Amisyam make a CFS or not? Yes. Yes, make. Quickly answer the question. Come on. Make CFS. Correct. Yes. So it is supposed to make a CFS. So that is the answer for us. You'll have to explain this provision. Section 129, and accordingly you'll have to state the answer that here the third condition is not satisfied. So Amisyam will have to make the CFS. Okay, let's move on to the next question. Descriptive question number 7. It's okay. So we're reading descriptive question number 7. With reference to the information given in para 2, whether there were any restrictions for VPL to sell its machinery to Mr. Devraj in exchange of the vehicle, and if yes, what are the legal requirements? Okay, so we'll have to read para 2 for it. This question says that are there any restrictions when VPL is selling its machinery to Devraj? So there is this VPL company, we know, private company. It is selling some machinery to Devraj. Devraj is who? Devraj is the managing director. We have to explain whether this is okay or not. Are there any restrictions? And if yes, what are these restrictions? So for that, we have to read para 2 to understand this transaction nicely. So there's a lot of mess on the screen. So I'm going to clean up first. Okay, let's read para 2. On 25th of August, VPL sold its two machineries to Mr. Devraj, where one of the machinery was sold in exchange of a vehicle of Mr. Devraj, and other machinery was sold at 1,20,000 respectively. The written down value at the time of sale was 90,000 rupees. However, such other machine was acquired by VPL on 10th September at the cost of 1,40,000 rupees. So there are two machines that VPL is selling. Okay, it's selling to its managing director. One of the machine is in exchange of another machine. So Devraj is giving one machine to the company. Company is giving one machine to Devraj. So they are not having a cash transaction. They are doing a barter, or they are doing a non-cash transactions. Now, when I say non-cash transactions with the director of the company, does it ring a bell? Like, do you remember any section that covers non-cash transactions with the director? Okay. See, the second machinery, it was sold for cash. So that we don't have any provision for that. Okay. But where we have related party transaction, but that is not covered here. Okay. So see, if there is any machine or any equipment or any non-cash transaction that is happening, it is covered in section 192. Perfect. Okay, so section 192 is what is relevant for us here with respect to the first machinery. So what does section 192 say? It says that no company shall enter into an arrangement with the director of company, associate, subsidiary or holding, or person associated with him to acquire asset from company, or the company acquiring asset from such person. Both are covered, unless a prior approval is taken in the general meeting by way of resolution. Okay, so if the company wants to do a non-cash transaction with the director by way of purchase or sale, both ways, first they have to take prior approval in the general meeting. Ordinary resolution has to be passed. Okay. Second thing is, if such a director is a director of holding company, then resolution is to be passed in the holding company's general meeting also. Is this relevant? It is relevant. See, VPL is a subsidiary company. Amisyam is the holding company, right? Now in VPL is giving, is exchanging the machine with the director. And this director MD is also the MD in Amisyam. Remember? So here, what will have to happen? Prior approval in the general meeting has to be taken by VPL, which is the subsidiary. Also, the holding company, Amisyam, will have to consider this in the general meeting. Ordinary resolution has to be passed. Okay, so if the director is a director in holding company, then resolution has to be passed by the holding company also. Okay, so generally speaking, if a company does any non-cash transaction, prior general meeting approval is needed. If this person, director, is also in the holding company, then holding company will also pass the resolution, and notice will contain all the particulars, like what is this asset, what is this arrangement, what is the amount, right? Accordingly, we can answer. Okay, we can answer that, see here, VPL has done non-cash transaction with the director, Mr. Devraj. For that, it will have to pass a prior resolution in the general meeting. Also, Amisyam will have to have a general meeting and consider this. Got it? So this is the answer for question 7. Let's move on. Next question is also a descriptive question, which is question number 8. First part only. So we are reading question number 8, first part. With reference to the information given in para 5, due to what legal restrictions Rao and company would not be able to provide internal audit service to VPL? Okay, so what is happening here? VPL is a company. We have to read para 5. Due to what legal restrictions Rao and company are not able to provide internal audit service to VPL. So definitely VPL must have reached out to Rao and company, but Rao and company must have said something that we cannot provide you internal audit service. Maybe because of some legal restrictions. What are these legal restrictions? We'll have to check. Maybe this Rao and company is also the statutory auditor. Okay, just saying. Okay, we'll have to check. But if you remember section 144, yesterday we had discussed section 144. Section 144 talks about the services that the statutory auditor cannot provide. Okay, section 144 had talked about internal audit. That means a statutory auditor who's auditing the financial statement, he cannot provide the service of internal audit. He cannot give actuarial services. He cannot do investment banking, investment advisory. He cannot make the financial system structure of the company, etc. So maybe Mr. Rao and company is the statutory auditor. That's why he's saying I cannot do the internal audit. Maybe. Okay, so let's look at para 5 to check what are the facts of the case. Okay, I'm reading para 5. Mr. Devraj consulted Mr. Praveen on the issue of standalone financial statement by Amisyam, to which Mr. Praveen explained him the statutory requirement. This is relating to the previous question. The next paragraph. Rao and Company is another firm of chartered accountants in which Mr. Praveen is having 22% profit sharing ratio. The management of VPL proposed Rao and Company to provide internal audit services to VPL for the financial year this. However, Mr. Praveen told the management that due to certain legal restrictions, Rao and Company would not be able to provide internal audit services. So what is happening? There is a firm, Rao and Company. They are a firm of chartered accountants. And in this Rao and Company, Mr. Praveen is having 22% profit sharing. So that means Mr. Praveen is having significant influence in this particular firm. Now, what is happening? VPL is there, we know. VPL has approached Rao and Company to do internal audit. But Mr. Praveen is saying, listen, I don't think Rao and Company can do internal audit in your company due to some legal restrictions. Now, who is this Mr. Praveen, first of all? Who is this Mr. Praveen? So we'll have to find out who's Mr. Praveen to say all of this. Okay. So if you read a little further in this, like if you read a little more of this case study, Mr. Praveen is the statutory auditor of VPL. Okay, 1 second. So para 4, first line says that Mr. Praveen has been appointed as the engagement partner for conducting the audit of Amisyam Limited. Okay. So Mr. Praveen is the auditor of Amisyam Limited. Who is Amisyam Limited? Amisyam is the holding company. Please try and understand. So this Mr. Praveen is the auditor of the holding company. VPL has got a holding company, Amisyam. Now this Amisyam has got an auditor. The auditor is Mr. Praveen. And Mr. Praveen is saying that for VPL should not appoint Rao and Company. Why? Because Praveen has got 22% stake in Rao and Company. So maybe this is all connected. Okay. So we'll have to look at section number 144 for this. Let's see. We know that the auditor of the company cannot provide internal audit services to that company, right? That much we know. That much section 144 says. Is there any other restriction? Let's look at section number 144 to understand this further. So see, section number 144 says that the auditor will not render certain services. What are these services? Bookkeeping services, internal audit, design and implementation of financial information system, actuarial services, investment advisory, investment banking, outsourced financial services, management services. Okay, these services should not be provided directly, indirectly to that company or to its holding company or to its subsidiary company. Got it? A person should not directly, indirectly provide these services to that company or the holding company or the subsidiary company. So what do we understand? That this Mr. Praveen, who's the auditor of Amisyam, which is Amisyam is the holding company, should not provide this service to Amisyam, which is the company, and should also not provide this service to the subsidiary, which is VPL, right? So Mr. Praveen should not provide. But here it's not about Mr. Praveen. We want to appoint Rao and Company. Rao and Company is a firm in which 22% stake is held by Mr. Praveen. Can Rao and Company provide this service to VPL? Are you understanding the question? This is quite mixed, complicated, or interrelated. For that, we have to understand what is the meaning of directly or indirectly. Okay? So directly, indirectly means person himself or by relative or any other connected person or through any entity where he has significant influence or control. So Mr. Praveen himself cannot provide this service to that company or the subsidiary or the holding. His relative cannot provide. His concerned any other person also cannot provide where he has any other person on which he has control or significant influence, or any entity also cannot provide where Mr. Praveen has got significant influence or control. Okay, so Rao and Company is an entity in which Mr. Praveen has significant influence and control. What is significant influence, by the way? So for that, we'll have to refer to section 2's definition. Section 2 mein associate company's definition has got the meaning of significant influence given, which says at least 20% of the total voting power or control or participation in business decisions, etc. But overall, we can say that this particular entity, which is Rao and Company, is significantly influenced or controlled by who? By Mr. Praveen. And Mr. Praveen is the auditor of the holding company. So Mr. Praveen himself and also through his entity cannot provide all of these services to that company, Amisyam, which is the holding company, or the subsidiary or the holding. So its subsidiary is VPL. Got it? So VPL, now please tell me, can Rao and Company provide internal audit services to VPL subsidiary company? Yes or no? I hope you've understood this provision. No? Others also? Only 2 people are active on the chat. Why? Okay. Okay, so his contention is correct. His contention is correct. Praveen's contention that, these services cannot be provided directly or indirectly by Praveen. And by indirectly, we mean even the significant influence entity cannot provide. So Rao and Company cannot provide such services to the subsidiary. Understood? Okay. Let us move on. Now we are going to move on to question number 18. Oh, sorry, case study 18. $179. So case study 1 was like, what do you think was the difficulty level of case study 1? Was it very difficult? Like, how was case study 1? We have done 5 questions in case study 1. Most of them were descriptive, and most of them I think were very twisted. Like, you have to properly read the question, I felt, to understand what is the connection. And you need to deeply understand the provision also. We can moderate. Chalo, very good.
Hello, my dear friends. Very good evening. I hope I'm visible and audible to all of you. Please confirm that. Can you please confirm that I'm visible and audible? Yes, thank you very much. Thank you. So come on, my dear friends. So today it's time to talk about some interesting provision with respect to direct and indirect taxes. We have got some good case studies to talk today, where we'll discuss some elements of direct and indirect taxes related part in that particular case study. So without any delay, let's start the discussion, and I'm sure you're ready. Shall we go ahead, my dear friends? Please reply, my dear students. Yeah, thank you very much. I'm sure the screen is visible for you. In the last session, we have discussed that case study number 11 to 15, where we discussed some interesting points in those case study. Especially, we had some good elements of GST with respect to GST refund. We also had some good points related to input tax credit. All that areas we have covered in that case study 11 to 15. And in these case studies today, what we have got, there are a lot of direct tax related elements also. So we'll see some 4 to 5 interesting case studies based on availability of time. We'll figure out some good number of case studies today. So let me start the discussion, my dear friends. And I'm looking at the case study number 1. This is from your case study digest, which is released by the institute with relation to the multidisciplinary case study. So let's see that part. Case study number 1, para 1. Amisyam Limited is an unlisted public company registered under GST, incorporated since 2011, with 7 directors on its board, and is engaged in the manufacturing and selling of chemical products through several units across the country. So basically, it's a manufacturing unit and is engaged in selling of chemical products through various units across the country. It also exports its chemical products to certain European and countries. So apart from domestic sales, they also have export turnover. Next slide. Amisyam Private Limited VPL is another company engaged in manufacturing and selling of only one chemical product, which is named as KOH, and its 55% equity shares were recently acquired by Amisyam Private Limited during 22-23, due to which the paid-up capital of VPL has increased from 8 crores to 12 crores. So basically what has happened is 55% shares were recently acquired by Amisyam Limited during 22-23. And due to that, what has happened basically their paid-up capital of VPL has increased from 8 crores to 12 crores. Originally, Amisyam Private Limited, that is VPL, they are engaged in manufacturing and selling only one chemical product, that is KOH, and 55% shares are recently taken over by Amisyam Private Limited. Next. So you have to observe that both the entities are private limited company. So both the entities are those entities. Otherwise, both entities are those companies in which public are not interested. Because the public are interested, we'll call it as a public company. If it's a private company, that is that company in which public are not substantially interested. That's a point to be noted because a lot of provisions of income tax apply only to a company in which public are not substantially interested. Next. For acquiring such shares, Amisyam paid a consideration of 10 crores to VPL, and the fair value of non-controlling interest was 3 crores. That's related to your financial reporting. VPL had incurred a loss of 4 lakh rupees during 21-22 as per income tax return, which was brought forward by it. So there is some brought forward loss from financial year 21-22 to financial year 22-23. And I'm sure you all know very clearly that business losses can be carried forward for a period of 8 years. But here, there is a big challenge. What is a big challenge? Friends, let me tell you, we have got a wonderful section known as Section 79, which clearly specifies that in case of a closely held company, otherwise company in which public are not substantially interested, on the last day of previous year in which loss is incurred, whoever are the shareholders, at least 51% shareholders should remain the same on the last day of previous year in which we intend to set off the loss. So last day of the year in which loss has occurred and the last day of year in which loss is sought to be set off, at least 51% shareholder should remain the same. But in this particular scenario, that condition cannot be satisfied because in the previous paragraph only, they have told that 55% shares were recently acquired by Amisyam Limited during 22-23. When 55% shares are transferred to some other company, automatically they cannot satisfy that 51% condition because 51% phenomena is mandated to be followed by a closely held company. Section 79 clearly says that the last day of previous year in which loss is incurred and the last day of previous year in which loss is sought to be set off, shareholders carrying not less than 51% of voting power, they should remain the same. And if they don't remain the same, that loss will not be allowed to be set off. Very, very interesting provision actually. Next point. Can I go ahead? Are you clear with the point? Please confirm. Yes, thank you. Thereafter, VPL appointed Mr. Divarkar as its whole-time company secretary and Devaraj as its MD, which are also serving on the same position in its holding company Amisyam Limited. After being appointed as MD in VPL, Devaraj acquired its 1,000 shares with face value of 100 per share at issue price of 130 per share, whereas the market value of the shares is 115. Please see carefully. After being appointed as managing director, Devaraj acquired 1,000 shares with a face value of 100 per share. At what price he has acquired? He has acquired at a price of 130 per share. So friends, at what value he has acquired? He has acquired at 130 per share, but whereas the fair market value is 115 per share. So the fair market value is 115 and he issued at 130. Let me make you recall, my dear friends, we have got one section known as 5627B, which we have discussed in previous case studies also, which clearly says that in case of a company in which public are not substantially interested, if they issue shares at a price more than fair market value, then the difference between issue price and the fair market value will be taxable, provided issue price is more than face value. That means issue cannot be at discount. If you observe carefully, in this particular case, the shares are issued at 130 per share, but the market value is 115 per share. So that 15 rupees into 1,000 shares, 15,000 will be taxable in the hands of company under the head income from other sources. And this provision is coming from 5627B, a very interesting provision. Next point. On 25th August, VPL sold its 2 machineries. Student is telling income from other sources. Yes, absolutely correct answer. On 25th August 22, VPL sold its 2 machineries to Mr. Devaraj, wherein one machinery was sold in exchange of vehicle of Devaraj, and other machinery was sold for 1,20,000 respectively, and the WDV at the time of sale was 90,000. WDV at the time of sale was 90,000, and that was sold for 1,20,000. But what is that they have done? However, such other machinery was reacquired by VPL on 10 September 22 at a cost of 1,40,000. So this is a clear case where an asset is transferred to another person and then it is reacquired. This phenomenon is very specifically covered in section 43, definition of actual cost of asset, which specifies that if an asset is transferred and then it is subsequently reacquired, then the repurchase price, what will you take for the purpose of depreciation will be WDV at the time of transfer or the repurchase price, whichever is lower. So technically, we will not take the figure as 1,40,000. We'll take the figure as 90,000. Absolutely correct answer. The logic is very simple because if this concept is not there in the law, what people will try to do, if I'm Shivateja, if I've got one friend Raviteja, I'll tell that person, I'll transfer the asset for 1 lakh to you and repurchase again from you from 2 lakhs so that I'll start charging higher depreciation. To encounter these kind of situations, and government wants to ensure that they cover up these kind of cases, they clearly told that WDV at the time of transfer or repurchase price, whichever is lower, that will be considered for the purpose of cost of asset in order to claim depreciation. A very, very interesting point actually. Good. Let me proceed. Next point. CFO of Amisyam Limited, Mr. Digpal, told Devaraj that from 22-23 onwards, financial statement will be required to be prepared on consolidation basis as the company acquired its first subsidiary BPL. Okay. Devaraj told him that he's of the view that there is no requirement to do so. So this is not related to tax, related to your financial reporting. Next. Para 4. Mr. Praveen has been appointed as engagement partner for conducting the audit of Amisyam on behalf of Ved & Co. for the 3rd consecutive year. For the concurrent year's audit, Praveen planned to use the audit evidence from previous year. Purely related to auditing question, not related to tax at all. Next point, my dear friends. Para 5. Devaraj consulted Praveen on the issue of standalone financial statements by Amisyam, to which Praveen explained the statutory requirements applicable in the case, and accordingly, Devaraj was compelled to change his decision. Fine. Rao & Co. is another firm of chartered accountants in which Praveen is having 22% profit sharing ratio. Management proposed Rao & Co. to provide internal audit services. So one firm is providing internal audit, one firm is providing statutory audit. That's related to auditing. So they're all related to auditing and law. Fine. So first question related to corporate law. I'll not discuss that. We proceed to second question. With reference to information given in para 1, whether VPL would be allowed to set off the loss of 4 lakhs for 21-22. I already told you the answer that loss cannot be set off because section 79 condition is not satisfied. And what amount would be chargeable as income in respect of shares acquired by Devaraj? That point also we have discussed that, my dear friends. That is 1,000 shares into 15 rupees per share. That will definitely become taxable. That area also, we have addressed that, my dear friends. Makes sense, right? So the answer is very clear that as per section 79, shareholders holding not less than 51% of voting power on the last day of previous year in which loss is sought to be set off should be same as they were there on the last day of previous year in which loss is incurred. In simple terms to tell, last day of in which loss is incurred and last day of in which loss is sought to be set off, 51% shareholder should remain same. And in the given case, condition is not satisfied. Accordingly, my dear friends, such loss cannot be set off. Further, as per section 56 to 7B, if shares are issued at a price more than fair market value, then the difference between issue price and fair market value will be taxable in the hands of company under the head income from other sources. And of course, my dear friends, this section applies only to a closely held company, which will also call it as company in which public are not substantially interested. I'm sure you got clarity on this point, my dear friends. Good. So now, based on the options, you tell me which option is correct, my dear friends. Come on. Option B, they are telling subsidiary company. Option C, they are telling subsidiary company. And option D, they are telling nothing is taxable. So definitely without thought, without second thought, answer is option A, my dear friends. Because nothing is taxed, not set off of loss is not allowed because section 79. And 15,000 is taxable because of income from other sources, section 56 to 7B. That's a beautiful point, actually. Next. Third bit, with reference to information given in para 2, what should be considered as a cost of machinery reacquired by VPL from Devaraj for income tax purpose, my dear friends? Come on. Already I told this slide to you. Tell me the answer, my dear friends. What will be the cost you will take as? We have option A 140, option B 120, option C 90, option D is also 90, and 50,000 is allowed as claimed as expense. D option is absolutely ridiculous. Without any second thought, my dear friends, answer is option C, because that is what is the most correct answer, which is suitable in this case. Are we getting clarity, everybody? Yeah. Student asking, sir, why? My dear friends, let me tell you, in case of transfer of assets and reacquisition of the same, what is going to happen is very clearly, in case of transfer of assets and reacquisition of the same, the cost of assets to be considered shall be WDV at the time of transfer or repurchase price, whichever is lower. And in the given case, if you see, my dear friends, WDV at the time of transfer is 90,000 and repurchase price is 1.4 lakhs. Accordingly, my dear friends, 90,000 is considered. No doubt about it. Very, very interesting point, actually. Good. What is the doubt student is asking? Let me answer that once again. Student asking, sir, why? I just told you that in case of transfer of asset and reacquisition of the same. You told yes, not why. Okay, done. Then you are clear. Second expense, section 79 again. So section 79 is very clear that last day of year in which loss is incurred and the last day of which loss is sought to be set off, at least 50% share, 51% shareholders should remain the same. Only then the loss can be set off. If not, the loss cannot be set off at all. That is what is the condition given by the law. Good. Should asking till what period do we treat as reacquiring? That point is not given in the law, my dear friend. Law is silent about it. Law only says that in case of transfer of asset and reacquisition of the same, then very clearly, whatever is the WDV at the time of transfer and the repurchase price, whichever is lower, that will be considered. Because in explanation in section 43.1, they clearly told if an asset has belonged to the assessee and it has been used by him at any time before and it is transferred and then reacquired, then the cost will be WDV at the time of transfer or repurchase price, whichever is lower. Good. I hope you are clear. Can I continue that? Even if you reacquire after 5 years, calculation will still remain the same. Yes, no doubt about it. Whatever is the W at the time of transfer or the repurchase price, whichever is lower, that will only be considered. Done. So that's the end of story for question number 3 MCQ, my dear friends. And question number 4 is related to the financial reporting that I'll not discuss. I'll talk only about tax. And MCQ number 5, that's also related to India's financial reporting. Descriptive question with reference to information given under para to explain the manner in which they would appoint directors. What statutory requirements are there? So that's all related to Companies Act. Next question is also related to companies. Any restrictions for sale or selection of vehicle if there's what are legal requirements? Auditing, internal controls, audit evidence. That's it. So friends, this case study does not have too much of taxation, but some interesting points of taxation are very clearly covered here. And I'm pretty sure that you got clarity on these points which are covered here. Please confirm that this case study makes sense for everybody. Can I proceed? Please reply. Yes, thank you.
Now we are going to move on to the case study digest of November 23. And we are going to take up a few questions from there. Okay. 1 second. Page 13. Okay, so first we're going to be taking up case study number 2. And we'll directly look at the MCQ. One of the MCQs is covering our company law concepts. So let's look at it. Okay. Under the provisions, so this is case study number 2 of the case study digest of November 23. Okay. Now, under the provisions of the Companies Act, the books of accounts and records are required to be kept at the registered office of the company. However, the manufacturing facility of the company are located in Noida and Uttar Pradesh. In the light of the above, advise the company. By the way, this is also one question which we have already covered. This we have already covered in one of the case studies before, and this is the exact replica of that previous question. Okay, this question says that, listen, books of accounts have to be maintained by the company. Books of accounts have to be maintained by the company under section 128. Okay, now the company has to maintain them at the registered office. So this company has also maintained it at the registered office. Okay, but this company has a manufacturing facility in Noida, Uttar Pradesh. This company wants to shift these books of accounts in Noida, Uttar Pradesh. Can this company do so or not? You simply have to refer to section number 128. Now, what does section number 128 say? Section 128 say that yes, the company can, 1 second, the company, if it wants, it can move the books of accounts from registered office to any other location. But for that, what they need to do, they simply have to give a notice in writing to the registrar of companies. Within 7 days of such decision, they will have to inform the registrar of companies by filing the notice in writing in AOC 5 form. Okay, AOC 5 within 7 days of the decision to the registrar of companies. So we'll have to select the correct option here. So AOC 5, right? Where is AOC 5? We can simply see AOC 5 here and here B option and C option. It has to be filed within 7 days to the registrar. Okay, so option B says within 30 days, option C says within 7 days. So C option seems the right one. The company can keep books of accounts and records at Noida by filling Form AOC 5 within 7 days of passing board resolution. So that's our correct answer here. Correct. Faiz has said correct. Okay.
So friends, now let me talk about the interesting case study, my dear friends. Case study number 2. In fact, you'll be surprised to see that this case study is something which we already discussed before itself. When we spoke about the case studies of the latest case studies given by ICA manual, this case study already is covered there with just some change in names. You yourself can see that. M4 Private Limited, incorporated in May 22, having registered office in New Delhi, started construction of premises building in Noida using prefabricated structure common and prevalent in these times. And building is comprising of 1 lakh square feet, and the covered area was ready for use at the cost of 6.5 crores. And they also got GST registration. Company had already had an advance, already in advance import of textile machinery from South Korea, and it got stuck. And further indigenously previously used machine was also planned for installation. Remember this kind of question what we solved? Where I told you about 115 BAD, about manufacturing entities, 15% tax what they pay. Yes, good. And here also you can see that there is a domestic turnover, foreign turnover, and they also have duty drawback. And they have incurred scientific research expenditure. Friends, we have discussed this question already before. And there's an input credit on inputs, credit on capital goods, credit on input services. And I already discussed with you that there are 2 options. Number 1, they can go for export without payment of tax, where whatever input credit they have got, they can directly claim it as refund. And in that case, you cannot claim refund related to capital goods. But you can also go for one more option called export with payment of tax, where you can use the credit on capital goods also. This case study, we very clearly already discussed all this question, my dear friends. Just that couple of numbers change. We covered this kind of question before itself. Done. And maybe more or less numbers are also same, I believe. Fair enough. I think I can proceed to the next case study then. Yes, thank you very much.
Okay. So we'll continue with the case studies discussion. This is with respect to case study number 3 from the case study digest. This is about Parv Fabrics, a partnership firm registered under GST having partners so-and-so, business of manufacturing fabric and related aspects. So they have given you details of capital, machinery and all of those things. Then as usual, if you go to the question, if you look at the first question, it is on GST ITC part. Second question is also from taxation. Third is also on GST. Fourth is also on e-way bill, which is GST. Fifth is also on ITC, which is GST. So nothing in the MCQs. Now, under descriptive question, on the first one, the firm has lodged its complaint with PSU insurer. So there is some PSU insurer consisting of damages to building, machinery and stocks. Besides, the firm has also included in its claim bill lodged with insurance certain unincurred estimated expenses for debris removal amounting to rupees 5 lakhs. Kindly suggest how these expenses should be treated in the financial statement of the firm for the year ended 31st March of 23, along with reasons therefore. Now, if you come back, it's a partnership firm, okay? And because it's a partnership firm, we know the Ind AS need not be applied. But because it has come as a CA final question paper, we have to consider as if Ind AS would be applicable in this particular scenario. And then accordingly, we will have to showcase or we'll have to present the answer. Okay. Now, so here if you see the relevant aspect, way back in year 2011, fire broke in the night at factory premise, which led to loss of inventory furniture turning into ashes. Fire department was informed as soon as the fire was seen, but it was too late to save. Recollecting the day, Mr. Perth understood the need of considering fire insurance policy. He understood, although one may take great caution using latest technology, possibility of accidents can't be mitigated. He understands safety risk in textile company. So that is about risk. And the following are the importance of fire insurance. So what are the importance of fire insurance? Then explain the coverage. So here they have given different types of policies. Considering the benefits and compensation covered in fire insurance policy, RF agrees to go for coverage of risk and have insurance. They together in the name of firm opted covering loss for building machinery and inventories. Unfortunately, a major fire had occurred on 6th of January 23. This is what has happened in the plant of the firm, resulting in damages. Okay, so there's a lot of damages, but if you look at the question here, the question is not asking us about the damages. What is the question asking us? Question is asking us that they have lost claim with the PSU insurer consisting of damages to building, machinery and stock. So we have filed a claim. Now, when do we recognize this claim? The claim can be recognized only when the insurance company accepts and gives us unconditional right to receive the money. Only then we can recognize it in the books. Okay. Now, the firm has included in its claim bill lodged with insurers certain unincurred estimated expenses for debris removal. Means we have not even incurred the expenses. We have not even incurred the expenses, but still they have put it under the claim, amounting to rupees 5 lakhs as on 31st of March. How these expenses should be treated in the financial statement for 31st March? Now, if you ask any accountant, chartered accountant, anyone who has knowledge of accounting standard, future expenses that you have not incurred, you will not recognize. See, if there is an obligation to incur, I am talking about debris removal. Now, debris removal may not be my obligation. When I remove the debris, at that point of time, I will account for the specific aspect or specific expenditure. So here, what have they said? Will these expenses be accounted? No, we cannot account for these expenses because we have not yet incurred the expenses. These are future. Okay, so even though you incur, if you say that, I'll claim it from the insurance company, those costs cannot be, considered, or you cannot consider these as your expenses for the financial year ending 31st March of 23. A simple answer. Now, how to answer this? See, for firms, Ind AS is not applicable, but still you have to give this answer with reference to Ind AS, specifically Ind AS 1. Are we clear? You can still make an assumption saying that, because as per accounting standard 1 also, you'll follow the accrual concept only. Future expenses, you will not account in advance. Then, analyze the working capital position of the firm vis-a-vis last year by discussing each component of working capital cycle and overall working capital requirements of firm, including effect of incident of fire on its working capital requirements. Also dwell upon how working capital requirements are being met as compared to last year. Now, this is a question from financial management or advanced financial management, as as we can see. So, what is the working capital requirement and how is that being met? That is what you have to address, right? So here you'll calculate the working capital requirement based on whatever you have. Now, when you say working capital is current assets minus current liabilities. So you will take current assets minus current liabilities and you will calculate what is the working capital, and the question also requires you to comment on year-on-year basis, how has it changed? That also we need to comment. Now, current assets, you will see what are the current assets, inventory, trade receivable, other current assets, then your trade payables. Based on this, you will calculate the working capital. Right? You also have overdraft facility. This is a part of your current liabilities. So what you will get is the working capital, and accordingly, you will make the commentary on that. So let us look at the solution for this. So first one, firm has included certain unincurred estimated expenses on accounts of debris removal amounting to 5 lakhs with the insurance company. In accordance with Ind AS 1, entities shall prepare its financial statement except for cash flow information using accrual basis of accounting. When accrual basis of accounting is used, entity recognizes asset, liabilities, income and expenses when they satisfy the definition of recognition criteria. Okay. So accordingly, you can see the conclusion, no treatment of expenses is required. When it comes to working capital, you will take inventories, trades. You see the inventory, 7.5, it has come down to 2, maybe because of loss. Then trade receivables, other current assets, less trade payables, then your overdraft facility. So, this is the working capital requirement, and so much has been availed with, so much has been funded with overdraft facility. So, 2.25 is the net working capital. Here you can see the working capital requirement has increased. Working capital requirement of the firm grew from 12.25 crores as on 31st of March to 21.45 crores as in 31st March of 23, inventory has reduced. Now, when inventory reduces, your working capital will also reduce. Now, why? Because of fire. The question has specifically asked you, connect that with fire. Then trade receivable has increased from 8.35 to 10.5. So, maybe we have not received money quickly. Another angle what you can put forward is turnover. Now, turnover has reduced. Despite reduction in turnover, your debtors have increased. Means 6:30, I started the class. Despite of reduction in turnover, your revenue has increased. Your receivable has increased. Meaning to say, the collection policy is not proper. So, the company has to work on the collection policy. Then other current assets, they have increased. Now, why would they have increased? Maybe because on account of claim. Because we have filed a claim with the insurance company, this would have resulted in other current assets being higher. Trade payables have again decreased. Means we have paid them more, because of which also our working capital has increased. Okay, then also overdraft facility has increased. So when you say working capital, you have to give current assets minus current liabilities, bank overdraft being a part of your current liabilities. Okay.
Let me talk about one last interesting case study for the discussion. Please see that, my dear friends. Yeah. Case study number 5, please see that. It was the year 1918 when the world witnessed the worst pandemic ever in the history of mankind, Spanish flu. And of course, we have seen the COVID-19 also already. It took world for 4 years to get back to normal by the year 1922. But the pandemic left with memories of pain and devastation and another COVID-19 outbreak. All this is story. And all industries got affected. We know that already. One such case is of Anupama Hotels Limited, operating an all-category resort, the Villas, which is a famous vacation property located in the hills of Shivalik, and the room occupancy is almost full throughout the year. And this property was a hot favorite for not only people of India, but also for tourists. But unfortunately, with the effect of pandemic on the hospitality industry, a lot of people faced a crisis. You know that, my dear friends. So all this is a story they are telling that there are a lot of problems, issues and all. And for that reason, they are looking out for restructuring and all those things. And they got 3 options, what they wanted to discuss. Option 1. Naman Hotels Limited has shown interest in acquiring this resort property as they are of the view that they can help each other in business with Naman Group's experienced staff and innovative team in collaboration with beautiful structure and landscape of the villas. And the business combination can be carried out. FR, India's business combinations. Option 2. Another company, Kavya Hotels Limited, from a different state. They want to acquire Anupama Hotels Limited to take charge of their resort property with its MD, Miss Kavya Narula, having confidence of pulling the property out of economic losses, using her vast experience in the field of hospitality industry. To substantiate this, they are asked by the management of Anupama Limited to put forward the financial details of their performance during the financial year. Consideration regarding striking deal with them with respect to the villas. Head accountant of Kavya Hotels wants to discuss some peculiar transaction with respect to profit and loss made by the group with Ms. Kavya and other members of the management before they finalize their books and submit a report. Head accountant tells them that their group profit shows 150 lakhs after debiting or crediting the following items. That means the following are already adjusted to the P&L. Payment of 35 lakhs, 0.35 lakhs in cash to a local farmer for purchase of vegetables and 0.3 lakhs to confectionery wholesaler for different products. Can somebody please tell me what is going to happen? Come on, guys, please reply. 0.35, that will definitely not be disallowed, but the 0.30, that will be disallowed because that is paid to whom, my dear friends? That is paid to a wholesaler. Next. Contribution towards employees pension scheme notified by government under 80 CCD for a sum of 3 lakhs calculated at the rate of 12% of aggregate of basic and DA. I hope most of you know this, my dear friends. How much is allowed in the law is only 10% of basic plus DA. Well, how much is excess? 2%. That will be disallowed. Payment of 5.5 lakh towards transportation of various materials procured by the resort to PQR Transport, a partnership firm, without doing TDS. And the firm opts for presumptive taxation under 44A and has furnished declaration to this effect. It also furnished a PAN. Come on, guys. What is going to happen? There is no requirement to do TDS. Why? Why, my dear friends? Because payment is made to a transporter and they are opting under 44A. When they are opting under 44A means they do not have more than 10 vehicles at any time during previous year. And 194C clearly says that when payment is made to a transporter who does not own more than 10 vehicles any time during previous year, and if they furnish PAN, there is no requirement to do TDS. Profit of 12 lakhs on sale of plot to Divya Limited, a domestic company. The entity shares are held by SSC company, and plot was acquired by Kavya Hotels on 1st June. What will you do, my dear friends? That is profit on sale of plot. Profit on sale of plot will come under capital gains. Some student is telling they have done this question in DT today. Wonderful, very good, so sweet of you. Next point. Contribution of 0.5 lakhs to IIT with specific direction for use of scientific research, my dear friend. Approved by the authority. Scientific research means we will take section 35 deduction and it's already debited to P&L. So no further adjustment is required. Depreciation 5 lakh rupees. Depreciation level under income tax is 15 lakh. Whereas depreciation as per books of accounts debited to statement of P&L account is 10 lakhs. Hence additional 5 lakhs has to be deducted while computing business income. So what is that we are going to do now? We are going to do now what? We will reduce 5 lakhs. Next point. Expense of 5 lakhs on foreign travel of 2 directors for a collaboration agreement with a foreign company per brewery to be set up. So it's a very, very interesting point, guys. Expense of 5 lakh on foreign travel of 2 directors for collaboration agreement with a foreign company. What is going to happen? And negotiation did not succeed and the project was abandoned. So generally, my dear friends, if the project is abandoned, then it is charged off to the P&L account, provided it is an existing business. But if it is a new business, my dear friends, it will be disallowed. It will be disallowed and is treated as capital expenditure. Very good. I'm so happy that majority are giving right answer. Next. Fees of 1 lakh paid to directors for attending the board meeting without TDS. What is that we are going to do? Fees of 1 lakh is paid without doing TDS. State answer 30% is disallowed. Depreciation charge is 10 lakhs. Okay. After submitting a report on their performance, Kavya works out acquisition plan. Identifiable asset, non-controlling interest. These all related to your FR. Option 3, risk-based audits. That's related to your auditing. Next, during the process of extracting the exception reports in the restaurant, she observes numerous entries without valid purchase orders. In terms of percentage, about 30% were made without valid purchase orders and fewer validated after the actual purchase. Also, there was no reconciliation between goods received and goods ordered. She proceeds ahead to check the validity of purchases at the account balance sheet level. Also, she is told that resort has a tie-up with Hard Coupons Limited, which sells coupons to general public that are redeemable against specific luxury food products at selected properties. Each coupon is sold for 900, but redeemable for 1000. Value of supply is taken as 1000. Value of supply in case of vouchers shall be the value at which the voucher can be redeemed. Rule 32. During the current year, they are awarded a contract for catering in a marriage to be held at Dehradun. Fine. And Sagar is taking care of audit. Ritu again auditing. Considering all the above options, working out the feasibility, Anupama chooses to go with option 3 of going for corporate debt restructuring. Request you to frame a scheme. Okay, fine. First bit. Which of the following indicators a possible potential misstatement with respect to recording? That's not related to your taxation as such. Yes, my dear friends. Yeah, next point. The head accountant view with respect to utilization of ITC on contract outsourced to Vanraj and Sons. What is going to happen? Vanraj and Co. What did they give? They have subcontracted. They have further subcontracted during the current year. They have been awarded a contract for catering in a marriage to be held at Dehradun. They have further subcontracted it for supply of snacks to be served in the marriage to Vanraj and Sons, local caterer of Dehradun. Head accountant is of the view that ITC cannot be availed. Why, my dear friends? 100% ITC can be availed because generally for food and catering, ITC is not allowed. But if it is taken for further supply in same line of business, then definitely credit is allowed because it is clearly in the course or furtherance of business. So answer will be option B. Incorrect, as ITC is available for utilization. Next, account balances of auditing. What is the value of food coupons? Food coupons value will straight away be 1000 because of value at which voucher can be redeemed, my dear friends. What value voucher is given, that is not important. What value that voucher or coupon can be redeemed, that is important. So answer will be option A, 1000. Next. The threat strikes a deal business combination. That is your Ind AS. Calculate the gain or loss they'll make on acquisition. Also show generators for accounting, non-controlling interest. That's also FR. Then risk of material misstatement. That's related to your what? Audits. With the help of data provided by accountant of Kavya Limited, compute PGBP, indicating the reasons for each item. As corporate debt restructuring arrangement, their bank has converted unpaid interest of 10 lakh into a new loan. So conversion of unpaid interest into a loan, it is not regarded as payment. But how much ever we pay, that much will be allowed. And the first installment of 2 lakh was paid in March by debiting new loan account. So that 2 lakhs when it is paid, that can be what, my dear friends? Reduced. There's no problem at all. But conversion of unpaid interest to loan, that is not regarded as payment. Depreciation as per income tax is 15 lakh rupees. Okay. Next line. Company received a bill of 3 lakh rupees on 31st March 23 from a supplier of vegetables for supply made in March 23. The bill was omitted to be recorded in March 23 and the bill was paid in April 23 and necessary entry was made in the books then. But the whole point is all about if the company is following mercantile system, we should take deduction in 22-23 only, right? If purchase is missed in 22-23, then take deduction in 22-23 only. Correct? Because generally, it is very common that company will obviously follow mercantile system of accounting. Done. So based on this data, let's compute total income. Done, my dear friends. Let's start the discussion. What is given in the question? Net profit as per P&L account. How much is the figure? 1 crore, 50 lakhs. Come on, what do I add? Let me go back to the question. First one, what is paid to farmer, that is okay. But what is paid to wholesaler, that will add back. So this 30,000 will add back. Then here also, my dear friends, 3 lakh is calculated 12%, but only 10% is allowed. So beyond that 10%, that also will be disallowed. So let me write this word. Cash payment to wholesaler. 30,000. Correct, my dear friends? Next. Contribution towards employee pension scheme. How much was contributed, my dear friends? 3 lakh is contributed. And 3 lakh is what percent? 3 lakh is 12%. So 3 lakh into 2 by 12, that will be disallowed. I'm sure you got this working, my dear friends. How I got this answer? Next. Payment to transporter without TDS. No disallowance. The sale of plot 12 lakhs, we have to reduce that. Contribution for scientific research, no treatment because it's already taken in P&L. And 5 lakhs foreign travel, negotiation did not succeed. It's a new project. It's a new project because they want to set up a brewery project to be set up. And brewery project is a new project altogether. You're getting my point? Next. Fees of 1 lakh is paid to directors for attending the board meeting, 30% is allowed. Depreciation charge is 10 lakhs, but they told in the question that depreciation as per income tax 15 lakh. So further 5 lakhs we will reduce. Foreign travel expenses in relation to new project which has been abandoned. Getting the point, everybody? Come on, how much is that figure? 5 lakh rupees. Next. Payment without TDS. How much they paid without TDS? They made a payment of about 1 lakh rupees without TDS, my dear friends. So that figure will be 30,000. Got it? Less profit on sale of plot. What is that value, my dear friends? 12 lakh rupees. I hope we are clear with this point, everybody. All of us. So can I proceed? Are we clear? Please reply. Next. What else is there? Depreciation as per income tax. It is 15 lakh. Already 5 lakh is 10 lakh is debited. So I'll take the balance figure of 5 lakh rupees. Next. Unpaid interest converted to loan and installment paid. How much we paid, my dear friends? We paid a figure of 2 lakh rupees. Getting the point, everybody? Next. Purchases omitted in books. And that figure is 3 lakh rupees. Taxable business income. That figure is working out to 1 crore 34 lakhs 10,000. I hope we are getting clarity, my dear friends. That's the story of this PGPP working. A very, very comfortable point, actually. No doubt about it, but of course, an important point. Are we clear with this, everyone? Please reply. That's it, my dear friends. That's the story of this very, very interesting case study. So, friends, we have discussed 4 interesting case studies today. And let me tell you that Today is the last session for taxation. And next couple of sessions, you will have that balance elements of the last 4 or 5 case studies, what we discussed. That balance related area related to FR auditing, that will be discussed. So technically, today is the last session for taxation, my dear friends. So without any delay, let me tell you, my dear friends, wholeheartedly, I wish you all the very, very best. And I wish you all the success, my dear students. Do come out with flying colors, and any doubts anytime with respect to direct or indirect taxes, Shiva Teja is there for your support. Feel free to message either through text mode or through forums. Lot of modes are there where you can reach out to me. Any doubts, feel free to get back. I'll be more than happy to reply to your queries. Thank you so much, my dear friends. Take care. All the very best. Wish you all the very best. Thank you so much. Shiva Teja signing off. Thank you so much. Miss you all, my dear friends. Thank you. Thank you so much. Bye-bye.
Now, moving on to the next case study number 5. In the year 1918, when the world witnessed the worst pandemic ever in the history of mankind. So this is something similar to COVID, what had happened 100 years back. This is an actual incident. It took world 4 years to get back to normal, but the pandemic left it with memories of pain and devastation. So these are all introductory, these are what you call, these are more of grammatical or literature part, which is not relevant for our questions. Okay. One such case, so basically hospitality sector and all that I mentioned, there is a villas thing. Out of all the offers they have been getting, they have come down to 3 options and want to discuss them. Option number 1, Naman Hotel has shown interest in acquiring this resort property. So basically you can figure out that there is a resort villas, the company. Naman Hotels want to acquire them. The business combination can be carried out by setting up a new entity called Anupama Villas Private Limited that will issue 50 shares to Anupama and 100 shares to Naman Hotels Private Limited. So basically, you have this thing. Similar question we have already covered, where we have date of agreement, appointment date of shareholder agreement, obtaining control, and date of transfer of shares. So multiple dates are there. There will be one MCQ which will say what is the effective date of control. Second, another company, Kavya Hotel, from a different state wants to acquire Anupama Hotels Limited to take charge of resort property. With its managing director, Ms. Kavya, having confidence of pulling the property out of economic losses using her vast experience. So that is the second part. So here what they have said. The head accountant tells them that their group statement of P&L for the previous year ended shows a profit of 150 lakhs up doing so and so thing. After submitting a report on their financial performance, Kavya Group works out on the acquisition plan of the villas. It will acquire 80% of the equity in exchange for cash of 300. Due to legal compulsion, they will have to dispose of their investment by a specified date, such that they will not have sufficient time to market their property to multiple potential buyers. The management of Kavya Limited initially measures separately recognizable identifiable asset and the liabilities assumed as on the acquisition date in accordance with the requirement of Ind AS. Identifiable asset 600, liabilities 200. Kavya engages independent consultant who determined the fair value of 20% non-controlling interest is 84 lakhs. Kavya Limited reviewed the procedures it used to identify and measure the assets acquired and liabilities assumed to measure the fair value of both NCI in Anupama and the consideration transferred. It decided that the procedures resulting measures are appropriate, and we waited for approval from the end of Anupama Hotels to move. So now here what has happened is, in the second option what has happened is a very elaborated or a very long description. Kavya from a different state wants to acquire Anupama Hotels. So they want to acquire Anupama Hotels. Now, the details of the dealings have been given. Again, everything may not be relevant from the questions point of view. Third, management of Anupama Hotels want you to carry out special audit of the controls implemented in their property and suggest them solutions to improve any deficiency in controls or any management incompetencies which might need improvement or replacement to bring back good old days. The company could ask its financiers for a corporate restructuring based on an audit report. You suggest them about risk-based audit and deliberate them about the process of this audit on their request. You tell them that your audit would be risk-based focus areas of greatest risk. RBA is an approach to audit that analyzes audit risk, sets materiality threshold, on audit risk analysis, develops audit programs. So basically, what is this reflecting to? We have to identify what is the risk, and based on those risks, we have to carry out the audit. Right now, there is some discussion between Komal, Sagar, Ritu, and all of those things. So let us come up with the multiple choice question, and depending on what is the requirement we need to pull it out from the case study, accordingly we will do it. Which of the following is an indicator of possible potential misstatement with respect to recording, as could be identified by you while carrying out the specific audit of hotels? So what are they saying? Potential misstatement, right? Now this again, if you look at the question, even without looking at the case, even without looking at the case, you will be in a position to figure out what is the correct answer. Okay, because source documents captured inaccurately, source documents not captured, source documents overstated, rejected source documents are not presented. So source documents means what? Source document means something like your invoices. Okay, invoices are your source documents. Now, indicator of possible potential misstatement. Basically meaning where we can see that which one of these can indicate that there is a possible misstatement with respect to recording. Okay, so you are carrying out a special audit and we are talking about what? With respect to recording. So source documents captured inaccurately, there is a recording issue. Source document not captured. See, when you are not captured, you cannot check the recording part. Source documents overstated. There is nothing called source documents being overstated. Rejected source documents are not presented. Again, rejected source documents you have not recorded. So specifically with respect to recording, source documents captured inaccurately is the appropriate answer. So here, even without looking at such a long case study, we were able to get to the answer. Which two account balances are most likely to be affected by the wrongdoings found by Komal while auditing the expense of the restaurant? Now here, you have to go back and see what Komal has got. Komal, during the process of extracting the exception reports in the restaurant, she observes numerous purchase entries without valid purchase orders. So no PO. In terms of percentage, about 30% of the purchases were made without valid purchase order and few purchase orders were validated after the actual purchase. Now, purchase order we have to issue before you purchase the item or before you receive the item. So here, purchases, there is a problem. Also, there was no reconciliation between the goods received and the goods ordered. So, you might have ordered, let us say, 100. You would have received 80. There is no reconciliation of that. So, that is another problem. Okay. Then, she proceeds ahead to check the validity of purchases at the account balance level and follows specific audit procedures. She is told that resort has tied up with hard coupons which sells coupons to general public that are redeemable against luxury food products. Each coupon is sold for 900 but is redeemable for 1000. See notices, working capital block relating to GST ITC. During the current year, they have been awarded a contract for catering in a marriage at Dehradun. So this is something related to ITC. Now here, the question is saying, or if you look at our observation, what is being impacted? One is purchases is being impacted. If my purchase is being impacted, my supplier account will also be impacted. So if you look at the options, it says sales invoices. No, this is not there. Inventory and accounts payable. Opening and closing stocks only. This is not correct because it will impact the account payable also. Purchases and account payable. So, inventory, you can still control by physical verification. You can still carry out a physical verification and control inventory. But purchases, you cannot control. So, option D is the correct answer. Okay. Why not inventory? Because inventory by using physical stock check, you can still figure out whether inventory is correct or not. But purchases, because PO and all are not issued appropriately, that can become a challenge. Then value as per GST. Suppose Anupama Hotel strikes a deal with Naman Hotels. Now, see this. They gave us 3 options. Now, when they gave us 3 options, had we spent a lot of time in going through all the 3 options, here the question is only about Anupama Hotels and Naman Hotels. What is that? Anupama Hotels and Naman Hotels. Now, when Anupama Hotels and Naman Hotels, you have struck a deal with both these parties. Which of the statements? So statement 2 are there. In this case, acquirer will be Anupama Hotels and not Naman Hotels. 1st July will be considered as the acquisition date. Now the question is whether both the statements are correct, whether both the statements are incorrect. Basically, which statement is correct, which statement is not correct. So what are we talking about? Anupama strikes a deal with Naman Hotels and 1st of July will be considered as the acquisition date. Right. So coming back, Naman Hotels has shown interest and they will form a new entity. Now here if you see, they will issue 50 shares to Anupama and 100 shares to Naman Hotels. Right? So if 50 shares is being issued to Anupama and 100 shares is being issued to Naman Hotels, who is my accounting acquirer? My accounting acquirer will be Naman because Naman has control over the entity. So Naman will be the accounting acquirer. Then what is the date of acquisition? Not the shareholder agreement, not the appointed date. When did we actually obtain control? 1st of July. So acquirer will be Anupama. No, Naman Hotels will be the acquirer because they have 100 out of 150. So statement 1 is incorrect. Statement 2 is correct. So statement 1 is incorrect. Statement 2 is correct. Option C is the correct answer. Okay. Then calculate the gain or loss Kavya Hotels will make on acquisition of Anupama Hotels if the deal is finalized. Show the journal entries for accounting of this acquisition. Also calculate the value of non-controlling interest in Anupama Hotels based on proportionate interest method if alternatively applied. So slightly elaborate question. Right? What are they saying? Calculate the gain or loss Kavya Hotels will make on acquisition of Anupama Hotels. So this is with respect to Kavya. Now, what is the Kavya's case? Kavya from a different states want to acquire Anupama Hotels to take charge of resort property with its MD, Miss Kavya, having confidence, so they will pull it over. They have asked management to put forward financial details of their performance. All of that is fine. Right. Now, what they have said, after submitting the report, Kavya Group works out on the acquisition plan of the villas. It will acquire 80%. It will acquire 80% of equity interest in Anupama Limited in exchange for cash of 300. So 300 is what will be paid. That is the consideration that will be paid. Okay, that's the first thing. Then, due to legal compulsion, Anupama Hotel Limited will have to dispose of their investment, so that is not relevant. Management initially measures the separately recognizable, identifiable asset and liabilities. Asset is 600, liability is 200. So, fair value of net asset is 400. 84 lakhs is the non-controlling interest. So, consideration is 300. Non-controlling interest is 84. So, total is 384. Now, what you have acquired? You have acquired assets worth 400. You have paid only 384, which means you got more assets. If you got more assets, 400 minus 384, 16 is your gain. And this gain will be recognized in the capital reserve. Now, how will we pass the entry? Very simple. When you pass the entry, you will debit identifiable assets 600, right? Then you will credit liabilities 200. You will credit cash 300. You will credit non-controlling interest 84, and you will credit capital reserve 16. So identifiable assets debit, all of these to credit. Okay, that is how we will pass the journal entry. Now, this capital reserve will be recorded in other comprehensive income under OCI. Right. Now, the next part of the question says, if you do proportionate of net assets method. So if proportionate of net asset method is followed, then NCI is equal to 20% of net asset. Net asset is 600 minus 200, 400. So NCI will be 80. So if NCI will be 80, this number will be 20. That's the only difference. Okay, very simple. So you see, almost in all the case studies, we have, alternate case studies, we have questions on business combination. So business combination and consolidation. If you practice them thoroughly, it will really, really help you in the examination. Then they gave a lot of literature on audit. Now let's look at the question. Auditors are required to assess the risk of material misstatement at two levels. Briefly explain the same and state the procedures to be followed by Komal regarding validity of account balances relating to purchases while auditing the controls in the restaurants of Anupama Hotel. Now, material misstatements. What is a misstatement? Misstatement is a mistake or an incorrect, item. Right? What has to be presented versus what is presented, that is called a misstatement. Now, misstatements are auditors are required to assess the risk of material misstatements at two levels. Briefly explain the same. Now, you have to look at the misstatements at the overall financial statement level or overall materiality level, you see. And the second one, you have to see them at assertion level or class of account balances and transaction level. So, at two levels, you will have to see the misstatement. One is at the financial statement level. At the overall financial statement level, what is the misstatement? That is what you have to see. Second is for specific transaction account balances assertion level, what is the misstatement you have to see. So at these two levels, you have to do. That is the first thing. Okay. Then state the procedures to be followed by Komal regarding validity of account balances relating to the purchases while auditing the controls in the restaurants of Anupama hotels. Right now, what are we required to do? Validity of account balances. Now, how will we check the account balances? We will check the account balances maybe by getting the vendor confirmation, right? Then you will maybe look at the purchase process. What is the purchase order process? Then what is the statement of account submitted by the vendors? Okay, what is the balance confirmation received from the vendors? What is the subsequent payment made to the vendors? Right. So like that, how will you audit specifically the account balances relating to the purchases? So basically, your purchase account and also maybe the payable account, how will you reconcile? Because in a lot of cases, purchase orders were issued after the purchase or purchase orders were not issued, they were incorrect. So purchase account balance is incorrect. So when purchase account balance is incorrect, what are the steps you will take? You will review the purchase process, you will review the purchase orders, you will review the vendor statements of account, you will take confirmation from vendors. By that, by carrying out these procedures, you will be able to understand that yes, the purchase ledger balance is appropriate. So let us look at the solution. Select purchases, review correspondence with the vendors, purchase requisition and reconciliation of their accounts. Review vendor listing along with aging details. Aging details means how long it has been we have not paid. Follow up material amounts paid before the normal credit period and analyze the reason for the same. Meet with company PO and obtain responses to the inquiries regarding purchase made without purchase order. Discuss the summary of issues with the client. You can also get, balance confirmation. Now you may ask, sir, for purchases, why do we need balance confirmation? You need balance confirmation because if the purchase order is not proper and if the vendor is showing some other balance and we are showing some other balance, then that is a problem. See, it could be a case where we have, said that we have purchased something, but actually this was never purchased. Okay, we never purchased the item. Just in the system, we have passed the entry and we have showed a payment entry, whereas the vendor has not, received the payment. So when we do the reconciliation, that is when you will realize that no such things exist. So you can add more procedures to this based on your own audit experience, like balance confirmation with the vendors, aging analysis of the vendors. Okay, any dispute with the vendors. Then a physical stock take will also help you understand whether purchases are recorded properly or not. Okay, so all of those things you can carry out. Moving to the next case study. CA Parminder Kaur is a qualified CA 3 years back and has set up her own practice in Jalandhar. Major expertise is in consultancy. Something similar. So all these backgrounds are somehow, somewhere or the other similar, right? So again, let's go to the question. Referring to the provision of FEMA, this is to do with the law. Again, FEMA law. It determines the value of impairment loss in foreign currency with respect to Medfix and whether it should be recognized in the books by Simraj Private Limited. So here we have to see what is the impairment loss with respect to Medfix, right? So let us come back. What's the name of the client? Simraj Private Limited. Okay. Simraj Private Limited. So here it is SIMCO, Simran Construction, SIMCO, Raj Pharma's Aegis India counterpart, Simraj Private Limited, requires high-tech machinery manufacturing. So here is the case. Okay, so no need to waste time. Just by looking at the first two lines, you'll be able to figure out where to get the relevant information from. Raj Pharma's Aegis India counterpart, Simraj Private Limited, required high-tech machinery manufacturing to be purchased from Cambridge, UK. For importing such machinery, Raj contacted one of his friends in Cambridge, who runs a company by the name of Medico Inc., a London-based company having several businesses across the world. It has a unit for manufacturing pharma machineries in New Delhi. It has a branch in Dubai, which is controlled by New Delhi. Medfix being not available with Medico, Raj's friend helped Cambridge him to procure the machinery from another company in Frankfurt, Germany, known to him. Foreign currency asset amounting to euro 100,000 is recorded by Simraj as non-monetary item at the date of purchase when the exchange rate was 52. So 100,000 into 52 or 1 lakh into 52, 52 lakhs. The recoverable amount of the asset on the reporting date is calculated to be 85,000. The exchange rate on the date of valuation was rupees 60. So this is 60, right? So 85,000 into 60, if I do, I get 51 lakhs. The exchange rate on the date of valuation was rupees 60 to a euro, and carrying amount of metrics recorded accordingly as per relevant in days is 51 lakhs. Okay. Now here, what is the question? The question is, determine whether value of impairment loss in foreign currency with respect to Medfix and whether value of impairment loss in foreign currency with respect to Medfix and whether it should be recognized in the books by Simraj Private Limited, right? That is the question. Now, what is the foreign currency value? Foreign currency value, if you see, it was 100,000 that is recorded. Okay. It's a non-monetary item. It is an item of machinery PPE, right? The recoverable amount on the date is 85,000. So 85,000, if you see, 100,000 is the carrying amount, 85,000 is the fair value. So you have a loss of 15,000. Now here, the question is not complete because you have to see whether there is depreciation to be charged. So that depreciation they have not given. Okay. So that is one thing you have to consider. So that part is not given. So we'll assume there is no depreciation. Then euro 15,000. So what is the question? Impairment loss in foreign currency is 15,000 euro. Okay. 15,000 euro. Now, whether we will recognize loss of 15,000 as impairment, assuming that 85,000 is the recoverable amount and assuming that 100,000 is not depreciated. See, if it is depreciated, the numbers will become very different. They have not given us information on depreciation. They have just asked impairment loss in foreign currency. So 15,000 is the loss. Will we recognize this loss? No, because our actual loss is 1 lakh. Our actual loss is 1 lakh. Now, what is the question asking? Impairment loss in foreign currency. So it has to be 15,000. Should we recognize 15,000 as loss? We will not recognize that. We will multiply it and arrive at the Indian numbers and then we'll recognize the loss. We are not making adjustment. Please understand, this is a non-monetary item as rightly pointed out. We are not making adjustment. We are calculating the recoverable amount. When we are calculating the recoverable amount, because this machinery has quote in US or not in US, in euro, we are considering 85,000 euro multiplied by relevant exchange rate. This is not restatement. This is calculating recoverable amount only because that machine is not available in India. If that machine is available in India, we may calculate recoverable value as per the Indian reports. Okay, that is how it is to be understood. Then, In entities P consolidated financial statement, can the perpetual debt be considered in accordance with Ind AS a monetary item for which settlement is neither planned nor likely to occur in the foreseeable future? That is part of P's net investment in Q. With the exchange gains and losses on the perpetual debt therefore being recorded in equity, entities P functional currency is INR, Q's functional currency is Euro. So we need some more clarity on this. Entity P and Q. So here if you see, in this case, Raj and Simran made several trips to India. Okay. One day over a dinner table, they discuss something. Okay, fine. So if we keep on moving forward, here you see, she tells Raj that one of her father's business set up in India by the name entity P, whose functional currency is rupee, has a foreign operation entity Q, with euro as its functional foreign currency. Entity Q issued entity P a perpetual debt. Now, this perpetual debt forms part of your long-term investment, right? So net investment part, with annual interest of 6%. Perpetual debt has no issuer call option or holder put option, means it will not be redeemed. Thus, contractually, it is just an infinite stream of interest payment in euro. Right? So, this is the contract or this is the transaction, right? Now, it is a debt. Debt is a monetary item. It is a monetary item. And the nature of this monetary item, because there is no redemption, it will not be repaid. The nature is equity. Because there is no redemption thing available. Okay. So whatever is the net investment in foreign operation, right? When we report this, this will form part of my monetary items as per Ind AS 21. And whatever is the gain or loss, because it is related to net investment, I will show it under equity. Okay. Very simple and straightforward. So what are the options? Perpetual debt can be considered monetary item. Related gains should not be recognized. Wrong. Perpetual debt should not be considered as monetary items. Wrong. Perpetual debt can be considered as monetary item. Related gains and losses should be recorded in equity. Why in equity? Because it is perpetual debt. You cannot take it to P&L. So option C is the correct answer. Sorry. Can INR be presumed as the functional currency for SIMCO? No. It is monetary, non-monetary is not long-term, short-term. Long-term, short-term is for current, non-current. Monetary item is item that is made, so amount which is determinable in money. Long-term loan is a monetary item because the amount of monetary value is fixed. So because it is debt, the amount that will be repaid ultimately when it is settled, that is fixed, and hence it is a monetary item. Clear? Can INR be presumed as the functional currency for SIMCO since it is located in India? Now, please understand functional currency. I'll go back to the discussion under Ind AS 1. First, let us have a look at what this SIMCO is all about. Simran, one of the biggest construction projects was being executed in India at Amritsar through Sim Contractors Private Limited, known as SIMCO, which is a foreign operation of Simran Constructions GmbH, primarily set up to execute projects in India. Functional currency of Simran Construction GmbH is euros. 70% of SIMCO's finances have been raised in USD by way of contribution from Simran Construction. Bank accounts are maintained in USD. Cash flows are generated by it are transferred to the German company on a monthly basis in USD. In respect of repayment of finance received from the German company, revenues are in USD. Competitors are globally based. Tendering happened in USD. 80% cost in INR, 20% cost in USD. So apart from cost, all other factors, all other parameters are in USD. Everything is happening in USD. So can we say that it is INR as the functional currency? We cannot say INR is the functional currency. So let us just quickly have a look at this Ind AS 21. So factors to be considered for determination of functional currency of an entity. If the entity is a foreign operation, why it is a foreign operation? Because holding company is somewhere outside, the subsidiary company is here. So you have to determine whether the functional currency of foreign operation is the same that of the reporting entity. So that is the first thing. Additional things you have to see whether it is autonomous, then what is the volume of transaction, check whether volume degree of transactions with the reporting entity, cash flows, debt servicing. Also, Primary indicator, what influences the sales price, competitive forces, what influences cost, funding, currency in which retains are retained. So almost everything here is in USD. Almost everything here is in USD except cost. So majorly, if you see, lastly, if you see, these are in the currency of USD. Hence, INR cannot be considered to be functional currency of this entity. Okay, so if it's a foreign operation, additional consideration, whether it is an extension of the existing the foreign company, whether it is autonomous. Okay, what is the volume of transaction? All of these things we have to see, and then accordingly we'll have to decide it. So here, apart from the cost, everything else is in USD. Hence, we cannot consider that the INR will be the functional currency. USD will have to be the functional currency. Okay. So that is with respect to the next question.
Okay. You all are with me? Write a yes in the chat box. Tell me, are you with me? Yes. Okay. Good. Very good. Okay, so now we are going to go to case study number 5, which is very, very easy. Only one MCQ we have in this case study. Okay, so we're going to refer to that case study. Let's read the question. All right. So question number 4, considering the transaction with Mr. D, one of the directors of the company, which of the following statement is most appropriate? Okay, now reading this question, we don't know. We can't be going on reading these 4 options. What is this saying? I don't know. So see, here the question is talking about Mr. D. We don't know the context of this whole question. So we can directly go find Mr. D in the question and we'll see what this is about. See, considering the transaction with Mr. D, one of the directors, which of the following? So there is some transaction which is happening with Mr. D. What is this transaction? Let's go to the case study and see. Okay. So I'm going to read the relevant part, which talks about Mr. D. It's very easy to locate Mr. D in the answer. 1 second. Just a second. Just give me a second. Okay. So ABCD Limited wants to expand its business and the management has found a suitable site which meets the requirement. Okay, so this particular company wants to expand its business and they have a particular location in mind that they want to buy. The said site is owned by one of the directors, Mr. D. However, Mr. D is unwilling to sell this property to the company. The company, however, offers him in exchange a bigger site located in that area having commercial potential. Lured by this offer, Mr. D agrees for the above. The property valuer, who is a civil engineer by profession, who is having an experience of 20 years in valuing properties for commercial banks, is also approached by the company to arrive at the value of the asset. The valuer does not possess any other registration or okay, this is difficult to pronounce this word, but okay, he does not have any registration. That is the relevant part for us. So what this question is saying is that, see, ABCD Limited, they want to expand the business. They have one land or one site in mind, but this particular property is held by Mr. D. Who is Mr. D? Mr. D is one of so let's continue reading. See what happens. So D agrees to exchange the properties. There is no cash transaction that is happening. They're exchanging properties. So what is happening? The company is doing non-cash transaction with one of the directors of the company. Now, in this case, what happens? This particular property which is exchanged, there is valuation done. There is a valuer who's hired. But this valuer does not have any registration, does not have any required registrations. Okay, so these are the facts of the case. Now, what does our question say? Question says that considering the transaction of Mr. D, one of the directors, which of the following statement is most appropriate? Before we read any of these options, let's try to understand the provision. Relevant provision here is section 192, which talks about non-cash transactions with the director. So I'll explain these provisions, then you can select the correct answer yourself. Okay. So what does section number 192 say? 192 say that no company shall enter into any arrangement by which director of the company, holding, subsidiary, associate, or person associated with him, etc., for consideration other than cash, or company acquires the asset from such person for consideration other than cash, unless a prior approval is taken in the general meeting. Okay, so what does it say? With a director of the company, holding, subsidiary, associate, or related person, if the company wants to do non-cash transactions, okay, barter transaction without exchange of cash, then can be done, but prior approval has to be taken in the general meeting. That's first condition. More conditions are mentioned, but I'm only referring to relevant conditions. Now see, when this general meeting is called, in which the prior approval is taken, in the notice of the general meeting, the company has to mention the particulars. What will be the value of the asset? What will be the use of the asset, etc. The value of the asset has to be given along with the report by the registered valuer. So in the notice of the general meeting, we have to attach a valuation of the asset which is done by a registered valuer. Now, what is a registered valuer? Okay, what is a registered valuer? That is given in our section number 247, which says registered valuer means someone who's registered under the Insolvency and Bankruptcy Board of India. Okay, so you've understood this is a requirement if the company wants to do non-cash transaction with any of its directors. Now, based on this, we have to select the correct option. With regard to transaction with Mr. D, which of the following option is correct? Let's start reading one by one. The transaction with Mr. D is permissible subject to certain conditions laid down by the Companies Act. However, the company is not acting in accordance with the law by approaching a valuer registered to in the description. Such valuer needs to be registered by the Institute of Actuaries of India. No, such valuer need not be registered by the Institute of Actuaries. He has to be registered by the Insolvency and Bankruptcy Board of India. Okay, let's read. So this one is wrong option. Let's read the second option. The transactions with Mr. D is permissible subject to certain conditions laid down in the Companies Act. They're not even mentioning the conditions. They're just saying as per Companies Act, it's possible. The company is acting in accordance with law by approaching a valuer referred in this description. So company is not acting in accordance with law because the valuer, see in this facts of the case, what was mentioned, that particular valuer was a civil engineer. He was not registered anywhere. So that kind of valuer cannot help us here. No, we need a valuer who is registered under the Insolvency and Bankruptcy Code. So let's read the next option. The transaction with Mr. D is permissible subject to certain conditions laid down by the Companies Act. However, the company is not acting in accordance with law by approaching a valuer referred to in the description. Such valuer needs to be registered under the Insolvency and Bankruptcy Board of India to act as a valuer. This looks like the right answer, but we are still going to read the option. The transaction with Mr. D is permissible subject to certain conditions laid down in the Companies Act. However, the company is not acting in accordance with the law by approaching the valuer referred in this description. Such a valuer needs registration by the Institute of Engineers India. So this is wrong. Okay, so our correct option here is C. Okay, so with this, we have completed this last case study that we are going to be discussing. Okay, how, like, you were able to understand? Are you able to understand? Yes, no, yes, no, yes. Okay. Okay. Okay, very good. So, okay, now how was the session? Do you have any doubts in the session from today? Were you able to understand? See, my approach was I wanted to ensure that even if, let's say, you have not studied the provision or if you don't remember the provision, you should be able to study, understand the provision, and then accordingly, get to the answer yourself. So that was my idea. Was it successful? Were you able to understand the provisions and the solutions? If you need me to change the approach in any way, let me know. Or if you have any doubts, let me know. Let's talk about it. When will we have access to the summary material? So this I'll be discussing it with the team and most likely we'll make it available to you as soon as possible. Okay. Deepika, no? So Deepika will update you on this. Okay, Mohak is saying it was fine, it was good. Chalo, nice. If you have any feedbacks, no, if you want me to change the way of teaching or something like that, please let me know. So we can change that approach. We were able to cover 5 case studies today, which is like awesome. Okay, Deepika is saying this approach is fine. Chalo, nice. See, for company law, you need to have the list of sections. You need to know what is in the section. You need to have idea of what is covered in the section. Then only, you'll be able to pinpoint, okay, this section has this point. It's like, it should not happen that in the exam, it's the first time you are opening the subject. Please, if you go like this, it will be a bad approach. You should have read the section once. If you want more practice, no, I would love for you to study the past exam questions also, chapter wise. Just read the provisions and then just look at the past exam questions, because most of the questions, I'm noticing they are from past exam only. It's just that they've combined together. So separately also you can practice. For tax, you practice past exam questions separately, studied separately. For law also you've studied separately, study the past exam questions separately. Combined together, you'll be able to solve these papers. Okay. Yeah, so Sai Praveen Reddy, we'll be trying to do that. We'll try to do that. We are providing summary notes already. The thing is that for Companies Act, no, there are 2 possible options. We can either compile the whole 470 sections together in summary form, or you can simply carry a reckoner. Okay, so the summary that we are providing, it has got list of sections, list of these performers, list of form numbers, because many times the form numbers are coming, list of deadlines, date, time limits, those kind of lists will be available to you. See, index for what? Ramamurthy is saying index, but index for what? See, you can create index for this case study bundle also. Many people are providing that. But it's not, I don't think there is a use for creating an index for these list of case studies. Okay. So, see, summary notes, regarding summary notes, I'll update the team. They'll provide you the summary notes. Let us know if you want some changes or anything like that. Okay. Chalo. Now, in today's session, did you have any doubt? Or we can close the session? What do you say? Do we have any more questions? If not, then all right. So I take extra class complete before 10th April. We'll try to do that. We'll try to do that. I'll try to take as many cases as possible. See, the number of cases we discussed today, no, they'll be covering up for the other subjects also in the upcoming week. So I'll try to do it as much as I can. Okay. Chalo, theek hai. So I'll be seeing you very, very soon, and study well. Okay.
Now we'll move to the next case study. Case study number 5, ABCD Textile Manufacturing Company based in Gujarat, more than 50 years. Again, he remains in constant touch with CA Nitin Garg and keeps discussing the legal compliances. Rahul knows the complexities in business have increased for GST. So this paragraph is about GST. ABCD Limited wants to expand its business and management has found a suitable site. Okay. Then Rahul to expand the business. So see, the thing that you need to understand as we're discussing this case study is some of the pointers in the case study is purely a business or management commentary. Introduction of the business, what they are doing, their friends are there, they came from US, they are going to US, they paid money to someone. So all of that, so you need to be trained. So you have to train your mind saying that this information may not be relevant for my case. So let me drop it. So you have to basically filter that out. Okay. So coming to the questions directly. Which of the following is responsible for IEC code? Direct question. What should CA Nitin advise CA critics to do when the later is stuck in the revision dilemma of materiality levels set earlier? So there is some discussion on materiality levels. We'll go back to the question and we'll understand that. Statement on GST is there. Then question on directors is there. Then here, provide the accounting treatment with respect to transaction between ABCD Limited and PQRS Limited in their respective books of account and show its impact on the consolidated financial statement. Support your answer by journal entries, and following is the information available. So now what we'll do is two things. One is materiality level of the transaction, that is the previous one. But before that, we'll complete this part related to NDS foreign exchange. How do we do the accounting for it? Right. Now, two things you have to keep in mind. One is, two things you have to keep in mind. One is, there is something called as transaction. There is something called as translation. Okay. Now, whenever you account for a foreign currency transaction, you will use transaction date. Then, monetary items, you will restate. Non-monetary items, you will not restate. This is a summary of it. Now, let us come back to the case and see what is the transaction between ABCD and PQRS. So, here, so they talk about ABC. So, now you might be wondering, sir, how do we know which paragraph to go to? So, what you have to do is, this is the introduction. So, here you will not get much information. Here, it is talking about complexities of GST. So, till here, if you see, he has been discussing about GST. So, this paragraph is only about GST. They want to expand its business and they have found a suitable site. The site is owned by directors. And, there is something about valuation and all. Okay. Then, Rahul, to expand its business, also discusses with Nitin on setting up a subsidiary outside India at Paris for specifically carrying out import and export transaction. And soon they set up a subsidiary by the name PQRS Limited. So PQRS Limited is the subsidiary. ABC Limited is the parent. ABC is engaged in the business of manufacturing clothes for textile and other companies. And if you see here, towards this end, you see, Euro is the functional currency of PQRS, while Indian rupee is the functional currency of ABCD Limited. So, this paragraph is where we have to see the details for our given question. ABCD Limited is engaged in the business of manufacturing cloth. Now, the company will be itself carrying out the import-export transaction without involving any third party. It applies for IEC. This is customs-related thing. Its wholly owned subsidiary is engaged in the business of ready-made garments. The subsidiary purchases garments and other stuff from its parent company. The demand for garments of PQRS is very high, and hence to cater this shortfall, PQRS also purchased from other company. Now, all of this information has nothing to do with the accounting part. Purchases are made at competitive prices. So basically, this is to say the related party aspect. During the year, ABCD sold garments to PQRS Limited for 13 lakhs euro. So, please we'll make a note of it. PQRS, sorry, who sold? ABCD sold. ABCD sold to PQRS 13 lakhs euro. Now, these kind of notings you can do on the rough page available towards the end of your answer book. Okay. The cost of this garment was 936 lakhs. Okay. At the year end, all these garments were lying as closing stock in PQRS Limited. So this 936 lakhs, whatever is there, it is there as closing stock in PQRS Limited. Euro is the functional currency of PQRS. So PQRS has Euro as the functional currency. ABCD has INR as the functional currency. Functional currency is the currency of primary economic environment in which the entity operates. Okay. Now, the question is, provide the accounting treatment. So we are expected to provide accounting treatment, give journal entries if applicable. So if required, you have to provide the journal entries also. For what? For the transactions between these two entities in the respective books of account and also consolidated financial statements. Now, always remember the entity has to record transactions in its books in its functional currency. So you will always follow functional currency. Means PQRS will report in euros, ABCD will report in INR. PQRS will report in euro, ABCD will report in INR. That is how the accounting will be done. That is the first aspect. Okay. Then the second thing that we need to understand is what will happen. What will happen in case of consolidated financial statement. Now, when you talk about consolidated financial statement, these are intercompany transactions. Intercompany transactions have to be eliminated. The receivable, the payable, the sales, the purchases, that has to be eliminated. And inventory has to be shown by the parent entity. So that is what will happen in the consolidated financial statement. Okay. So now, let us see how will we do the accounting. As far as AB and also exchange rate on 1st of January and 31st of March is given. So exchange rate is given. 1st of January date of sale, which is 83 and 85. Now, how will we do the accounting? First, sale by ABCD will be recorded at exchange rate of 83. Okay. So, sale value is 13 lakhs multiplied by 83. That is 13 into 83, which gives us 1079 lakhs of sale that will be recorded. Okay. So, this one. What is the entry to record the sale? Sir, why are you asking us foundation questions? What is the entry to record this sale? What will you debit and what will you credit? Journal entry. What is the journal entry? Debtor to sale. Okay. So, debtor is PQRS. PQRS limited debit to sales. How much? 1079 and 1079. Okay. Then that is the first part. Okay. What is that? That is as far as the sale is concerned. Now, they have not told us whether the amount is outstanding or not. So we can assume either ways. Because information on 31st March is given, we will assume amount is outstanding. Now, PQRS Limited is my customer or is my account receivable. Is that a monetary item or a non-monetary item? PQRS Limited, my receivable, is that a monetary item or a non-monetary item? Monetary. And monetary item has to be restated. So, PQRS restated value on 31st March will be 13 lakhs multiplied by the rate that we need to consider is 85, which is 1105. Now, please understand, I had to receive 1079. Now, I'm saying we'll receive 1105. So, there is an exchange gain of 1105 minus 1079, that is 26. So, this also we have to record PQRS debit 26 to exchange gain 26, because I will receive higher amount from the customer. Okay, that is one thing. Then what will be the accounting treatment? So this is in the accounting treatment of ABCD. Accounting in PQRS. PQRS will say purchases debit 13 lakhs euro to ABCD Limited 13 lakhs because they have to record in euro and the billing has happened in euro itself. So they will record euro 13 lakhs, right? That is one thing. Now this entire purchases is there. So inventory as on 31st of March will be 13 lakhs euro. This is in standalone books of the entity. Okay, standalone books. Now we don't have the information on net realizable value and all. So we'll consider the cost itself is the net realizable value, and then that is how we will show in the stock in the books of your PQRS Limited. Okay. Now in the consolidated financial statement, what you have to see in the subsidiary book, inventory is there in PQRS. If inventory is there in PQRS, the value at 13 lakhs euro, in INR terms, it will be multiplied by 85. So INR value will be 85 into 13, which is 1105. So inventory, when you're trying to consolidate, it will be converted to 1105. But please understand, when you're preparing consolidated financial statement, we have to see what is the cost to the group. What is the cost to the group? So what is the cost to the group? What I have to understand is, if you come back to the question, the cost of these garments is 936 lakhs. So if the cost of the garments is 936 lakhs, in the consolidated financial statement, I will show the inventory at 936 lakhs only. So inventory in books or in consolidated financial statement will be shown at cost to group or NRV, whichever is lower. So cost to group is how much? 936. So 936 is the cost to group, and hence you will show inventory at 936 only. Okay. Now that is one aspect. Second aspect is the intercompany sale, intercompany purchases, all of that will be eliminated, and only this cost will be shown in the balance sheet. Sir, what happens to the profit? We sold at how much? We sold at 1079. Okay. Now that sale also will eliminate. And again, we will show inventory of 936. So profit 1079 minus 936. If you do this 143, this profit also will be eliminated because this is an intercompany transaction within the same group and it is an unrealized profit. So that is how you will eliminate. Okay. So what you will do is you will debit consolidated P&L by 143 and you will credit inventory by 143, and hence that the unrealized profit from the inventory will be eliminated. Is that clear? Now you might be thinking, sir, what did we do with here? See, this PQRS will record sales. Sorry, ABCD will record sales at what? 1079. This sales and corresponding purchase will be eliminated. Sales of 1079, corresponding purchases of 13 lakhs, that will be eliminated. Okay. And while valuing inventory, we will see what is the cost to the group and what is our profit, what is our, the value at which the NRV has to be stated. And when you compare that, lower will be considered. Okay. Another way to look at it is on date of sale, purchase price for subsidiary is 13 lakhs into 83, 1079. Cost is 956. So we'll always measure at lower of cost or net realizable value. Okay. So that is how we'll do the accounting for. right? Then there is an MCQ here, which is on materiality. So for that, let us see what is the background given. During the year, they find difficult with GST, so that is related to taxation. They imported from Paris and filed ex-bond bill of entry, customs. Statutory audit of the company is also being carried out by Nitin Garg and Company. See, now one thing is, who is Nitin Garg and Company? Nitin Garg and Company is partner of Nitin Garg is partner of Nitin Garg and Company, and that is with whom they keep on discussing. Okay, so there is no independence angle as such. So coming back, the statutory audit of the company ABC Limited is carried by Nitin Garg, supervision of engagement partner Krit Garg. CA Krit understands that as the auditor, he should develop an audit plan and shall include a description of procedures to be performed as per 315 and 330. Okay. Audit plan is more detailed than the overall audit strategy that includes the NTE, nature, timing, and extent. So here, this, I think you remember this, nature, timing, and extent of audit procedures to be performed by the team members. Planning for these audit procedures takes place over the course of the audit as the audit plan for the engagement develops. He asks Mega in his audit team to work on planning the NTE of the specific further audit procedures and Saurav on planning of risk assessment process. So Mega is given the NTE of audit procedures. Saurav will do the RAP or the risk assessment procedures. CA Krit knows that the overall audit strategy and plan should take into consideration the element of, so much of background is given, question is on materiality and its relationship with risk and procedures to be adopted. CA Krit has already developed an audit strategy, and while a detailed plan is being developed, he decides that materiality levels set earlier needs to be lowered as weakness in the internal controls were highlighted in the internal audit report. Subsequently, a deviation from the audit strategy is felt necessary, and he's stuck in a dilemma as to what to do first. Modify the strategy and revise the plan, or vice versa, and seeks CA Nitin's suggestion. Now, one thing that you have to understand is materiality level. Whenever we say, when we are lowering the materiality, now what does that mean? Let us say, if my materiality level is 1 lakh, this means anything below 1 lakh, that I'll keep aside, that I'll not ignore. If the misstatement is less than 1 lakh, I'll ignore it. Of course, I will aggregate all the misstatements and see subsequently. But if it is less than 1 lakh, I will not check that. But then, if I say my materiality level is only 10,000, means what? Anything above 10,000 will catch my attention. So I will be checking more. Why am I checking more? Here the question says the internal control, the internal audit has flagged deficiency in internal control. So that is the linkage between materiality levels and the extent of audit you carry out. Now, ultimately, what is the objective? To bring the overall risk of materiality, material misstatement to an acceptable low level, right? So you have inherent risk, you have control risk, you have detection risk. All of that, we have to bring it down to an acceptable level. So your materiality level should change according to the risk that you have assessed. So here, there is a problem in the internal control system, means there is a higher risk. So you have to do more checking. That's why you have to lower the materiality level. Now here, what should CA Nitin advise CA Krit to do when the latter is stuck in the revision dilemma of materiality levels set earlier? Okay. Now, which should be modified first? First, modify the overall strategy and thereafter prepare the audit plan. First, prepare the audit plan and modify the audit strategy. Modify both of them simultaneously. Go with change in anyone as they are not. Here, very, very simple thing. Always remember, in strategic management also you learn the same thing. In audit also you learn the same thing. First, you prepare the strategy, then you prepare the plan. So when you're doing the change also, first you should change the strategy, then you should change the plan. It cannot be ulta. It cannot be that you will change the plan first and then change the strategy. Your nature, timing, and extent of audit procedures, that strategy you have to fix in place, and then subsequently you have to carry out the change. Okay. So that is how the this MCQ can. So even if here in this statement, it is more about another way to look at this question. Which of these 4 statements are correct? Which of these 4 statements are correct? And even without reading that paragraph, you may be able to get the right answer that yes, A statement is correct, B, C, and D are not. Is that clear? Okay. So with this, we conclude these 2 case studies. Slightly went slow because of impairment involved. Those concepts are important. So one thing what you can expect is some direct theoretical questions also, which they should not be doing, but institute being institute, we don't know. So our focus should be to score maximum in MCQs. MCQs, if you score maximum, handling the theoretical parts should not be a challenge. Okay. So tomorrow we'll continue. Shivdita will continue on taxation, and then tomorrow we'll share the plan for the upcoming classes. Okay. Thank you. And gradually we will extend the classes to 8:15, 8:20, 8:30, so that we can cover more in more depth. Okay. Sure. Thanks a lot, everyone.
Come on, let me open the next case study, guys. Sir, is the screen visible for you? Yes, thank you. Case study number 5, my dear friends. This is an interesting case study, and you'll have a lot of tax-related questions in this case study, so please be careful. ABCD Limited is a textile manufacturing company based in Gujarat, Surat, which enjoys a vintage of more than 50 years of good reputation and business. Company was set up by Mr. Amar Dev in 60s in a small room, and as the years passed by, it became such a successful and big business that now, after serving domestic consumers, company has gone global and expanding its business across Europe and Canada through third-party sales from India. Mr. Rahul Dev, the grandson of Amar Dev, is the managing director of the company and has been following quite an aggressive approach in globalizing their business after graduating from college. He remains in constant touch with CA Nitin Garg, who is a partner of Nitin Garg & Co., Chartered Accountants, and keeps on discussing with him legal compliances and procedures. Next point. Rahul knows that the complexities in business have increased a lot, particularly after advent of GST. That is, after introduction of GST, the complexities in business have increased drastically. And it is imperative to diversify the ever-expanding business. He understands that their company is well integrated into the web of international business transactions. There is inward as well as outward flow of goods and services between India and other countries. I expected the moment they tell the word inward and outward between India and other countries, they'll bring into picture the GST. That was very clear for me. GST impacts imports and exports too. Provisions in the GST law seek to provide a level playing field to domestic supplier vis-a-vis international supplier in case of imports and make exports more competitive. He has been discussing various provisions of GST law as will be applicable on import and export supply with respect to their business. If they wish to enter the global market directly apart from normal customs duty. ABC Limited wants to expand its business and management has found a suitable site which meets its requirement. The said site is owned by one of the directors of the company, Mr. D. However, D was unwilling to sell his prized property to the company. Company offers him in exchange a bigger site located in area having commercial protection. Lured by the offer, that means got attracted by the offer, D agrees to the above. A property valuer, that's all about valuation. Rahul, in order to expand his business, also discusses with Nitin on setting up a subsidiary outside India at Paris for specifically carrying out import-export transactions. Wow. Easily, and soon afterwards, Rahul sets up subsidiary at Paris under the name and style PQRS Limited. ABC Limited is engaged in the business of manufacturing clothes for other textile companies and non-textile companies. Now the company will itself carry out the import-export transaction without involving third party for export purpose, which it has been involved in doing now. It applies for IEC, Import-Export Code Online, which is mandatory for doing exports and gets the same. Its wholly owned subsidiary PQRS Limited, which is in Paris, is engaged in the business of ready-made garments. And the subsidiary purchases garments and other stuff from parent company. And the demand for garments of PQRS is very high, and hence to cater to its shortfall, they also purchase garments from other companies. Purchases are made at competitive price. During the year 23-24, ABC Limited sold to PQRS for euro 13 lakhs. And the cost of this garment is 936 lakhs. And at the year end, all these garments were lying at the closing stock with PQRS Limited. Euro is a functional currency of PQRS, while Indian rupee is a functional currency of ABC Limited, obviously. ABC Limited seeks help from Nitin on the following issues. And we have to assume that we are only CA Nitin and accordingly answer these queries. First bit. During the year, Rahul is finding it difficult to comprehend the GST taxation with respect to export sales made by their company. So with respect to export sales made by the company, he was finding it difficult. One such sale is where ABC Limited receives an order to supply goods to a dealer B in Greece. Company finds a supplier C in Singapore and asks him to supply goods to B in Greece. So that means, simple example, Shivateja is in India. I'm procuring goods from one person in UK and I'm telling that person send it to US. Same way, company finds one supplier C in Singapore and asks him to supply goods to B in Greece. Two invoices are raised here. One by the company on B in Greece and other by C in Singapore on ABC Limited in India. The point to be noted here is that the goods do not touch the Indian shores. So basically, goods are supplied from outside India to another person outside India without touching India, which is technically called out and out supplies. Technically, we call it as goods are supplied from non-taxable territory to another person in non-taxable territory. Next, they are shipped by sea from Singapore to B in Greece. There are many more such kind of export sale, and Rahul seeks Nitin help in getting out of this confusion. Don't worry, we'll help you. Rahul seeks CA Nitin's opinion on the GST procedure and the treatment for following two types of export transaction, which he plans to proceed with in near future. Clear? Rahul has purchased a license to put up a stall in the Textile supermarket Global Fair to be held in Milan, Italy. So he purchased the license to put up a stall in one exhibition and wishes to send his team to this fair along with their company's stock to be displayed over there for promotional purpose. So it's sending stock from India to outside India for display in exhibition. He had heard from a dear friend that he could sell his company's products within India, but these could still be categorized as exports. If you sell within India, why do you call it exports? But there is a concept called deemed exports, where a manufacturer will sell to an exporter. That's called deemed export. Already we discussed that story in one case study. He was eager to know about such circumstance. Next. Chief accountant of the company further seeks CA Nitin's time to understand the valuation and taxability of following transaction under GST. They have imported one special fabric from Paris and files ex-bond bill of entry for clearing warehouse goods for home consumption. So there are generally two types of bill of entry what we file. Bill of entry for home consumption, where we pay the duty and collect the goods. Second is called bill of entry for warehousing, where it's called into bond bill of entry. We have to execute one bond for filing bill of entry for warehousing, my dear friends. Next. ABC Limited imported textile fabric from London and sells them to Panesha Private Limited in India before the goods are cleared for home consumption. Oh my God. Customs declaration, that bill of entry, is filed by the agent of Panesha Private Limited for clearance of such goods. Next point. Statutory audit, SA 315, 330, it's all related to your audit related story. That's it. Come on. Let's see the multiple choice question. First one. Which of the following is responsible for issuing or granting IEC? So let me tell you, IEC import-export code is actually granted by whom? Come on, somebody please tell. Very good answer by one student. The answer is Director General of Foreign Trade, Ministry of Commerce and Industry. Don't write Department of Revenue, MCA and all. It is always given by DGFT, Ministry of Commerce and Industry. Clear, my dear friends, everybody? Next point. Second question, that's related to the strategies, audits. Third question, GST is leviable on the fabric imported from Paris while filing for its clearance. Wow. What is that line they're talking about, my dear friends? GST is leviable on fabric imported from Paris while filing for its clearance. We imported some fabric from Paris, right? Yeah. And files ex-bond bill of entry for clearing warehouse goods. So when you file ex-bond bill of entry, that means what, my dear friends? That means you are clearing the goods for home consumption. You definitely have to pay something called BCD, social welfare surcharge, and also IGST. So GST will be levied. So statement is correct. Next. GST is not leviable on the sales made to Panesha Private Limited. On this, GST will not apply, my dear friends, because in case of supply of goods before clearance for home consumption, my dear friends, GST will not apply because the transaction is not a supply at all. Let me highlight this point to you, my dear friends. Case study number 5, MCQ number 3. The point is very clear, my dear friends. Number 1, import of goods attracts import of goods cleared for home consumption. Attracts BCD, SWS, and also IGST. Normally. And of course, there's something called safeguard duty, countervailing duty, and all, which may come. But if it is home consumption, then definitely it attracts BCD, SWS, and also IGST. Good. So what is that they ask in the question? If they ask in the question, GST is leviable on the fabric imported from Paris. They ask in the question, GST is levied. So definitely GST is levied on fabric imported from Paris. So that statement is correct. I hope you understood, my dear friend. One student is asking, sir, please repeat. I hope you understood, my dear friends, now. Yeah. Second bit, what did they ask? GST is not leviable on sales made to Panesha Private Limited. What is that we'll say? In case of goods cleared, in case of goods supplied before clearance for home consumption, it is not regarded as supply as per section 7(2)(a), read with schedule 3. Because 7(2)(a) talks about the transactions which are neither regarded as supply of goods nor regarded as supply of services. Clear, my dear friends? Hence, on that transaction, GST will not apply. On that transaction, GST will not apply. Come on, what is that they gave in the question? GST is leviable on the fabric imported from Paris while filing its clearance for home clearance. Very good. The answer is correct. Second, GST is not leviable on sales made to Panesha Private Limited. 100%, that is also correct. GST is not levied. So in those two statements which are given, both the statements are correct. So answer is, my dear friends, option B. Because both the statements are correct, and that too, these statements are independent of each other. And technically, whenever we clear the goods before clearance for home consumption, that is called high C sales. What do we call it? High C sales. We have imported the goods, but even before clearance for home consumption, we sold that goods. That is technically called high C sales, my dear friends. Are we getting clarity? Friends, come on, please reply. Good. What is the doubt student is asking? Sir, what does ex-bond bill of entry mean? Sir, I told you that there are two types of bill of entry. Number one, bill of entry for home consumption, bill of entry for warehousing. When you file bill of entry for warehousing, you have to file something called into bond bill of entry because you have to execute one bond when you are filing bill of entry for warehousing. But when you file bill of entry for home consumption, my dear friends, what if there is no requirement to file? There is no requirement to execute any bond. That's why it is called ex-bond bill of entry for home consumption. That's why what do we call it, my dear friend? Ex-bond bill of entry for home consumption. Did you understand, my dear friend? Please reply. Come on, my dear friends. Did we get that point? Good. Next. Fourth bit. Fourth bit is related to your law. Fifth bit. In case of trade involving B in Greece and C in Singapore, invoicing should not have been done by ABC Limited in India. Why invoicing will not be done? Why invoicing will not be done? Invoicing will definitely be done. There is no doubt about it. Correct, my dear friends? So speak out. What is supposed to be done is invoicing will definitely be supposed to be done. There is no question of invoicing not supposed to be done. GST will not apply because this is called as out and out supply. Goods are supplied by person located in non-taxable territory to another person located in non-taxable territory without entering India. But still, invoicing is supposed to be done, my dear friends. There is no doubt about it that invoicing is not supposed to be done. So what did they say here? Invoicing should not have been done. So this statement is incorrect. Second, statement 2. Value of such shipments has to be included by ABC Limited in the value of exempt supply for the purpose of reversal of ITC under Rule 42 and 43. So let me tell you, for the purpose of reversal under Rule 42 and 43, these are definitely not included. So when I say these are not included, that means this statement is also incorrect, my dear friends. So this statement is also incorrect means statement 1, statement 2, both the statements are incorrect. So let me highlight that point very clearly to you, my dear friends, which goes something like this. Yeah. In case of out and out supplies, that is supply from non-taxable territory to another person in non-taxable territory, GST will not apply, since it is neither regarded as supply of goods nor regarded as supply of services. It is neither regarded as supply nor regarded as supply of services. Correct, my dear friends? However, invoicing has to be done. That there is no doubt. Clear, my dear friends? And second bit, what they were telling is, my dear friends, that is about Rule 42 and Rule 43. So let me tell you, my dear friends, Rule 42 talks about apportionment of ITC in case of inputs and input services. And Rule 43 talks about apportionment of ITC in case of capital goods. Come on, my dear friends. Apportionment is in case of capital goods. And for the purpose of determination of exempt supplies. For the purpose of what, my dear friends? Determination of exempt supply, value of above shipments is not included. When I say value of above shipments, what is that, my dear friends? Supply from non-taxable territory to another person in non-taxable territory. That will not be included, my dear friends. A very, very interesting point, what you should definitely get clarity upon. Are we clear with this point? Everybody, please reply. All of us, come on, my dear friends, please reply. Does this point make sense for everybody? Good. So what is that they asked in the question? So first statement they gave, second statement they gave. And both the statements are incorrect. So answer is nothing but option B, my dear friends, because both the statements are incorrect statements. Next, let's look at descriptive. Descriptive, come on, first bit, my dear friends. Provide the accounting treatment. And the moment they talk about accounting treatment, they are talking about something called what, my dear friends? Financial reporting. And second bit, as regard to transaction with the D, one of the director, state the audit procedures, my dear friends. Wow. Which audit procedure, that also is not concerned with taxation. For a last bit, discuss the implication of proposed transaction relating to sending of company's merchandise for a display in textile fair in Italy. So one point, let me tell you, my dear friends. Listen carefully. Question number 8. If goods are sent out of India for the purpose of exhibition, it is not regarded as supply unless it is covered in Schedule 1. Because Schedule 1 talks about transaction regarded as supply, even though there is no consideration. Because you have to understand the logic here. When we are taking the goods to the exhibition, it is not a supply unless the actual supply happens at the exhibition. So if it is not a supply, then it is not regarded as zero-rated supply. So when it is not a supply at all, how can you call it as a zero-rated supply? Because zero-rated supply will come into picture only in case of exports or supplies to SEZ. So it is not a supply at all. There is no question of zero-rated supply calling it, my dear friends. Getting the point, everybody? Then what else they asked in the question? So now one more point, let me tell you, my dear friends, that is, in case of zero-rated supplies, so zero-rated supply covers two things. Number one, exports. Number two, supplies to SEZ. And in zero-rated supply, there are two options what a person has. Number one, export without payment of tax under LUT. You have to execute one letter of undertaking and you can export the good without payment of tax. And ITC, input tax credit balance, in electronic credit ledger can be claimed as a refund. And I'm sure most of you guys already know that for the purpose of claiming refund of the balance in electronic credit, there is a formula which says ITC into your exports divided by total turnover. And one point is very clear that ITC on inputs and input services is considered and not capital goods. But second option, what they have is, my dear friends, export with payment of tax. Where what they can do, pay IGST on exports using electronic credit ledger and cash ledger. Further, such IGST paid on exports can be claimed as a refund. So a person has got two options, my dear friends. And the best part of this option is what I'll tell you. You can also claim ITC on capital goods can also be claimed. And ITC on capital goods means what, my dear friends? Capital goods is nothing but those goods, the value of which is capitalized in the books of accounts. That also can be claimed. But in this question, my dear friends, in this question, there is no requirement of LUT. Since it is not a zero-rated supply. When it is not a zero-rated supply, my dear friends, then where is the question of requirement of LUT, my dear friends? Come on, what else did they ask? Also discuss under what circumstances goods sold within India can be categorized as exports under GST law. And also touch upon the taxability of such transaction. There is something called deemed exports. In case where supply is made by manufacturer to an exporter. Supply is made by manufacturer to exporter, my dear friends. Then it is called as a deemed exports. Then it is called what, my dear friends? Deemed exports. even though, my dear friends, manufacturer, he is not sending goods out of India, it is still regarded as what, my dear friends? Deemed exports. So getting clarity? And in deemed exports, my dear friends, the payment need not always be received by way of foreign exchange. It could be Indian rupees also, because it is not normal export, it is deemed export. And just to give a perspective, my dear friends, in case where we supply of goods under any advance authorization and all, we call it as a deemed export. And there's something called EPCG, Export Promotion Capital Goods, which is covered in your foreign trade policy. Even in that case also, it is called deemed export. And then making supply to an export-oriented unit, that is also regarded as deemed exports. So there are all the cases which are covered in deemed export, my dear friends. What are the points I just told? Advance authorization is 1 point. EPCG, Export Promotional Capital Goods, is 1 point. Export-oriented unit, that is also 1 point. And then 1 point called supply of gold. Supply of gold by a bank or a public sector undertaking against an advance authorization. That is also regarded as deemed export, my dear friends. And on deemed exports, my dear friends, definitely GST will apply. Don't think that, don't be under apprehension that GST will not apply on deemed export. Even in case of deemed export, 101% GST will apply. But whatever GST is applied, that GST can be claimed as refund. That benefit is always there. Whatever GST is applied, that GST, my dear friends, can be definitely be claimed as refund. In case of deemed exports, GST can be claimed as a refund. Very, very interesting point. That's about this interesting case study, my dear friends. That's all. 6, 7, 8, and 6th question is FR, 7th question is law, and 8th question is about GST. That's what we just discussed. So if you observe, there are a lot of interesting element in this case study in relation to GST, my dear friends, especially related to exports and zero rated supplies. Are we all fully clear with this concept, my dear friends? Kindly please confirm. Yeah, surely ask me one question. Sir, in case of supply to SEZ, who gets refund, supplier or recipient? Sir, generally when we make supply to SEZ, my dear friends, supplier will take something called LUT, letter of undertaking, and supplier will not pay any tax. Whatever input tax credit supplier has got, supplier will happily take refund. There is no question of recipient taking refund because recipient did not pay any GST. Generally, when we supply to SEZ, we don't charge any GST. Got it? Good. That's it.